Accounting standard number 80 talks about related party disclosures. Related party disclosures. Objective of the accounting standard is to learn about what kind of disclosures we have to make if we are in a transaction with related parties. So this standard talks about two things. When is a party related? When can we tell that the party is related to us? And second, what kind of transaction is called as a related party transaction? These are the two things which this standard tries to answer. Applicability, it applies to both independent and consolidated financial statements. We are going to start with certain definitions. The first definition which we are going to place in perspective is related party relationships. Related party relationships can either be with an entity or you can be in a relationship with a person. Relationships can be with an individual or with an entity. First, these relationships are broadly classified into two types. For example, in our day-to-day thing, as a person, we can classify relationships as one is blood relationship, or we can call that as relatives. Other is relationships which we make during our lifetime. We call them as friends. These are not blood relations, not part of family. So we can call it as family and friends are two categories. In a company parlance, relationship can be classified into relationship of control and relationship of significant influence. So we are going to learn 5 examples of relationships where the relationship could either be with an entity or with an individual. Relationship can be where control is there or just significant influence. I have to come to the word control and significant influence, but before that, let us see those 5 examples which have been given by the standard telling that these kind of relationships are called as related party relationship. 5 examples are given. Example 1 given and 2 given are to deal with entities. These two are going to be where entities are going to become our related parties. First, subdivision A talks about entities which are going to be called as holding company, subsidiary company, or it can be fellow subsidiary. This relationship is discussed in subdivision A, holding, subsidiary, fellow subsidiary. Now, in the context of parent-subsidiary relationship, whether it's going to fall under control or significant influence, answer is there is control involved in it. Control means what? I am able to take the decisions. We have the power. 1 minute, I will also take just remember this simple meaning for now for control. We have the power to decide on their policies. So we are going to take decisions for that entity. We are in a position to take that decision, which means we are having control. Suppose we can only participate in the decision making. We cannot take the decision by ourselves. We can only participate or influence the decision. Then we call it as significant influence. So first, to do with control, the relationship is parent-subsidiary relationship. How was the standard told that is entities that control or they are controlled by or are under common control with the reporting entity. So entities that are controlling the other entity, which means what is that talking about? Suppose I am controlling this entity, holding company. I am being controlled by someone, which means I am the subsidiary. Under common control, we are talking about fellow subsidiary. So parent subsidiary relationship is captured under the first example, first example given by AS 18. Entities that, can we just repeat it? Entities that directly or indirectly control. There is this extra word, we will come to it afterwards. Entities that directly or indirectly control, or they are controlled by or under common control with the reporting entity. For everywhere there is something called as reporting entity which is used, because in a related party relationship there are at least two entities involved. Then only there can be relationship. Two entities should be involved for a relationship to come into picture. You should know for which entity are you determining the related parties. The entity for whom you are determining the related parties, that entity will be called as reporting entity. Okay, so there is something called reporting entity which we will find in every subdivision. So first relationship is through with. Totally 5 relationships we are discussing. First relationship, through with. Second relationship is talking about, subdivision A was about holding, subsidiary and fellow subsidiary. Second relationship is about associate and joint venture. These two relationships are covered. In associate, what is an associate? We have to understand. Suppose we are now when I tell associate or joint venture, are we talking about control or significant influence? If it is associate, it is significant influence, whereas joint venture, it means you are jointly controlling that entity. Second relationship is on associate and joint venture. The relationship is mentioned like this: associates and joint ventures of the reporting entity. That's all. Only first line we will read and understand. Associates and joint ventures of the reporting entity. Let's take reporting entity is Sun Limited. For this entity, we are going to find out the related parties. This entity has invested money in Moon Limited and Star Limited. Now, how to decide whether it is an associate or a subsidiary? The decision part is based on the percentage of shareholding which Sun Limited has. Suppose I tell Sun Limited has more than 50% of the holding. More than 50% if Sun Limited holds, then that is going to be called as a subsidiary relationship. Suppose I tell that Sun Limited is holding more than 20%, then it is going to be called as an associate relationship. So if reporting entity has invested money in X Limited, for the reporting entity, what is X Limited? An associate. If reporting entity is jointly controlling Y Limited with someone else, there is another company Z Limited. Z Limited and reporting are jointly controlling W Limited, in which case for this company reporting entity, who is Y Limited? Joint venture. Okay, joint control means joint venture, significant influence means associate relationship. So what is the second part? Associates and joint ventures of the reporting entity. Now the same example, let's take it where P Limited, okay, I will not change, I will take it with this itself. X for Sun Limited. I move it to, I will take with names, okay, Sun, Moon, Star. Sun Limited has invested 25% in Moon Limited. Suppose you're finding related parties for Sun Limited. Who is the related party? We will not take Star, right? Who is the related party for Sun? Moon Limited. Under what category will you call it as? It's an associate. Okay. Now, if you are finding related party for Moon Limited, who is the related party? Sun. Is Sun an associate? We call Sun, suppose We are seeing for Moon Limited and Sun has invested money for us, that Sun is going to be called as investing party. So even investing party, or let's take this way, Sun Limited is jointly controlling Star Limited, 50% only is holding. So for Sun Limited, if you're finding the related party, what is Star Limited for it? Joint venture. However, if you're finding the related party for Star Limited, Sun is the related party, that we will call it as venturer. So this subdivision has associates and joint ventures of the reporting entity and investing party or venturer in respect of which reporting entity is an associate or a joint venture. If you remember this provision, okay, even if you understand, should be sufficient. You may not have to repeat this provision as such in the question. If you write associate and joint venture of the reporting entity, should be enough. Moving to the third category. Third and fourth category deal with individuals. First and second category dealt with entities. Third and fourth category deal with individuals. Third category talks about an individual who can control or significantly influence the entity. How can you establish control or significant influence? Let us look at the meaning of those words and then come back, continuing this relationship. Control means you have the power to decide on the accounting policy, on the financial policies. You have the power to decide on the operating policies. But how do you, see whether a person is able to control the entity or not? For that, standard gives you some guidance. It talks about three things. I will first dwell around two things. Either you are holding shares of the company or you're being a part of the management of the company. If you're holding shares in the company, at least 50%, which means this is the wrong word, you should be able to hold more than 50% of the shares. If you hold more than 50%, the standard tells that you are in a position to control the entity, or you are able to control the board of directors in the company, in which case also you are in a position to control the company. So two things the standard gives guidance. One, you hold more than 50% of the shares, either directly or indirectly, which means A Limited is holding 50% shares in B Limited. B Limited is holding shares of 60%. I'll take it as 52% here. 60% in C Limited. Is A Limited controlling C Limited? Yes, because this is 52%. So A Limited is in a position to control B Limited. So B Limited is a subsidiary. B Limited is controlling C Limited. So C Limited is a subsidiary of B. So indirectly, C Limited is a subsidiary of A Limited. Okay, so direct or indirectly, if I'm holding more than 50%, it means that there is a control. In our exam questions, only this is tested, this and this is not at all tested. This is not being used anywhere in the standard discussion itself. So I've just written it here, but I'm not going to really explain on it. If I explain, it will be last. Right now, it will be too offbeat from our discussion. So we will go back to our discussion of related party relationship. Individual who is holding interest in the voting power of the entity that gives him control, or it is giving him significant influence over the entity. How is control established? Two things. One, you're holding voting power, or two, you're able to control the board of directors. Here, which thing is used here? Have they used both the criteria or only one criteria? Means only one criteria. It tells individual who is owning the voting power of the reporting entity. So controlling board of directors is not part of this. Individual is able to hold more than 50% if his shareholding is there, then it gives him control. If it is more than 20% only, it will give him, he will be in a position to significantly influence. So any person who's holding more than 50% will be in control position, more than 20% will be in significant influence position. So a shareholder who is holding so much percentage of shares, not only that person but also his relative also will form part of this. So can we just repeat it? Individuals owning either directly or indirectly an interest in the voting power that gives him control or significant influence over the entity. Subdivision D. Before I come to it, yeah, there is relative also here. This plus relative. So relative meaning we will see. Relative includes the following. First, if you are finding the relative of this person, his spouse is the first thing. Thereafter, his mother, father, brother, sister, son, daughter. All of them are going to be classified, are going to be told as relative of the individual. Subdivision D. Key management person plus his relatives. Fourth one is pretty simple. It just tells any person who is a key management personnel will be called as related party. Who are KMP? They have the authority and responsibility to plan, control, and direct, which means they are going to manage that organization. Any person who is in a position or authority to manage the organization, the entity, is going to be called as a KMP. Examples which you can remember is MD, CEO, Executive Director. Executive Director is also forming part of this whole-time director. Non-executive director is not a KMP. There is an illustration question on this. Whether non-executive director is a KMP, answer is no. He is not a KMP. So even KMP, not only KMP, but also his relatives will form part of related party. Can we just go 4 relationships done? 4, right? Yeah. We are just left with the last category of relationships. 60 to 70% questions in the study material is to decide whether it is a related party or not. So related party relationship, just on this definition, 60 to 70% questions are placed in the material. 4 relationships. First relationship, I will also keep it here. Entities that control or are controlled by or are under common control with the reporting entity. This captures parent subsidiary and fellow subsidiary relationship. Second one, associate and joint venture of the reporting entity. This captures associate and joint venture relationship. Third one, individuals who have voting power, which is giving them control or significant influence over the entity. This is capturing individuals' relationship, plus even their relatives are captured here. Next, KMP plus relatives. Last category only is a bit tricky to understand. Last is subdivision. If you see, relatives relationship can either be with an individual or it can be with an entity. This E category is talking about a relationship with an entity. An entity where this person described in C or D. Who is a person in C? A C is a person who is having voting power, which is giving him control or significant influence. D is a KMP. So we are going to find a related party for this entity. Let's take reporting entity. We will call this limited as X limited. This is Raja. We will call him as Raja. Raja is a KMP in this entity. Is Raja a related party then? Yes. Okay. Raja is a KMP, so he is a related party. This related party understood. Now, a little more we will go into where and all Raja is related, other entities also we will see. Let's take Raja is having 23% shares held in this entity. Raja is holding 23% shares in this entity. In which case, Raja, can he influence this entity? Yes, because he is holding 23%, he is having significant influence on that entity. Because Raja can significantly influence this entity also, indirectly these two entities get related. So Raja is someone common between X limited and Y limited. Let's call it as Y limited. Because Raja is common in X and Y, X and Y are getting related. Okay, so entities over which persons described in C and D are able to exercise influence, that entity will become a related party for us. Okay, let's now just look at examples. Whichever are study material, little different questions, I've given them as issues here itself. X Limited has invested money in Parrot and Sparrow. X Limited is holding 25% in Sparrow, which means what is this relationship? Associate, parent subsidiary, or joint venture? Answer is this is an associate. X Limited is also holding shares in Sparrow Limited, which means this is also becoming an associate. Question is, Parrot and Sparrow, are they related? Here, before I get into this, I will talk about one more question, then come back here. Y Limited is holding shares 60% in A Limited and 70% shares in B Limited. Y Limited is holding shares 60% here. So what kind of relationship is this? Parent subsidiary relationship. Y Limited with B Limited, subsidiary relationship. Are A and B related? Yes. How? Fellow subsidiary. Okay, fellow subsidiary. Because in that definition, what was told? Either I control, or I am being controlled, or I am under common control. All the three are covered. Okay, now we will look at this example. Parrot and Sparrow. Here it is associate. For Sparrow also associate. We will go step by step. For X Limited, who and all are related parties? Parrot and Sparrow. What relationship? Associate relationship. Now we will come to Parrot Limited. For Parrot Limited, who is X? Investing party. Investing party it is called. So for Parrot, X Limited is an investing party. So X is a related party. What is the relationship given there? Associate or joint venture. I'll go back to that. Associate, joint venture, or it can be investing party or venture. This is what 4 words have been given. Now the question arises. Parrot Limited, X's investing party. Are these two related? Are co-associates related? Answer is no. Co-associates are not related parties. So Parrot and Sparrow, they have no relationship. Okay, this is the first thing which you should bear in mind. Next, Virat Limited, Anushka Limited, they have invested in a company called Reebok Limited. How much are they holding? Means Virat and Anushka jointly control this Reebok. If jointly controlled, it is a joint venture relationship. We will look at it from Virat viewpoint. From Virat viewpoint, who is the related party? Reebok. What and under what category of relationship? Joint venture. Like meaning brother, sister, mother, father. Here we're going to call it as a parent, there's a holding company, subsidiary company, joint venture, associate. These 4 words we're going to use. Here for Virat Limited, Reebok, for Virat Limited, first related party is Reebok under the category of joint venture. For Reebok Limited, who are related parties? Virat is related party. Anushka is also related party. Under what category? What name? Ventures. under the name venturers, they are related party. Now question comes, are Virat and Anushka related party? Are they related party? Answer is no, because co-venturers are not related parties. That's what the standard uses only 4 words. Either they are associate or joint venture, or investing party or venturer. Only these 4 can be related parties. So co-venturers are not related parties. So what should be there in mind? Co-associates, not related party, which means this is the example of remembering co-associate relationship, and this is the example for remembering co-venturers relationship. Next, we will move to common directors. Let's take an example of, let's take CATN Manoharan, a chartered accountant, is a director in Infosys. He is also a director in ICICI Bank. Are they related? Meaning, are Infosys and ICICI Bank related is the question. This cannot be a straight yes or no. We need to look into the details a little more. Let's take TN Manoharan is a KMP in Infosys. Is he a related party for Infosys? Yes. Under which category? Under the 4th category, KMP plus relatives. So under that category, Manoharan sir is related party for Infosys. Next, he is a director in ICICI Bank, but in a non-executive role. He does not have any right to participate in the decisions, nor he has the right to control the decisions. In a non-executive role, he is a director of ICICI Bank. In which case, are these 2 related? No, because he is able to influence Infosys, but is he also able to influence ICICI? No. If he can influence both, then they become related parties. If he cannot influence both, then they are not related. Just because there are common director, these entities, which means Infosys and ICICI, don't get related. The person who is a director in both the companies should be able to influence both the entities. Only then he can be these 2 entities can become related. Clear? 3 examples were done. Co-associates, not related party. Co-venturers, also not related party. Just because you have common directors, the entities don't get related. Next issue. Virat and Anushka are holding 34% in Reebok. For Reebok, we are going to look at everything from the viewpoint of Reebok only. For Reebok, are Virat and Anushka related parties? Yes. Under which category of relationship? Associate. Associate. Because 34% only. Okay, 2 people, 3 people does not matter. Here it is associate relationship. There is an associate relationship. So Virat, for Reebok Limited, we will tell Virat and Anushka are related parties. Now Virat and Anushka also are partners of VA and Company. This is a partnership firm in which they are partners. Are they able to control this firm? Are they in a position to control that firm? Yes, they are only the partners, so they only control. So they can control VA Limited. Can we tell Reebok and VA Company are related parties then? Yes or no? Anybody online can turn on your mic and answer. 366 of them. Rita, can you answer, Rita? Okay, no one turning on mic. Virat and Anushka, can they influence Reebok Limited? Yes, they have significant influence here. Can they influence VA and Company? Yes, they can. In fact, they can control itself. Not only significant influence, they can control itself. If they can influence both the entities, are these 2 entities related? Yes. If Virat and Anushka can influence the decisions of Reebok and they can also influence VA and firm, These two entities on which they are able to influence will become related parties. This is similar to the previous one, T.N. Manoharan. T.N. Manoharan sir is a director of Infosys. Here he has an influence or control, whatever be the case. But is he able to influence ICICI Bank? No. If he could not influence, are they related parties? No. Here, Virat and Anushka can influence both the people, both the entities. Hence, these two entities become related. Next issue. These issues are nothing but study material questions only. So I am not going to really look at material questions after the discussion. Only if I find one or two anything different only I will look at. Next thing. Deepika Limited has invested in Ranveer Limited. Ranveer Limited has invested in Dua Limited. Before I get into this, I will give with some other percentage and then come back to this. Okay? Let's take Deepika Limited has invested in Ranveer 60%. Ranveer has invested in Dua 80%. For Deepika, is Dua related party? Yes. Under what category? Subsidiary. Directly or indirectly also you can, if you control an entity, still it will be captured under subdivision A relationship. So either control or being controlled by or under common control. Directly or indirectly is a related party relationship. If you come to now, in this example which I am given, it's not a control relationship, it's only a significant influence relationship because it is not more than 50%. It is only more than 20%. Deepika in Ranveer, 28%. So, for Deepika, who is Ranveer? Associate. Okay. For Ranveer, is Deepika related? Yes. What name you will put it? Investing party. Okay. You should be able to be very clear in your mind. Associate, investing party. Joint venture, venturer. Okay, joint venture, venturer, not many questions are there in our material also. Associate and subsidiary, more questions are there. Moving to Dua Limited. Ranveer has invested money in Dua. For Ranveer, who is Dua? Associate. For Dua, who is Ranveer? Investing party. Okay. Now question is, are Deepika and Dua related? Associate of an associate, are they related party? Answer is no. If you look at the definition, does it talk about direct, indirect word here? Not there. That's why associate of an associate is not a related party. Okay. Control meaning. We'll look into this example. Ranveer Limited has invested 60% in Alia Limited, which means Alia is a subsidiary for Ranveer. Now, Alia Limited has invested 12% in Raha Limited. So, for Alia Limited, is there any relationship between Alia and Raha? Associate 12%? No, that is not there. Okay. Now question is there any relationship between Ranveer and Raha? Yes or no? No. Ranveer subsidiary is Alia. Alia and Raha, are they related? No, because only 12%. Ranveer is having 14% in Raha. You have to check Ranveer in Raha totally how much percentage is having. Here, is he able to control Alia? Yes. So subsidiary 60%, which means control. Either he is having in Raha or through his subsidiary is having in Raha, both put together 14 plus 12 comes to 26%. Hence, for Ranveer, Raha is becoming an associate. Because Ranveer is directly is having 14%. Indirectly, Ranbir is having 12%. Both put together is what you're going to see for the relationship. Control or significant influence can either, you can enter into this company either directly by putting 26 or through Alia he's put in 12%. So this is also a significant influence he can exercise. They are related parties. Now going over the meaning of the word control, significant influence. Control can come either because you're holding the voting power, you're a shareholder there. If you're holding more than 50%, it is control. If you're holding 20% or more, it is only substantial interest, significant influence only. If you can control the board of directors, then this is also control. Meaning control can come either by voting power or by controlling the board of directors. Suppose you are having more than 50% of the voting power. What kind of relationship it is? Control relationship. Subsidiary. But I am talking about a control SI relationship. This falls under control relationship. If you are able to control the board of directors, what relationship it is? Control relationship. Now the standard tells one more category. It tells, suppose you are holding 20% or more voting power in that entity, which means are you in a position to control? No, only significantly influence. Okay, substantial interest, which means not more than 50%, 20% more. You are having substantial interest in the voting power, plus you are able to control the board of directors, then that relationship will be under control. What did I tell initially? If you're holding more than 50%, what relationship? Control relationship. If you're holding more than 20% relationship, what relationship? Significant influence. Yes. Here there is a third category covered. Suppose I hold only 20% or more, but I can also control the board of directors. Both put together, if I'm able to do, then that relationship will be a relationship of control. Even though my voting power, my shareholding is not so much, I'm able to control the board also at the same time. In that case, it was a control and not significant influence. Significant influence, right to participate, that is explain the meaning, but indicators of significant influence means holding 20% or more voting right, or statute has given you the right to participate in decisions, or there is an agreement that you will be participating in decisions. In our exam question, only this will be tested. So significant influence means you can influence the company but not control the company. The standard also tells you what are ways you can significantly influence. Either you have a representative in the board, or you are able to participate in the policy decisions, or you are a provider of technical assistance. They are technically dependent on you. Even then, if they tell that it is a significant influence. Okay. We will look at this question. Narayana Murthy is a key management personnel in Infosys and also Datasys. Are they related parties? Yes, they are related. Here, the standard also tells that there is one, I think, there is a study material question where they tell just because he is a KMP, that alone is not sufficient. Yes, they are related. Infosys and Datasys are related. However, they also explain a little more. Just because a relationship exists, that is not sufficient. The KMP should be in a position to influence both the companies. Then only the two companies can be related. Which means that just because he is having a designation, substance, don't look at the substance of the transaction, look at the form of it. He is holding KMP, yes, they are related. However, you also should check whether in the position of KMP, he is able to influence both the company. If yes, then both the companies are related. So if you're answering a question, you should also give this extra thing, that if the KMP is able to exercise influence on both the company, only then you will take both the companies are related. Okay, this last thing we will see, and then we will move to another discussion under ASAT. Arjun, Amar, Akbar, Antony. 4 companies are here. Arjun Limited is having 30% in Amar Limited. Amar is having 35 in Akbar. Amar is having 40 in Antony. First question. Is Arjun related to Amar? Arjun related to Amar? Yes. Associate relationship. Next question. Is Akbar related to Arjun? Akbar related to Arjun. Why? No, associate of an associate. Associate of an associate is not related party, so it is not related. Next question. Are Akbar and Antony related? No, co-associates are not related. Okay, I hope by now the associate relationship is clear. Okay, now we will go to deemed not to be related parties. Deemed not to be related parties. What are the 5 relationships we have seen? Subdivision A, entities which are controlled, which directly or indirectly they are controlled or be controlled by or under common control with the reporting entity. Second one, associate and joint venture, investing party and venturer. Third, individuals who are they are directly or indirectly they are able to exercise significant influence on the entity. In that case, that individual and his relative will become related parties. Fourth one is KMP plus his relatives. Fourth thing's clear. Fifth one is any entity on which subdivision C and D is able to influence. If this person can influence this entity, then these two entities will become related. Now coming to something which are not related parties. Two companies cannot be related just because they have a common director. We have already seen most of it, okay? However, if now common directors, we had seen one example, Narayana Murthy example, and T.N. Manoharan example. T.N. Manoharan example. He is a director in Infosys. He is also a director in ICICI Bank. Just because he is a director in both the company, will Infosys and ICICI be related? No, they are not related. He should be able to influence both Infosys and ICICI. Only then ICICI and Infosys can be related. This is about common directors. Next. Entity is having major volume of business from one person only. He has one customer who is the major customer or one supplier who is the major supplier. Will that customer or supplier become related party? Okay, just because he is the entire sale is making to one person does not mean they are related parties. Relationship should be where you are able to control the entity or influence the entity. Just because you are having more business with a person does not mean you are going to be related to that person. There is an illustration question on this in the study material. Next, these parties are not related. The standard itself tells that these should not be taken as related parties. First one, providers of finance. Example given in the study material, X Limited has taken a loan from SBI. I am just giving my own names though. Has taken a loan from SBI. 10 lakh rupees. Because, or we'll take it as a little more. Let's take 50 lakh rupees of loan taken. So SBI tells, if I'm giving you so much, I should be able to sit in your board to know what all decisions you take. I should be able to participate in the decisions that you take in the board because I have given you a huge money. Let's take 50 crore rupees itself. Huge amount has been given. I should know what is going on in your company. How is this money being utilized? So SBI is asking to become a part of the board. Just because SBI is becoming a part of the board and participating in these decisions, can we take SBI to be a related party? Means AS 18 tells no. It clearly tells providers of finance should not be taken as related party. So SBI, even though it's participating in the decision, there's a clear guidance not to take them as related party. So who are not related party? Common directors. Second, significant volume of business you do with one person. Third is providers of finance if you know sufficient. The other three are not tested. Not at this level, not at final also. So not at all required from examination. Now, last part of the standard I'm going to cover. Three things are left, that's all. Now, this relationship which we are talking about, before you read this, let me explain what background that should be put in. 1st April, we start the year and we end by 31st March. So, they're following financial year as the accounting. April X Limited, or let's take T.N. Manoharan, sir, is a KMP in Infosys from 1st April onwards. In the month of July 2025, Manoharan sir died. So he has, the relationship with Manoharan sir has closed. Now on 31st March, we are coming, 31st March 2026 we come. When we are preparing financial statements, should we disclose Manoharan sir as a related party in the financial statements? Yes or no? Yes. Even though he is not a related party as on 31st March, if he was related at any time during the reporting period, he will be considered as a related party. Relationship need not necessarily exist at the balance sheet date. If the parties were related any time during the reporting period, then that person is going to be considered as a related party. Here I am telling related party, nothing but he has the power to influence. I've given it. Related party transaction means what? A transaction that takes place between related parties. Transaction means what? It is a transfer of resources between related parties. Either you charge money or do not charge money, that is not the point. Whether or not price is charged, if there is a transaction between related parties, it will be called as a related party transaction. There is a study material question where they tell you that some goods have been sold from one person to the other. There is some relationship between them. They tell either, I think, subsidiary or associate relationship is there, but no price was charged. Can that be called as related party transaction? Yes, because any transfer of resources happening between related parties, regardless of whether a price is charged or not, will be considered as related party transaction. Okay, now final discussion. What is the disclosure requirement? If Manoharan sir, Manoharan T.N. Manoharan sir is a very, very famous chartered, he's a very popular chartered accountant. He's also a Padma Shri Award winner. He passed away last month, July. Really, he passed away last month. So, Manoharan sir, let's take, is a related party of Infosys. He is a KMP, related party. In which case, what and all should you disclose? Yes, we have understood that he is a related party. But if we have to disclose in the financials, what are the things we should disclose? Two things. One, T.N. Manoharan. We have to tell the name of the person. Next, we will tell what relationship we have with the person, KMP. Let's come to, say, Virat and Anushka have put in 35% money in Reebok. In which case, what should we disclose under name of related under disclosure requirements? First is name. We will tell Virat and Anushka. And nature of relationship. What nature of relationship they have? Associate. So for Reebok, they are associates. Is it? Investing party, not associate. For Reebok, relationship which we are going to write down here is investing party. Okay. So this is what we are going to disclose. When we are disclosing, let's take Virat and Anushka have 35%, we will start with 75%. I'll give a control example. 75% with Reebok. During the year, there was no transaction between Virat and Reebok. No transaction at all. No related party transaction happens. Still, should I disclose it? The answer is yes. You have to check whether that relationship is a control relationship or is it a significant influence relationship. If it is a relationship of control, then even if there are no transactions happening between the parties, still information should be disclosed in the financial statements. Whereas if it is a significant influence, where let's take 35% only Virat and Anushka hold in Reebok, in that case, will you disclose if there is no related party transaction? Not required. So, because if they are in a control position, the fact that there is a relationship itself, they will be able to influence in some way or the other is what the standard feels. So what you should remember, there is a study material question in this also. I don't know whether that relationship is control or significant influence, I don't remember. But you need to check whether if there is control, disclose even if there is no transaction. If it is significant influence, disclose only when there is a transaction. Okay, now we will just, I've removed that out. Relationship is there. Transaction also takes place during the year. For which kind of relationship will you disclose? For control, significant influence, or for both? Both. Because relationship was also there, transaction also happened. So you will disclose both relationship of control and also significant influence. Next thing, relationship is there, but no transaction happened during the year. What kind of relationship you will disclose? Only control you will disclose. No transaction during the year, what gets disclosed is only relationship of control. Only if relationship of control is there, disclose all this. If relationship of significant influence is there, no disclosure. Only when there is a transaction, significant influence will require disclosure. Okay, next. Relationship itself does not exist, but transaction took place. Will you disclose? Not required. We are not related parties, but we are transacting. For example, I'll give you an example of say Virat, Anushka. I don't want to think of another example. Virat and Anushka in Reebok Limited. They are holding 35% shares here. 1st April 2024, we start the year with. 31st March, we are ending the year. There is a continuous transaction between Virat and Reebok. How means? Virat is supplying the raw material to Reebok. During the year, in the month of October 24, Virat and Anushka sell these shares and exit from Reebok. Okay, but they continue to supply raw material from the beginning of the year till the end of the year. From 1st April to 31st March, every month Reebok is purchasing raw material from Virat and Anushka. However, relationship till 1st October, it was there. On 1st October, let's take, they sold the shares and they exit. For this period, whatever purchase of raw material which Reebok does from Virat and Anushka, will that be considered as a related party transaction? Answer is no. If relationship, it's what is the meaning of related party transaction? A transaction that takes place between related parties. So first they should be related. At this time, October, where Reebok and Virat related parties? No. Transaction did not take place between related parties. So this period disclosure not required. Only for this period disclosure is required. Only as long as the relationship exists, disclosure is required. So I hope the concept is clear with it. Final discussion. With this, the standard we are closing out. In certain cases, disclosures are not required. Even though it is related party transaction, disclosures are not required. First, what I gave you exception was They are deemed not to be related parties. Who are all deemed, even though there is a, who are deemed not to be related party? Common directors, significant volume, that is your purchasing or selling significant volume with the person. And third is providers of financial remember. Here they are not related parties itself. What I am discussing now is they are related parties, but I need not disclose. First case, where if I disclose, it is going to affect my confidentiality. Let's take A Limited is, no, I'll take it as bank, okay. SBI is giving loan to X Limited. There is some relationship between SBI and X, let's take, okay. I don't want to get into the type of relationship, but there's a relationship. For SBI, this loan which is given to X Limited, is it a related party transaction? Yes, because I told you SBI and X Limited are related parties. Okay, let's take SBI is having some shareholding in X Limited, okay. Let's take 25% shareholding in X. So are SBI and X Limited related? Yes. So any loan given to X Limited will be a related party transaction. What is a related party transaction? A transaction that takes place between related parties. Are these two related parties? Means yes. So this is an RPT, related party transaction. However, because of some Banking Regulation Act, the banks are not required to tell to whom and all they have given loan. If there is a statute like that and SBI decides not to disclose it, is it okay? Yes. Because accounting standard can't ask you to do anything which statute, it can't contradict with the statute. What will prevail? Wherever statute and AS collide, what will prevail is only the statute. So if statute tells you don't disclose, AS tells okay, follow the statute. I can't do anything about it. There is an example given in the study material where I will go back to Virat and Reebok. I want to go with the same example. Virat is selling raw material to Reebok. Virat is the major supplier for Reebok. Major supplier, okay. Are Virat and Reebok related parties? He is selling raw material and he is the major supplier of raw material. Are they related parties? No. Just because I am selling maximum volume to Reebok does not make me related party. That you should be clear with. Let me give you information next. Let's take Virat is holding 60% shares in Reebok. Is Virat and Reebok related party? Yes. Because of 60% shareholding, he is getting a control relationship. He is related party. Now he is also selling raw material to Reebok. Will this transaction be required to be disclosed? If he sells raw material to Reebok, should you disclose the transaction? Yes. Because first thing, any transaction taking place between related party is a related party transaction and has to be disclosed. Virat and Reebok are related. Virat and Reebok are related, and then there is a transaction happening. Hence, disclosure is required. Okay, but Virat comes out with a request. Virat tells that I do not want people to know that I am associated with you because it affects my popularity. I am a cricket player. I don't want people to know that I'm also dealing in trading. I'm also selling raw material to Reebok. I don't want people to know that. So for maintaining confidentiality that affects my cricket image, I'm requesting Reebok not to show that they are purchasing raw material from Virat. Okay, so Virat tells Reebok, don't show to maintain confidentiality. Will Reebok accept Virat's request? They cannot accept. Why? Because the shelter under confidentiality is given only in terms of statute, regulator, or something competent authority. Just because two parties think that I don't want others to know, then you can't go for this exception. Exemption should be given to you by some law or some regulator. Only then you can. there is a study material question like this, where a person comes and tells, don't disclose because I don't want people to know. In that case, you will tell, no. Maintaining confidentiality should be required only by statute or regulator, only then exemption is given. If this is not the case, there is no exemption given from the disclosure. That's all. This is only more important from an exam viewpoint. These two, I've just covered it, but there's no exam question. Suppose you're preparing consolidated financial statements where you're going to add the balance sheet of, let's take Ranbir Limited and Alia Limited. They are related parties. How means holding subsidiary relationship. So we are going to add these and come to consolidated financial statements. If that is the case, and there are transactions between Ranbir and Alia, have you learned that intergroup transactions, intragroup, should be cancelled out? We've learned it. So in that case, intragroup transactions happening between them need not be disclosed as related parties, because anyway those transactions are cancelled when you arrive at CFS. So for consolidated financial statement, within the group transactions need not be disclosed. Third is state control entity. If a state control entity means an entity that is in which government is having a major control and share. If, let's say, Karnataka government is controlling Nandini, a milk manufacturing company. Okay, milk, it buys and sells, it produces and procures and sells milk. This is a state controlled entity, let's take. And Arvind Limited. Here, let's take Tamil Nadu is having a stake in Arvind Limited. Now there is a transaction between Arvind and Nandini Limited, and they are related parties. In such case, if both are state controlled entity, then they need not show their transactions. So for government, there is a shelter given where government and government entities deal with it. You need not show the related party transaction. No question tested on these two. Only on this question is tested. So are we clear with this? So with this, our standard discussion is through with. What all we have done is, if I have to quickly finish off, first we saw who are related parties. 5 categories have been given. First is control thing, where we captured parent subsidiary relationship and fellow subsidiary. Second is joint venture and associate. Third is any individual who's having control or significant influence either directly or through relative. So person and even relatives covered. Fourth is KMP plus relative. Fifth is an entity that is influenced by C or D will be also related parties. These are the 5 relationships. Next, we will also cover up now who are not deemed to be related parties. First, common directors. 2, significant volume of business. 3, providers of finance, not related parties. Next, we will move to related party transaction. Any transaction that takes place between related parties is called as a related party transaction. Also, note I have given you this thing. Relationship should exist when the transaction happens. When should you disclose in the financial statement is parties are related. If any time during the reporting period, not necessary that the relationship should exist at the balance sheet date, even during the year if they are related, still it will be considered as a related party. Transaction you will disclose only for the period they were related. See, you need to be clear with this. One is relationship and other, that is related party relationship, and other is related party transaction. Related party relationship means during the year, any time they were related, that relationship should be disclosed. But transaction, only as long as the relationship existed, you will disclose the transaction. If the transaction happened when the relationship was not there, I need not talk about the transaction. Okay, now when it comes to disclosure, if it is controlled whether or not transaction happened, that relationship should be disclosed. I'm not talking about RPT. The fact that we are related should be disclosed even if the transaction has not happened. The fact that we are related need not be disclosed if the transaction has not happened. Okay, and this is exemptions. Let's take a break here, and we are meeting after break. Half an hour break we will take up. So let's begin with accounting standard number 11. We will revise off the provisions first quickly. Thereafter, we will look at a few questions to understand the application part. Today's class, mostly we are going to focus on what are the things. Accounting standard, we will go through with the concept of it. Thereafter, we'll finish off a few accounting standards in a row, concept. Then we will do MCQs. So that's why I want to cover the concept part. We will see whether we've understood in MCQ questions. Starting with AS11. Effects of changes in foreign currency rates. So this accounting standard deals with foreign currency rates, the changes in that, what impact it will have in the financials. Regarding that, this standard is discussing. Objective. When transactions are taking place in foreign currency, they need to be converted into rupees. That's the first premise based on which the standard is written, that when you have transactions happening in currency other than rupees, you'll have to convert that into rupees. And when you do this conversion, there are two questions which arise. One, at what rate should we convert? And suppose there is any exchange difference that is arising after we have recognized in the books. This exchange difference, how to record in the books? That's the next question we will answer in this standard. When it comes to foreign currency transactions, entity can enter into such transactions by two ways. One, it directly enters into the transaction where it is purchasing goods or selling goods with a person who is not in India in some other currency. Now, two words you need to be familiar with. One is foreign currency and the other is reporting currency. Foreign currency, first I will start with reporting currency. Reporting currency for an Indian entity would be rupees, in the sense the currency in which you are preparing the financial statements, that currency is called as reporting currency. Any currency other than reporting currency will be called as foreign currency. So a transaction that is not happening in rupees, that will be called as a foreign currency transaction. This foreign currency transaction can arise because of two ways. One, directly the entity is entering into the transaction, or it is entering into the transaction indirectly through its branch or subsidiary which is abroad. So foreign branch or subsidiary, it is entering into the transaction. Scope. Our entire discussion of the accounting standard can be divided into three segments. Unlike in the standards which we have learned so far, where we saw scope is where this standard is not applicable to certain items. For example, PPE, we saw it is not applicable to wasting assets, biological assets. But in AS11, non-applicability, nothing like that is discussed. What we are going to cover, that only is told. So AS11 scope, not important from an exam viewpoint. Just for putting the perspective in place that what order I am going to talk about in the class, I have brought this here. That first we will discuss about transactions which are directly entered by the entity, how to record them. Second, transactions which are entered through foreign operations. Foreign operations means it could either be this entity is having a foreign branch, or it is having a foreign subsidiary, or a foreign joint venture, foreign associate, anything. Transactions that it is entering into through any other intermediary will be discussed second part, and third part is accounting of forward exchange contracts. This is the scope of AS11 which we will discuss. Starting with definition. So we've gone through an objective of the standard, scope, and now we are coming to the definitions part. Under definition, foreign currency transaction, what does it mean? Any transaction that is denominated in foreign currency, or it requires to settle in foreign currency. So that the transaction itself is denominated, which means the price of the transaction is fixed not in rupee terms but in some other currency, or even if it is fixed in rupee terms, you will have to make the settlement in some other currency, let's take dollar terms, then that transaction is called as foreign currency transaction. This definition not yet tested in the exam, but I think you need to understand the word foreign currency for a better perspective. Next, the definition, pretty important, is classifying the assets and liabilities into monetary and non-monetary items. What does monetary item mean? Monetary item means money held. When I tell money held, it means cash and cash equivalents, or it is assets receivable in terms of money, or liabilities payable in terms of money. I will quickly explain of the meaning of this. Monetary item specifically means there is a money involvement in this. When I tell money involvement, one, you are holding the money as such, money held, which means cash in hand, cash in bank will fall part of money held. Or it could mean asset and liability, which is receivable in terms of cash or payable in terms of cash. And this cash that you're going to receive or pay can be it can be determined in fixed or fixed terms of money. You can exactly determine how much you're going to receive or how much you're going to pay. Looking at examples, trade receivables, loan given. These are examples of assets that are receivable in terms of money. Where in trade receivable, if I tell debtor 1 lakh rupees, I am expecting to receive this money in terms of rupees only. And I can clearly tell that this is the amount I will receive. There's no doubt on the number. So one, you should receive it in terms of money. Second, there should be no doubt on the number. Loan given. These are the examples for assets receivable. Liabilities payable. Examples will be debentures, bank loan, trade payables. These are the examples for liability payable in terms of money. Non-monetary item. Any item other than any item other than monetary item will be called as non-monetary item. In the sense, any asset which is receivable in kind or payable in kind will be called as non-monetary item. Examples for this: fixed assets. You have an asset, it is not receivable in cash, you're going to get benefits by using the asset. Or suppose you have inventory, you're going to you know that you have inventory, but this inventory is going to fetch you money, but you do not know what exactly it's going to fetch. Inventory as on balance sheet date is not receivable in cash. Only when you make the sale, cash is receivable. Hence, inventory cannot be classified as monetary item. It will only be classified as non-monetary item. As on balance sheet date, this inventory, if I show 1 lakh rupees, it does not mean I'm going to receive cash from someone to the extent of 1 lakh. Receipt of cash right will be established only after you have sold the inventory. So it is a non-monetary item. Okay, so the first discussion is between monetary and non-monetary bifurcation. Next, so looking at illustration 1, classify the items as monetary or non-monetary. Inventories, just now I told it is only non-monetary. Trade receivables is monetary. Investment in shares. Are you going to receive, investment in equity shares will be considered as non-monetary only, because you do not know the exact amount which you will receive right now, and the intention of holding it is not with the view of sell, but to earn income out of it. That also we can take it. Property, plant and equipment is a non-monetary item. So this is about monetary, non-monetary discussion. Okay, having understood the distinction between monetary and non-monetary, next we are entering into the three segments which we had laid down. First, transactions which the entity is directly entering. Second, transactions which it is entering through foreign operation. And third is forward exchange contracts. Starting with directly entered by the entity. We are going to discuss it in the following way. First, recognition. When can we recognize the transaction? We will recognize it on the date of the transaction. Nothing very different about this provision. Any transaction is recorded on the date when the transaction happens. The main focus is on the measurement criteria only. Measurement. How do you measure a foreign currency transaction? Measurement, we will divide the discussion into two. First is the initial measurement and the next is the subsequent measurement. Initially, how will you measure the transaction? Means we will measure it using the rate that is prevailing on the date of the transaction. Rate prevailing on the date of the transaction. I repeat that. Here, we do not check whether this item is a monetary or a non-monetary. Classification is not at all relevant. All the transactions will be converted into rupee terms using the rate on the date of the transaction. Subsequent measurement. Subsequently means on every balance sheet date. Once is initial recognized in the books, on every balance sheet date, we will be subsequently remeasuring the item. But we will remeasure only monetary and non-monetary items, which means anything which results in asset and liability only will be remeasured on the balance sheet date. Here the classification is relevant because based on the classification we will decide what rate to be used. Suppose the item is a monetary item. What is monetary item? Money held, assets receivable in cash or payable in cash, that is liabilities payable in cash. Such an item will be called as monetary item. This monetary item should be restated on every balance sheet date. When I tell restated on every balance sheet date means I will be measuring that item at the closing rate that is prevailing on the balance sheet date. So we are going to remeasure the item using the closing rate. For non-monetary item, we will generally not restate the item, not restate or remeasure the item on every balance sheet date. We will continue to carry the item at the price at which we had initially measured it and not restate it on every balance sheet date, general rule. However, to give clarity, the standard tells that it depends more on the model which you are following for that item. Suppose you are following historical cost model, you will not remeasure that item on any subsequent date. Whatever is initially recognized is recognized. Do not go back and change the number. However, if you are following the fair value method of valuing that item, or you are valuing it at NRV, then you will take the rate that is prevailing on the date of that fair value or date of NRV. Now, which items can go under this fair value of NRV? Let me just give you some examples. Suppose there is a fixed asset. There is an option given by AS10. Either you can fall under cost model or you can fall under reval model. Suppose you fall under cost model, you will not be remeasuring the item on every balance sheet date. But if you fall under the reval model, then you will be remeasuring the item on every balance sheet. You will check for the fair value on every balance sheet date. Whichever dates fair value you adopt, that date's rate should be used. So rate prevailing on the date of revaluation. Suppose it is inventory. You have to do a comparison between cost price and NRV, whichever is lower. Suppose by doing this, your answer comes that inventory will be measured at cost. In that case, what will be the rate you take to, will there be a remeasurement at all? No remeasurement because you're going as per the cost model. Suppose you're doing cost versus NRV, whichever is lower, and you're getting the answer, stock will be valued at NRV, then you will take the rate to be on the date of valuation. Okay, so these are the examples for non-monetary item for historical cost, non-monetary item which can be valued at fair value or NRV. So this is about the subsequent measurement. Now, when you do subsequent measurement, that time, suppose you are required to remeasure the item. Let's go back and see which are the items which can be remeasured on the balance sheet date. Monetary item, will it be remeasured on balance sheet date? Yes. Non-monetary item, historical cost, will it be remeasured on balance sheet date? No. Non-monetary item at fair value, will it be remeasured? Yes, on the date of valuation. The rate on the date of valuation. Suppose you have initially measured an item at one rate. Initially measured at one rate, rupees 42 per dollar. I'll take it as 62 per dollar. And subsequently, you are remeasuring the item at rupees 65. Then there is a change in the value of that asset. For example, we have measured, I will take an example of a liability. Loan we have borrowed is $10,000. $10,000. Initially, when we recognize this item in the balance sheet, we use 62 as the rate per dollar. So we have recognized the liability as 6,20,000. Subsequently, on every balance sheet date, we'll have to remeasure this loan. Why? Because it is a monetary item. Monetary item means what? Liability that is payable in terms of cash, fixed or determinable amounts of cash. So this has to be revalued. When I revaluate, that time the rate prevailing is 65. So this loan will get revalued at 6,50,000. By doing this, my liability value has increased. Liability value has increased from 620 to 6,50,000. So there is an increase, and this is my new liability value. How much is the increase? By 30,000 rupees it is increased. Let us try passing a journal entry for this. To liability account, to increase the liability, I'll have to credit the liability account. Corresponding debit, we will take it as a loss in the books, and that loss will be called as exchange loss. So whenever you record in one date, but you are remeasuring at another rate, that time there is an exchange difference which will arise. First case. Second case, we have remeasured this liability. We have remeasured this liability at 6,50,000. This is the balance sheet date. We have remeasured this liability at 6,50,000. So right now the liability in the books is 6,50,000. Next year, after 2 months, we are repaying the liability. When we repay the liability, let's take the dollar rate has become 64. Now let us pass the journal entry for repayment of liability. Loan account will be debited to bank account. In our books, what is the loan amount? 6,50,000. Whereas how much are we paying money? 6,40,000. There is a difference of 10,000 rupees. This 10,000 is a gain for us because we expected to pay 6,50,000, but exchange fluctuations has resulted in us paying only 6,40,000. So 10,000 will be taken as exchange gain. This exchange gain will be transferred to the P&L account in the year in which it is recorded in the books. So exchange difference can arise because of three situations. Transactions were initially recorded at one rate but settled on at another rate. So initially I recorded at 6 lakh rupees, but I settled this at 6,40,000. In that case, there is an exchange difference. Second, you initially recorded at one rate, but you subsequently remeasured at another rate. This is where we discuss 6 lakh we initially recognized. On every balance sheet date, we'll have to remeasure monetary items. We remeasure at, let's take 6,50,000. This increase, this change is nothing but an exchange difference. Or you subsequently remeasure at another rate and settled at another rate. So these are the three reasons why exchange difference can arise. Next, whatever exchange difference that arises, that will be recognized as a gain or loss in the P&L statement in the year in which it occurs. There is no other treatment but to take it to P&L in the year in which it happens. So this is about exchange difference recognition and measurement principle. Measurement is the difference you will find out between the rates and find out how much is the exchange gain or loss and then take it to P&L. Okay, are we clear so far? Okay, let's read one question and just see whether we are able to understand the provisions which we have listened so far. Karma Limited, an Indian company, has the following foreign currency transactions during the year. It imported, on 1st July, it imported goods from Tri Limited, a German-based company amounting to 30,96,000. Next transaction. I will read the entire question, but first we will see what is required from us to show the value at which above items will appear in the balance sheet as on 31st March 23 to calculate the exchange gain or loss on the above transactions. Okay, now let's continue reading. So first is importing goods at 30,96,000. Second, on 1st October, it imported plant and machinery, a German-based company. The amount was paid on the date of import itself. So this is immediate payment. There is no later we are paying. It's immediate payment on the date of import itself. Exported goods on credit to Cream Limited, a German-based company amounting to 50,40,000. All the above transactions were recorded in the books at the prevailing exchange rate on the date of transactions. Initial measurement happens at what value? At the rate prevailing on the date of the transaction. Subsequent measurement happens at what value? That depends on whether it is monetary or non-monetary item. Monetary item happens at what value? At the closing rate. Non-monetary depends on whether it is historical cost or fair value. Historical cost, no remeasurement, fair value on the date of valuation. With that, again, provisions revised. We will now go through the exchange rates. 1st July, they give you one rate, 1st October, December, and 31st March. This is the closing rate given to us. You are required as per AS 11 to show at what value these transactions will appear in the balance sheet on 31st March and calculate the gain or loss. We will just go over the solution instead of working it out. We will just go through the solution. First thing required is we have to find out only the value of items on the balance sheet date. This question, whenever you read a question, in your mind you should run through, are you doing this question on initial measurement or on subsequent measurement? Answer is subsequent measurement. So having understood subsequent measurement, you will have to write down the relevant provisions as subsequent measurement of the transactions of foreign currency transactions depends on whether the item is a monetary item or a non-monetary item. Monetary items should be remeasured on the balance sheet date using the closing rate prevailing on the balance sheet date. After having written this, we will start showing the workings. I have not written the provisions. I just told what provisions are applicable. First transaction is about the Tri Limited. We imported the goods on 1st July. So when we recorded the transaction, they're telling us in rupee terms, okay, 30,96,000. Can we also have that first? Okay. So initially when we measured it, recognized it, at that time, we would have recognized it at 30,96,000 in rupee terms. Can you find out how much is it in dollar terms now? 30,96,000 is in rupee. That time the dollar rate prevailing is 1 euro is 86. So 30,96,000 divided by 86 comes to 36,000 pounds. Euro. It's euro. So 36,000 euro. 36,000 euro is the transaction amount involvement. Remeasure this on the balance sheet date. What will be the value of this on the balance sheet date at the closing date? Which means this into 90, if you do, you will get 32,40,000. Initially, we recognize this at 30,96,000. Now we are going to remeasure at 32,40,000. This has resulted in increase of liability or decrease of liability. Answer is increase in the liability. So increase in liability is 1,44,000. This is an exchange loss because if liability increases, it is going to be a loss for us. So this is resulted in an exchange loss. This is the first part done. We have remeasured on the balance sheet date. Next, we are importing plant and machinery. That's the next transaction. Initially, we recognize this at what value? 18,500 is a euro. We imported this on 1st October. So on 1st October, 88 euro is the prevailing rate. 18,500 into 88, 16,28,000. This is the value at which we initially recognized. Are we going to restate this on the balance sheet date? No, because any plant and machinery is a non-monetary item which will not be restated on the balance sheet date. That provision needs to be written that it is a non-monetary item and it will be shown at, and it is getting shown at historical cost is the assumption. So anything that is shown at historical cost need not be remeasured on the balance sheet date. So plant and machinery will continue to be shown even on the balance sheet date at 16,28,000 at which it was initially recognized. This is the way you should present the answer. Next, suppose your the next transaction is you have exported the goods to Cream Limited. So this is resulting in an asset, and the asset is in the form of a trade receivable. Trade receivable number is given as 50,48,000 as on the as at the date of the transaction. They have given not in euro terms but in rupee terms. Can we find out how much of euro is involved? 50,40,000. The date of the transaction is 1st December. 50,40,000 divided by 84 comes to 60,000 euro. So 60,000 euro restated at the closing rate, which is 90. So 50,40,000 initially data recognized, remeasured at 54 lakhs. So there is an increase in the receivable by 3,60,000. Increase in any asset results in a gain. So this is an exchange gain. So what have we done? We have tried to remeasure the items, and finally in the end, please present your conclusion clearly that foreign, okay, I have written the provision in the end that it should be remeasured. It is your choice. I started with the calculation. Based on the calculation, I decided what provision is applicable and then I wrote it below. You can write it in the first ideally, if not at the end also. But finally, I should see this conclusion clearly shown. The question tells you, tell us what value appears in the balance sheet. So I have shown what value appears in the balance sheet. Next, it asks me what is the exchange gain or loss. I clearly present that this is the exchange gain or loss. It is very important to conclude with what is exactly required in the question. Tabulated or listed one below the other should be the presentation of answer. Okay, so this is a question on remeasurement of foreign currency transaction. We will enter into the next discussion. We are going to talk about a specific transaction which is a foreign currency loan that you have taken for acquiring a fixed asset. A foreign currency loan taken for acquiring a fixed asset. Generally, any exchange difference on a loan should be charged to P&L. No change in that. And why does exchange difference arise? Because of three reasons. Can we recollect back what are the three reasons why exchange difference can arise? You initially recorded at one rate, but you settled at another rate. Or you initially recorded at one rate and subsequently remeasured at another rate. Third, You initially you subsequently remeasured at one rate and later settled at another rate. These are the three reasons why exchange difference can arise. Suppose you're dealing with a loan that has been used to acquire a fixed asset. In that case, there is an exception to the rule. What rule exception I'm carving out? That exchange difference, what is the usual treatment? Debited to P&L. But in some cases, you need not debit to P&L. Should not be done. Instead of taking to P&L, you are going to get the option of capitalizing the differences. Capitalizing the gain or loss on exchange differences. This is given as para 46 of AS 11. In this paragraph, it tells you that you may not debit the exchange difference that arises on a foreign currency loan that has been taken for acquisition of a fixed asset. Please go listen to what are the situations that are given, or what is the application part of. Now I can. Okay. AS 11 is giving the entity an option. Please note, I am talking about a loan that is taken in foreign currency for acquiring a fixed asset. For that, exchange difference that is arising on this loan, the standard gives you an option. Either you charge it to P&L statement in the year in which the difference arises, in the year in which exchange gain or loss arises, or there is another option. Now this para 46A is an option given by the AS 11. This option, once you exercise it, there is no way backing out of it. You should continue year after year. I have to talk about the option, but first I will explain the premises of the option. What are the conditions applicable for this para 46A? First condition is, once you exercise, continue year after year. Second, say you purchased a fixed asset in 2020. That time you have you did not exercise 46A. You have been charging off exchange gain or loss to P&L year in the year in which the exchange gain or loss arises. In 2024, you have decided to apply 46A. Can you do it like that, or you should decide on the option at the time you purchase the asset? Answer is, you can do any time you want. Not necessary that you should decide it at the time of purchase. But if you decided later, say 2024, should you go back retrospectively and make the change, or from this year onwards you will change the treatment of exchange difference? Answer is, it should be applied prospectively. So once you apply the option, you follow it year after year, and it should be applied prospectively. To which items is this option applicable? To any long-term foreign currency monetary items. I will have to explain this word in some time. I will come back. This option should be applied to all long-term foreign currency monetary items. You cannot selectively choose which item to apply, which item not to apply. If you apply to all the monetary items which are long-term in nature, this option should be applied. To short-term, it is not applicable. Now I am left with explaining what is this LTFCMI. What does this mean? It is a monetary, first of all, we are talking only about monetary items. When I tell monetary items means what? It is money held, asset, cash and cash equivalent, asset that is receivable in cash, or liability which is payable in cash. In our study material, we will be looking at examples where asset receivable in cash, they will tell you examples as trade receivable, or liability payable in cash, they will tell you example as some loan. Generally only these two. So this loan is a foreign currency loan, and that loan has to be long term. We are only going to discuss initially from the viewpoint of a liability, a foreign currency loan that has been taken. So foreign currency loan means, what are the criteria in your mind you should think of? First, it is a loan item which is long term in nature. Second, it is in foreign currency. And third, yeah, a loan that is monetary item I told you. So first, it is a monetary item which is long term and it is in foreign currency. For this, what is the accounting treatment we have to understand? Suppose that loan is taken. Now we are going to talk on the purpose of the loan. What did I tell initially? Option 46A is applicable to long-term foreign currency monetary item, which means it is applicable to a monetary item which is long-term and foreign currency. It should be in foreign currency. It is applicable to a loan. Let's take a loan example. Loan, we need to check what is the purpose of having this loan. Have you taken the loan for depreciable asset acquisition, that is for acquisition of a fixed asset, or have you taken the loan for any purpose other than acquiring a fixed asset? Suppose you have taken the loan for acquisition of a depreciable asset, that is fixed asset, then what is the treatment of exchange difference? I'm going to explain. Repeating the provision clearly. So we are dividing the entire discussion of LTFCMI based on the purpose of having that monetary item. Suppose that item is for acquiring a depreciable asset, then the exchange difference that arises should be added to or deducted from the cost of the depreciable asset. It will not be charged to P&L. It will be added to the cost of the asset. What will be added to the cost of the asset? The exchange gain or loss that arises by restating that monetary item on the balance sheet date or on the settlement date. That should be adjusted with the depreciable asset cost. You are not going to charge it off to P&L. So what is the general treatment of exchange difference? Charge off to P&L. Exception of para 46A tells that don't charge it to P&L. You will add it or deduct it from the cost of the asset. This is if the loan relates to a depreciable asset. Suppose the loan does not relate to a depreciable asset, any other purpose other than depreciable asset, then the treatment of exchange difference we will go through. What is the usual treatment of exchange difference? Debited to P&L. But under para 46A, they give you an option. There's only an option. If the entity wants only, it will avail this. The option is you will not take it to P&L, but you will keep it in a separate account called FCMITD account, which is foreign currency monetary item translation difference account. The name is pretty long. There are two terms which we have come across here. First, LTFCMI. This is the first terminology. These are all not acceptable short forms. You have to write the term in full. Long-term foreign currency monetary item. Next, FCMITD. Foreign currency monetary item translation difference. We are removing LT out. FCMI, for that a translation difference account we are creating. What is translation difference? Nothing but exchange difference. They don't call it as exchange difference, they're calling it as translation difference account. So this exchange difference will be kept in a separate account, and that account will be shown under reserves and surplus, amortized over the life of the asset, which means every year a portion of this FCMITD account will be written off to P&L. You're not taking the entire amount straight debit to P&L, but you're splitting it and moving it into P&L in portions. This is about the loan that is taken for the purpose of either depreciable asset or not depreciable asset. What is the accounting treatment? We will look at a question and then continue in the last part of the discussion. Let's read May 2025 RTP question. This question is, okay, we will first read the question and see what the question asks us. Then I will explain about the procedure in which we will approach it. Legal Limited is engaged in the manufacturing of rubber. For its plant, it requires machineries of latest technology. It usually resorts to long-term foreign currency borrowings. The moment we see long-term foreign currency borrowings, what should come to our mind? Long-term foreign currency monetary item. If you are coming across any LTFCMI, you will check what is the purpose of this monetary item, whether it is for acquisition of a depreciable asset or any other purpose. If it is acquisition of depreciable asset, you will check whether the entity has gone in for the option 46A or it decided not to avail 46A. You will have to check whether it is applied the option. Let's continue reading. On 1st April, it borrowed this loan of 1 million from some fund when exchange rate was 63 rupees per dollar. Funds were used for acquiring machine on the same date to be used in 3 different plants. Useful life is 10 years and their residual value is 30 lakhs. So this is the loan amount borrowed. The rate 63 rupees. Earlier also company used to purchase these machineries out of foreign borrowings. Exchange difference that time was not capitalized but charged off to P&L. So earlier also they had such loans but they never have capitalized it. They have only charged it off to P&L. So is that very clear in your mind? Exchange difference, what is the treatment of it? Debit to P&L. But exception, now we are going to look at it. What now the legal limited is deciding. For this purchase of machinery, legal limited is interested to avail that option of capitalizing the difference to cost of the asset. So it wants to avail para 46A. Exchange rate prevailing on the last date of the year is 62 rupees. So this is the closing rate. The rate at which you enter into the transaction is 63 rupees. So from 63, it has become 62. The loan was recorded at 63. Now, subsequently, we are going to remeasure at 62. It is not having any old borrowings except for this. Comment whether legal limited can capitalize. First, it asks you, can it capitalize? And if it can capitalize, find out what is the depreciation amount of the machineries. So we have to tell whether it can avail para 46A option first. Such a question is not there in the study material where they ask you on writing about para 46A option. We have to write about the option, about its applicability. First point, before we discuss, what are the points we saw for 46A para 46A option? First point, I will also have the notes in front of you because we have to learn what provisions should be written, relevant provisions, what are the relevant provisions. Even that your mind should be able to think through. Yeah, these are the provisions for 46A option. 1, it is only an option. Once you exercise, continue year after year. You will apply it prospectively, and if applied, you should apply to all the LTFCMI. Okay, this is the provision. Now, what is relevant for this question? We will now see the solution. Solution. Yeah. First, for para 46A is an option given to the entity. Once it is exercised, entity should continue with the same year after year. In the given case, though legal limited has not earlier exercised the option, it can avail the option now to capitalize the exchange differences. The question which legal limited has is, till now I did not do it for my other loan items. Can I do it from now onwards? Yes, you can do it. And if you do it, you will be applying it prospectively only. That also should be written. I missed writing it. This option once away should be applied prospectively. Next, entity cannot apply this option only for selected LTFCMI. If it applies, it has to apply for all of them. However, in the given case, legal limit, it does not have any other earlier long-term foreign currency borrowing. So it is not required to apply this option to the earlier borrowing. Only for the borrowing which is right now it is going to enter into, if it applies, it is sufficient. Treatment of exchange difference. Now I'm getting into the measurement criteria. First is whether we can avail the option we have answered. Next is we will find out what is the exchange difference that arises. Can you calculate what is the exchange difference that arises on this loan? 63 rupees we capitalized. We brought the loan into our books. Right now the loan value is, the exchange rate is 62. So 1 rupee is it is falling down. 1 rupee into how many? 1 million. So 1 into 1 million will be rupee 1 million. This is the decrease in the loan liability. Any decrease in loan liability will result in an exchange gain. Now coming to the accounting treatment. Normally any exchange gain or loss arising, what is the accounting treatment? It will be charged off to P&L. However, if option 46A is availed for a loan that has been taken, see the provision is given here. If a long-term foreign currency loan is taken for acquisition of a depreciable asset, then that exchange difference can be added to or deducted from the cost of the asset. Hence, the calculation wise, cost of the asset capitalized is 63 million. Exchange gain to be deducted from here is 1 million. So the revised cost is now 62 million. The question does not ask us only exchange difference. It tells us find out what is the depreciation on the machineries as on 31st March. So we'll have to close out the answer with that. What is the date of purchase of the asset? 1st April 23 we purchased the asset. The date we are in right now is 31st March 2024. 1 year is already over. Depreciation for this year is already charged. Done. Now, on this date, the cost is revised. What is on this date the cost is revised? We have to be charging depreciation for this year. Okay. So how do we charge depreciation? Revised cost of 62 minus residual value of 3 divided by current year depreciation we are charging. What is the useful life of the asset? 10 years. So if we calculate depreciation, it comes to 5.90. This is the carrying amount of the asset as on the balance sheet date. So when we are charging depreciation at the end of the year, the cost has undergone a change. So we'll apply or we will calculate depreciation using the revised cost. Okay, so this provision we are through with. Now let's move to the question where you are going to have a loan for acquisition of an asset which is not a depreciable asset. So you're going to, if it is not a depreciable asset, you will take the foreign currency differences, foreign exchange differences to FCMITD account. That model we will just go over a question. Looking at illustration 9 question, A Limited has borrowed $10,000 in foreign currency at 5% per annum. Annual interest, 5% annual interest, and acquired a depreciable asset. The exchange rates are given. This is the rate on the date of transaction. And this is the closing rate. This is the closing rate. We're asked to pass the journal entries in the following cases. Option 46A not availed, 46A is availed, and something else. If 46A is not availed, what is the treatment of exchange difference? Debit to P&L. Let us first find out what is the exchange difference that arises on this loan. 10,000 US dollars. We initially recorded at 48. So 4,80,000 is the initial measurement. Subsequently, we will have to remeasure this on balance sheet date because it is a monetary item. And since this is a long-term foreign currency monetary item, 46A option can be availed, but first we are working on where it is not availed. So the 5,10,000, there is an increase in the liability by 30,000 rupees. This 30,000 is a exchange loss. Okay, working wise we have done. Next, we will pass the journal entries. First entry for receipt of the loan. What will be the entry for receipt of loan? Bank account debit to the loan account. Bank account to foreign currency loan account. Next will be for the payment of interest. Payment of interest. Let us calculate the interest. On what number are we going to calculate interest? On the rupee terms or in dollar terms? Remember, dollar terms, because the person who has given the loan will charge us interest on what dollar he has given. $10,000 into 5% comes to $500. That $500 should be converted to rupees using the closing rate, which is 51. So the interest that you calculate comes to 25,500. What is the journal entry for interest? Interest account debit to bank account. But we generally don't use the word interest. We write it as finance cost account debit to bank account. Finance cost to bank. Next, we have to restate. Have we repaid the loan before the balance sheet date? No. Balance sheet date, the loan prevails. So we'll have to restate the loan on the balance sheet date. To restate it, 30,000 is the exchange loss. We just calculated. Hence, exchange loss, what is the treatment we are going to do? Charge it off to P&L. The entry will be P&L account debit to loan account. On one side, loan liability increases. On the other side, it is resulting in a loss. So the journal entry will be foreign exchange difference account they are taken. Either you take it like this or we can write P&L also. Even material tells that P&L is okay. P&L to loan account. This is if the option is not availed. If the option is availed, the first entry is going to be the same. Second entry is going to be the same. Third entry, you will not take the exchange difference to P&L, but to which account are you going to take it to? No, you have taken this loan for the purpose of a depreciable asset. So if it is depreciable asset, what is the treatment of exchange difference? FCMI TD will go if it is non-depreciable, if it is purpose other than depreciable asset. If it is depreciable asset, you will add it or deduct it from the cost of the asset. Okay, so you are going to take it to this. Now, how the journal entries are passed, I will just go over it. First entry, second entry are the same, no change in that. Only the third entry, remeasurement entry, I'm going to explain now. First entry is to bring the exchange difference account. So we're going to write exchange difference account debit to loan account. We are increasing the liability in the books by way of because of exchange difference. This is done. Next entry ideally should be P&L to exchange difference account, but we are not going to transfer to P&L. We are going to take it to PPE account. So the next entry will be PPE to exchange difference. Either you do it like this or you do a combined entry. Both are okay, but preferable, I would say this is a better way of doing it, because first you're showing that you're increasing the loan amount. Next, you're telling that this difference is getting transferred to PPE account. So better to show it as two separate entries. Last one. This loan was taken not for acquisition of a depreciable asset, but to finance the operations of the entity. If it is taken for a purpose other than depreciable asset, then the exchange difference should be taken to an account called FCMITD account. Now we will go over the entry. First entry, second entry, same. Third entry will be, first we will pass the entry for exchange difference account debit. It's not clearly right. Exchange difference to loan account. We are increasing the foreign currency loan because of the increase in liability. Next, the exchange difference, we will write to exchange difference, and correspondingly we will debit FCMITD account. Is that the entry given in the material? Yes. First is to bring the exchange difference. Second is transferring the exchange difference. Okay, I hope with this the accounting treatment of exchange difference is clear in your mind. Most of the questions asked are from this area only. When I tell area, I told that we are going to start the discussion. We are going to divide the discussion of the accounting standard into 3 parts. First is directly entered. Direct transactions directly entered by the entity. Second is through foreign operation. Third is forward exchange contracts. Most of the questions come only from directly entered in the exam. Forward exchange, there is no track record of being asked in the exam. Okay, but I will anyway take it through in the next. Foreign operations, which means transactions that are entered into through foreign branches or foreign subsidiaries. For this, the discussion is already there in branch accounts, where you learn how to translate a trial balance from foreign currency into rupee terms. That kind of questions only can come. They do not ask you an AS11 question from this area. If they ask you, they will place it in branch accounts only. So I am not bringing it as part of discussion here because it is learned under branch accounts. But under branch accounts also, for if you see a trial balance, yeah, there is a study material question. We will just quickly go over the question. Illustration 7. So whoever are sitting at home, please ensure you open your study material and directly look through your material itself. I will open illustration 7 now. Illustration 7 talks about a foreign operation, that is a foreign branch, and they're giving you a trial balance to translate it into from pound into rupee terms. They give you closing stock is some extra, closing stock is 700 pound, depreciation to be charged on machinery so much, prepare trial balance after converting it into rupee terms. So let's start with the trial balance. Machine 5,000. I will directly show here. We will remove this from the screen. Yeah, machinery. Machinery, what kind of item it is? Monetary or non-monetary? Non-monetary. Under non-monetary, this is under historical cost. So what is the rate at which you are going to convert the pound into rupees? Rate that is prevailing on the date of the transaction. You're going to convert machinery at the rate prevailing on the date of the transaction. Debtors. What is debtors? Monetary item. Monetary item at what? How will you remeasure monetary item? At the closing rate. Opening stock. Opening stock will be, is it a monetary or non-monetary item? Non-monetary item. It is carried at historical cost because they don't tell you that they are valuing it at NRV. So historical cost. If it is historical cost, what value? Initially, whatever recognized, which is the opening rate. You're not going to change the rate. It will be whatever is there in the books. That time you'll run the opening rate. Goods received from head office. Actuals. Because you will have it in the HO books, branch account will be maintained. You will be able to find out this number actually. Sales. Any expense or income item should be translated using the average rate. Okay, that I did not tell. Any expense or income item should be translated using the average rate. Cash. It is monetary or non-monetary? Monetary. So use the closing rate. Remittance to HO. Actuals will be there because HO will maintain records of this. So we will take the actuals itself. HO account also, the actuals will be there. So we will take it. Creditors. Monetary or non-monetary? Monetary. So it is closing rate. You're going to restate all the monetary items at the closing rate. That's it. With this, you will try to balance the trial balance. Whatever balancing figure you get will be the exchange difference. Closing stock will be valued at the closing rate. the rate on the date of transaction. Closing stock, the valuation is done on the balance sheet date, so you will take the closing rate only for closing stock. For opening stock, opening rate, closing stock, closing rate. That's all. You remember that way. Depreciation, you will just apply the rate on the rupee terms. You have the fixed assets at rupee terms. On this, you apply the depreciation percentage and get it. 10% on the rupee, you will get 30,500. Okay. Last part of the standard now, which is forward exchange contracts. There's a lot told in the accounting standard regarding forward exchange contracts, but what is there for us studying is very, very limited at inter level. You will learn it in detail only at final level. So I'm not going to cover forward contracts in detail. I'm just covering the limited viewpoint of the examination. What is a forward contract? Forward contract is an agreement where you decide to exchange different currencies, where I'm going to enter into an agreement with Mr. Ram, telling Ram that on a future date, right now the date is August, I tell him that 3 months later, it is September, October, November. In November, let's say on 30th November, I will come to you and I will sell you $10,000. You give me rupees that time. So we are contracting to sell foreign currencies or some other different, some currency at a specified future date and at a predetermined rate. Now itself, let us fix the amount is what I'm telling Ram. If you fix it later, that is nothing but that does not form part of forward exchange contract. You are deciding now that you will sell $10,000 3 months later at 70 rupees per dollar. That rate is fixed. In that case, we tell that it is a forward exchange contract. Or you can decide to buy dollars. Instead of selling, you can decide to buy dollars at 70 rupees per dollar on 30th November, fixed. So that's why the word is not agreement to buy currency or sell currency, it is exchange, which means it's covering both purchase or sale of the currency. Why should you enter into forward exchange contract? Because you want to guard yourself against fluctuation risks. I do not want an uncertainty as to how much I'll have to pay 3 months later for purchasing dollars. So I'm removing that uncertainty by fixing an amount of 70 rupees. So now I'm clear that I'll have to pay only 70 rupees. I don't want any uncertainty about that. Or it can also be for trading or speculation purposes. There are two terminologies to start off with to know. One is the spot rate, other is the forward rate. Spot rate means the rate, exchange rate that is prevailing at the inception of the contract. Inception means the day you're entering into the contract, what is the exchange rate? That is called as spot rate. Forward rate means the rate at which you're going to settle the contract. So this is the rate at the inception of the contract. And this is the rate at the time of settlement of the contract. When you settle, that is the rate that is agreed upon to buy the currency at a future date. Difference between forward and spot rate will be called as premium or discount at inception of the contract. A forward contract accounting treatment depends on the purpose of the contract, whether you're taking it for own purpose or you're taking it for speculation purpose. Suppose you're taking it for own purpose. In that case, the treatment of premium or discount at the inception of the contract is you will not debit it to P&L entirely, you will amortize it over the useful or over the life of the contract. This alone, there is an illustration question in the study material. You will have to find out what is the premium or discount at inception of the contract and then tell that it has to be amortized over the life of the contract. Let us look at the illustration question. Illustration number 4. Please move to illustration number 4. Rao Limited purchased a plant for 1 lakh US dollars payable after 3 months. Company entered into a forward contract for 3 months at 49.5 per dollar. Why is it entering the contract? Because it has to repay the money after 3 months. There is a payable after 3 months. Is it entering for speculation purpose? No. If it is not speculation, you will take that this forward contract is for own purpose. So first, on reading the question, you should understand what is the purpose of entering into the forward contract. Having understood the purpose, now the exchange rates are given to you. First exchange rate given to you is 49.5, 49.15, and another exchange rate given is 48.85. For a forward contract, two things are relevant. One, what is the spot rate? And two, what is the forward rate? What is the spot rate here? 48.85. Spot rate means the rate prevailing at the date you enter the contract. 49.15. This is the rate which you're going to settle the contract. Let us find out the difference. 48.85 minus 49.15. This 0.3 per dollar, 0.3. This into 1 lakh dollars comes to 30,000 rupees. Able to understand the calculation of 30,000. Next, whether this is a premium or a discount, which means is it a loss or a gain, we need to decide now. Why are we entering the contract? To buy dollars or to sell dollars? We are entering the contract because we have to pay 1 lakh dollars after 3 months. So I'll have to purchase the dollar from someone and then pay it to my supplier. So this contract is entered to purchase dollars. I had entered into the contract. That time, what was the spot rate? 48.85. Now, the forward rate, that is, I'm contracting to purchase the dollar at 49.15. So, I'm expecting to pay more on account of forward contract. So, this difference between spot rate and forward rate is a loss or a gain for us. It's a loss because we are contracting at a rate more than the rate which is prevailing at the time the contract was entered into. So at spot date itself, that is at the time of entering the contract itself, I know that I will pay an extra of 30,000 rupees in rupee terms. It is a loss. Any losses should be amortized. Now here this is a loss. This loss will not be debited to PL immediately. It will be amortized over the life of the contract. What is the life of the contract? 3 months. So for 3 months means per month 10,000 has to be amortized. For this, we entered into this at 1st February. So February, March falls in this accounting year. The other month falls in the next accounting year. So for this accounting year, 20,000 will be charged to P&L, 10,000 will be charged in the next year. That's all. This is a forward contract taken for own purpose. Now we will move to speculation purpose. Suppose you're taking the contract for speculation purpose. This gain or loss at inception need not be recognized. So that calculation itself is not there. For own purpose, you will have to recognize it. But for trading purposes, you need not recognize it. We have to remeasure the contract on every balance sheet date. When you remeasure, there will be a gain or loss which will arise because you would have recognized the contract at one rate and you will remeasure on another rate. How do we calculate the gain or loss? Forward rate that is available. Anyway, it is the difference between the spot rate and the closing rate. Closing rate means the rate on the rate of balance sheet. You will find out the difference between these two and take it as gain or loss as on the balance sheet date. We will take up an illustration. There's one in the material. Illustration 5. a forward contract for 3 months, $1 lakh. When you enter the contract, 47.1. This is the spot rate at which we entered the contract. No. The AA bought a forward contract at this 47.1. So 47.1 is the contracted rate that I'm going to, this is the rate which is agreed upon. When the exchange rate was 47.02, which means this is the spot rate. On 31st December, when he closed his books, exchange rate was 47.15. So this is the closing rate. On 31st January, he decided to sell the contract at $47.18. Show how the profits will be recognized from the contract. Now here, he's going to sell the contract itself. So this contract is entered into for speculation purpose. In case of any speculation contract, the contract should be restated on every balance sheet date. And so let us find out what is the gain or loss on restatement. What is the forward rate? We are going to calculate, we are going to calculate the profit or loss on the contract getting settled itself. So 47.18 is the rate at which the contract was sold. 47.18 is the rate at which the contract was sold. Minus the contract rate is 47.1. This is the rate at which I had agreed upon. The difference is 0.08. This into 1 lakh comes to 8,000 rupees. I will just explain the rationale of it. When I entered into the contract, the rate prevailing was 47.02. This is the spot rate. Next, we had contracted to, this contract is to buy, we had contracted to settle the contract at 47.1. So this is the forward rate. Next, 47.18, we have sold the contract. So the sale rate is 47.18. They are asking us, show the profit from the contract and how it will be recognized. First point to be clear in your mind is, when you enter into the contract, unlike the previous question, what did we do? When we entered into the contract, we compared the forward rate with the spot rate and found out whether we are making, whether it's a profit or a loss situation. And what did we do with the profit or loss? Amortize it over the life of the contract. If you are entering for speculation purpose, you will not find out the difference between spot rate and forward rate, not found out this way. Instead, what we are going to find out is the difference between the forward rate and the, on 31st December, he closed his books. That time the rate prevailing was 47.15. This is the closing rate. Ideally, we will have to remeasure the contract. But in the material, they directly have found out when you sell the contract, what is the profit you make. Okay. So when you sell the contract, what is the profit you make? How are we going to arrive at the profit? At what rate? What is the selling price of the contract? At what price were you able to sell it? 47.18 you were able to sell it. You have to execute the, now you had, what is the rate at which you are going to honor the contract? Forward contract has been taken. You are going to purchase, you have to honor the contract at what rate? What is the forward rate? 47.10. This is the rate at which you are going to honor the contract. You will have to execute the contract on that date. Right now, you were able to sell it 47.18. You have to execute it at 47.10. So the gain that you make is 0.08 per dollar. You have sold the so 0.08 into 1 lakh 8,000 is the profit that you make on the contract. Okay, question on this model never asked in the exam, nor I have seen it in the RTP also. So very rare possibility of this coming. Okay, with this AS 11 discussion we are through with. So we will quickly look at three accounting standards now back to back: AS 9, AS 7, AS 12. I will just run over the concept part of these accounting standards. Question wise, we will take up some MCQ questions which apply the concepts towards the end, so that time we will be able to test how much we've understood the standard. So starting with AS 9. Objective of this standard, objective is to tell you when to recognize the revenue. When to recognize revenue, this is being answered in accounting standard 9. So the standard is titled as revenue recognition, which means when to recognize revenue. This standard is not on measurement principles, but only on recognition principles. So when to recognize revenue is the only question we will try to answer. Before we get into recognition criteria, let us stop by to understand what does the word revenue mean. Revenue means gross receivables. Gross receivables in cash, kind. Cash, kind, or other consideration. Just gross receivables of cash, kind, or other consideration that you are receiving because of one, sale of goods. You're receiving by sale of goods or rendering of services. Sale of goods, rendering of services, or use of entities' resources by others. Use of entities' resources by others. What are the now meaning or definition of revenue will not be tested at all in the exam as such, but what I want you to understand is, first point, revenue is the gross receivable. The word gross is important. We will see some study middle question to see what is the implication of the word gross. Received by three things: sale of goods, rendering of services, or use of entities' resources by others, which is yielding in three things: dividend, interest, or rent. Sorry, dividend, interest, or royalty. Only these three incomes are covered: interest, dividend, and royalty. So our discussion of AS 9 is going to be divided into, first we will see sale of goods, when to recognize revenue. Next, rendering of services, when to recognize, and rent, interest, rent, and interest, royalty, dividend, when to recognize. Okay, so three parts our discussion is divided into. Looking at the meaning of or definition of this revenue, entity XY sells machine that is used at a factory for 2 lakh rupees. Carrying value 1.8980. Can the gain be recognized as revenue? Is the profit on sale of the asset a revenue or not? Answer is no, because it should arise in the ordinary course of business. You are earning profit not in the ordinary course of business, so it is not part of revenue. So revenue is only from sale of goods, rendering services, or this fixed assets is not part of this definition, so that cannot be considered as revenue. Next example given by study. I'm only doing study middle questions here. Buying and selling properties. It purchased a land of 150. It sold off that land after a few months at 240 crores. It is a real estate developer is selling the land. Will it be revenue? Yes, because it is in the business of buying and selling land. Okay, now come to this thing. Gross receivable is the word used. Let us see if in an agency relationship, what will be the revenue. Again, this is a study material illustration, one question. Zigato runs a food delivery business. Zigato allows customer to order foods. Now, during the year, it collects money on orders made online as under. Total price is 200 lakhs. Delivery charge is 60 lakhs, GST 40, and totally 300 lakhs is the received from the orders by Zigato. How much will be revenue for Zigato? It's the Zomato, Swiggy kind of business setup is this question on. How much is the revenue here? Means the revenue is only and only the delivery charges and not 300 lakhs. Gross receivables is the word used. However, if there is an agency relationship in which the entity is working for the agent, the 300 lakhs is not the revenue. It will have to remit it back to the principal. So what is revenue for the agent is only the commission charges. Commission, here it is delivery charges. Similar model, Trip Deal is a website. It's nothing but that makemytrip.com kind of business setup where we will tell only commission is the revenue for them. Coming to sale of goods. So we've understood what is the meaning of the word revenue. Now we will get into different sources of revenue. First is sale of goods. We will see what is the recognition criteria for sale of goods. I've removed that from the screen. This standard draws parallels or draws reference with the Sale of Goods Act, which you have learned at foundation level or even at college level you would have learned. Sale of Goods Act tells when can you tell that a sale has happened? When the risks and rewards incidental to ownership of the goods has been transferred to the buyer, we can tell that the sale has happened. So that's the first condition. Significant risks and rewards of ownership in the goods should be transferred to the buyer. Nothing to do with any accounting standard knowledge. This is only Sale of Goods Act sentence told here. Then only then you can tell the sale has happened. Apart from this, we are going to link Sale of Goods Act plus conservatism principle. What does conservatism tell? Do not recognize any anticipated profit, but provide for all possible losses. By no way you should not overstate your income. It's okay to understate income, but never overstate your income. Which means if you have sold 1 lakh worth goods, but you think that out of this only 90,000 will come to you, how much of revenue can be recognized? Or how much of receivable we can recognize? Only 90,000. You cannot show something which you are not going to receive, which means only when you are certain about the collection, only then revenue could be recognized. If you think that you are not going to get the money, don't recognize that as revenue in the books. So the second condition tells there should be no significant uncertainty in the ultimate collection at the time of recognition. This phrase, I want you to surely remember. We will decode the phrase now. There should be no significant uncertainty. Significant uncertainty about what? About the ultimate collection of the revenue. When you should not have any doubt about the ultimate collection, at the time you are recognizing the revenue in the books, that time itself you will check whether there is any significant uncertainty or not. This criteria you are going to apply when you are initially recognizing the revenue in the books. So recognition criteria I am going to split into two parts. One is initial recognition. Recognition at the time of transaction. What is the criteria? Once we have recognized the revenue, then subsequently what you should check for, that is second. That is the second part of the standard. When the transaction happens, what are you going to check? Two things. Significant risks and rewards incidental to ownership of the goods has been transferred to the buyer. Second, there is no significant uncertainty about the ultimate collection of the revenue at the time of recognition. However you want, you word it, but what I should see is uncertainty should be attached with the word significant. No significant uncertainty. In ultimate collection should be there and recognition should be there. I have brought only the keywords. You can you you have to remember this sentence. Okay. Now, in goods also, there are some special situations under which revenue recognition we will discuss. Special situations are given by the standard itself. First one, the delivery of goods is delayed at buyer's request. The delivery of goods is delayed because the buyer wants you to delay it. In such a case, when should you recognize the revenue? Let me give you a question and then explain, because that will make it more clearer, I think. XYZ sells goods worth 50 lakhs. AB Limited is facing short storage. Now we are selling the goods to AB Limited. So AB is the buyer. But AB is having some storage problem. So it tells the seller, that is XY, that you keep the goods with you. I will take it from you only on 15th March. So he is asking the delivery to be delayed. However, risks and rewards associated with the goods are deemed to be transferred to AB Limited. How should the transaction be accounted? Here, when delay is not because of us, but because the buyer asked us to delay it, I will open the material and show you the answer. There are some conditions which you should example number 5. Example 5. These are the conditions. First, the goods must be in hand. I will take it through in a little in detail. Some sentences are written here, some sentences are written here. So I will give more clarity than the study material. First one, goods must be in hand, which means they should be specifically identified that these goods belong to this buyer. So goods must be in hand and specifically identified. Second, goods are ready to be delivered to the buyer. I am ready from my end to give it to the buyer, but buyer tells I don't want it now. So first, goods must be in hand and specifically identified. Second, goods are ready to be delivered. In a packing condition, I have kept it ready, but the delivery is delayed at the buyer's request. And these goods cannot be sold to any other person. Suppose suddenly someone comes and tells, I want to buy this. You cannot sell it. If these conditions are satisfied, then we will take that risks and rewards incidental to ownership have been transferred. Has the physical possession transferred from the buyer to the seller? No. Physical possession, when does it get transferred? Only on 15th March. In this question, when does physical possession get transferred? Only on 15th March. But when is the goods ready to be delivered? 20th February itself. When will we recognize revenue? 20th February. See, the goods are ready to dispatch. That is the word to be searched for, ready to dispatch. But delay is because the buyer's request, means we will recognize the revenue when the goods are ready. We will not wait till the delivery date, actual delivery date. Okay, suppose there is a consignment sale. There are two other situations which we will discuss. Let's take Rita Limited is into garment business. She is selling goods to Aisha Limited. And Aisha is going to sell it to the ultimate customer. Rita Limited, when she sends the goods to Aisha, there is no sale transaction. She's giving to Aisha and telling her that you are an agent for me, you sell the goods to the ultimate customer. So when Rita sends the goods to Aisha, we call that as goods are sent on consignment basis. There is no sale happening. Goods have been sent to her so that she can make the sale to the ultimate customer. She is only acting as an agent. Rita is the principal or the consigner. Aisha is the consignee. Now, when will revenue be recognized on the goods? When Rita, in the books of Rita, when will revenue be recognized? We're going to discuss. When Rita sends the goods to Aisha, will revenue be recognized? Or when Aisha sells it to the ultimate customer? Answer given by the standard is when Aisha sells it to the ultimate customer, only sale is happening because Aisha is only an agent. The risks and rewards incidental to ownership is transferred only when a sale is made. Right now, even though the goods are lying with Aisha, the principal owner of the goods is Rita. The risks and rewards have not been transferred to Aisha. They will be transferred only when the Aisha makes the sale to the ultimate customer. Okay, so in consignment sales, when is revenue recognized? When the goods are sold to the ultimate customer. Third situation, goods are sold on sale or approval basis. When goods are sold on sale or approval basis, what does it mean? I am giving the goods, let's say X Limited is giving these goods to Priyanka. X Limited giving the goods to Priyanka, telling Priyanka that you use the goods. If you're happy, you keep the goods. If you're not happy, you return back. So these goods have been given on sale or return basis. And when goods are given on sale or return basis, there will also be a time period which is fixed. Let's take 30-day time period. Within 30 days, Priyanka should decide whether she wants that item or not. If she does not want it, she should return it back within 30 days. If after 30 days also she held on to that item, I will take it as if she has purchased the item. Okay, I will take it as if she is interested and she's taken the item. In such a scenario, when should sale be recognized? When X, now options given. Option A, when X Limited gives the goods to Priyanka, that time should sale be recognized. Or when Priyanka tells she wants the goods, she is willing to take the goods, that time should revenue be recognized. When should we recognize it? Answer is when Priyanka gives her formally approval, when she accepts the goods only we will recognize it. Let's take approval is not given by Priyanka. In such a case, when should revenue be recognized? When the time period is over. Reasonable time period we given 30 days. When the time period is over, we will recognize the revenue. Okay. So in sale or return basis, revenue will be recognized on getting the formal acceptance by the buyer that the goods have been accepted, or time period is lapsing, whichever is earlier. Whichever is earlier, we will take that goods have been sold on approval basis. The revenue will be recognized from this transaction. Coming to the next thing. KJ sells goods. This is a sale and purchase agreement. We will just go with the question. KJ sells goods at an invoice value of 5 lakhs. At the time of sale, KJ has agreed to repurchase these goods at a price of 6 lakhs. So KJ is selling the goods for 5 lakhs. And sale happens on 1st January for 5 lakhs. And he is also going to purchase back the same goods on 1st March at 6 lakhs. When should revenue be recognized on this transaction is under discussion. This is called as sale and repurchase arrangement. Similar like this, we are also seen under leases where we tell sale and lease back arrangement. Here, this is not involving a fixed asset or a PPE, it involves goods. Here, in this case, where you are entering into two contracts. One contract is a sale contract and the other one is to repurchase the goods. The standard tells that in this scenario, it is not at all a sale transaction, because why will you sell the goods and then repurchase back if you really wanted the goods? this transaction is a financing arrangement is what the standard tells. So it goes with the substance of the transaction rather than the form of it. Hence, it will treat this transaction as a financing arrangement and tell you that you should not recognize the profit on this transaction. What should you do? I will show you the example how the journal entries are passed. What is done is, when the sale has happened, 5 lakhs, you're going to receive 5 lakhs because you sold the goods. Bank account debit, you're going to write the entry as bank account debit to sales. You're not going to write, because if you write sales, you're recognizing the revenue on it. You can't write sales. You're going to write loan. It is like you're entering into a liability. 5 lakhs you're getting now. The interest on that will be taken as 1 lakh. The difference between you selling and you purchasing back, with the 1 lakh is taken as interest. And finally, the loan is repaid. Loan to bank, when you are repurchasing back, it is taken as a repayment of loan. Okay, but this sale of goods is through with. These are the different situations. We will just see one question on this model, which covers all the points. Question number 7. Can you quickly jump to the book back question number 7? Yeah. Following information of Meghna is provided. Goods of 60,000 were sold, but at the request of the buyer, these were delivered on 10th April. See, when you're starting this kind of a question, they're asking you, tell us the amount to be recognized as revenue, which means you should decide when to recognize and how much to recognize. What are the provisions which you're going to write here? That only I'm going to discuss. The answer wise, even if you did not know AS9 question is the most trickiest of all questions. It is the easiest standard, yes. But having said easy, it is logically, conceptually, you know the standard. But to present the answer only is the learning point in the classroom. What provisions should be written, what sentences to be learned, that you have to focus when you're going through AS9 at home also. This question is on when to recognize revenue and how much to recognize the revenue. When to recognize revenue, what are the criteria? First one, significant risks and rewards incidental to ownership of the goods should be transferred to the buyer. Second, there is no significant uncertainty in the ultimate collection of the revenue at the time of recognition. These two conditions should be mentioned. However, material tells us secondary, we will first mention these two conditions. In the given case, now this is the base recognition criteria. Now, special situations. This is where the delivery is delayed because of the buyer's request. What are the extra conditions? Goods should be in hand and must be identified. Second, goods are ready to be delivered. Third, the delivery has been delayed only because the buyer has requested. These three conditions satisfied here. Hence, the revenue from this will be recognized not on the delivery date, but on 20th March itself. Okay, so here the amount which will be recognized as revenue will be on 20th March. The date will be 20th March and the amount will be 60,000. Next one, goods of 1,50,000 were sent on consignment basis, of which 20% were still lying unsold. How much of revenue will be recognized? 1,50,000, 20% is lying unsold, which means only the 80% of the goods can be recognized as revenue. When will revenue be recognized in case of a consignment sale? Only when the goods are sold to a third party. This sentence has to be written. Revenue should be recognized only when the goods are sold to the ultimate customer. You can write that way also. But that sentence is very important to be written for consignment sale. Next, goods are sent on approval basis. 70% buyer has sent the approval. No approval or disapproval for the remaining goods till 31st March. So, revenue will be recognized only to the extent of 75% of the value. Balance 25%, which means 30,000 rupees, cannot be recognized now. It will be recognized. We will have to see whether the buyer approves it or disapproves it and then decide on the revenue. So for this, what sentence should be written is, revenue should not be recognized, or you can write it like this: revenue should be recognized when goods are formally accepted by the buyer or the time period has lapsed, whichever is earlier. That provision, right? Then you write the amount. Next, company has made cash sale of 7,80,000. Trade discount of 5% was allowed on cash sale. How much will be the revenue to be recognized? Revenue here will be only after deducting the trade discount. Should be deducted in determining the revenue. That's all. This model question only is the most frequently asked question under sale of goods, where they give you all the situations in a go and they ask you this for 5 or 6 marks. Provision wise, this line has to be written that trade discount should be deducted and determining the revenue. Next, there should be no uncertainty regarding the ultimate collection. I'm going to do a question on that model. I will just explain on the provision. There should be no uncertainty at the time of recognition of revenue. See, when it comes to recognition of revenue, now ultimate collection of revenue, whether there is any, is there significant uncertainty in ultimate collection of the revenue, we need to check. When will you check it? First, at the time of recognition, when you do initial recognition, you will check. Suppose there is an uncertainty at the time of recognizing itself. Will you recognize the revenue? No. You will postpone the recognition. Say you have recognized the revenue in your books and later you come to know that there is a doubt in the collection. How will you deal with it? I repeat, revenue has been recognized and later you come to know that there is a doubt in the collection. In that case, we will do not reverse the revenue. Instead, make a provision. This is what is taught in school, that suppose you have debtors in the books and you think the debtors may not pay up, you will create a provision for the doubtful debts. Okay, so that's about the uncertainty in collection of the revenue. Next, we will move to now this question we will see illustration 6 from the material. Can you just move to illustration 6? Board of directors decided to increase the sale price. See, they have already sold the goods, but now they are deciding to increase the sales on 31st March, giving it retrospective effect. And they're going to go back to the customers and tell them, you pay us the extra money, because we are going to increase the sales. In this case, the doubt is 15 lakh rupees is the extra money which they are asking from the customers to whom goods have already been sold. Can this 15 lakhs be recognized as revenue in the books? For this, we'll have to go with the criteria of, if there is no answer, if there is certainty that this 15 lakhs can be collected from the customer because of the relationship with the customer, in that case, revenue can be recognized. But if there's uncertainty, you cannot recognize this revenue. Illustration 6, if you see the solution, price revision is effected now. If the company is able to assess the ultimate collection, only then it can be recognized. If it is not reasonably certain, then it shall postpone the recognition of revenue. Why the word postpone is used? Because the question is not right now, initial recognition. Suppose the question was where they have already recognized the revenue and now they are having a doubt, then what will your answer be? They should create a provision for the portion which they think that may not be receivable. But in your exam question, they generally ask you only at the time of recognition whether they can recognize or whether they should postpone. Okay, similar model question, illustration 7 is also there. So I'm moving to rendering of services. How will you know whether you've understood the standard or not? We are going to do MCQ questions. I will do 7, 9, 12. 3 standards back to back. And then we will move to MCQ questions. Rendering of services. Revenue from rendering of services can be recognized when? I will tell the recognition criteria. It's not there in the soft copy of that. The criteria is first one, service has been performed. This is for services. So service has been performed. What is the first condition under sale of goods? There is no, the risks and rewards incidental to ownership of the goods has been transferred to the buyer. Okay, only then you can take that sale is complete. When will you take service is complete? When the service has been rendered. Instead of saying service has been rendered, you can tell or service has been performed. Either case. Plus, what is the second condition? There is no significant uncertainty in the ultimate collection of the revenue at the time of recognition. Same condition as what we learned under sale of goods. So these are the two conditions for recognizing revenue from rendering of services. Questions are not only based on when to recognize, but also how much to recognize for rendering of services. How much to recognize revenue? For that, the standard tells that I will give you two methods of recognizing the revenue. One is you recognize the revenue only when the entire service is over, which means you're going to go by completed service method. You finish the entire service and only then recognize the revenue. Or you go for proportionate completion method, where we will recognize the revenue as and when the service gets rendered. If you have completed 30%, recognize 30%. If you've completed 60, recognize 60%. So, revenue recognition is based on how much of the contract has been completed. Now, how will you decide how much of the contract is completed? There are different bases. First is go for a technical survey, wherein you yourself find out from the details of the contract how much has been completed. Or if you can't find out like that, you take cost as the base. The total cost of the contract is 100 lakhs. You have spent so far 30 lakhs on the contract. So how much of the contract is complete? We will take it as cost incurred till date divided by total cost of the contract into 100, which will give us 30%. This only is used as part of AS7 to recognize contract revenue. So the best way to understand 7 is to understand 9 first, because 9 teaches you how to recognize revenue. That is used by AS7 and telling you that you first find out percentage of completion for contract. How do you find percentage of completion in a contract? Cost incurred till date divided by total cost of the contract into 100. Then what you will do is 30% you will apply on the revenue fixed. Let's take revenue fixed on the contract is 120. So you will do 120 into 30%. 36 will be the revenue that you recognize. How much is the cost incurred till date? 30. So profit recognized will be 6. So from 9, you can also link it back to 7. Some MCQ questions are there for sale of services. There is no single short question on sale of services alone. There is a question which is a combination of goods and services. Study material question number 8. We will just go with that. Just a minute, I will project this question also. AS9. Please move to question number 8 in your study material. Let's look at the question. For the year, KY Enterprises has entered into the following transactions. KY supplied 2 machines. Both the machines were accepted. Machine 1 was a machine that was routinely supplied and installation process was very simple. Machine 1 was installed on 2nd April by ST's employees. So when was, say, machine 1 and machine 2, 2 machines are being sold here. You should decide how much to recognize revenue and when to recognize the revenue. For machine 1, 3,20,000 is the selling price. Cost is 1,60,000. Machine 2 is a more specialized machine which is more complicated and requires assistance. Machine 2 was installed between 2nd and 5th April. For machine 2, because the process is very complex, this machine can be taken as the risks and rewards transferred only on the date installation is complete. For machine 1, when will the date of sale happen? When the machine is delivered itself. You need not wait till the installation date. But for machine 2, you will have to wait for the installation date. Only then you can recognize the revenue. Okay, now last part. Interest, royalty, dividend, when to recognize. Interest will go as per accrual basis. In interest you will recognize on period. Based on how much of period is over, you will decide on the revenue to be recognized. Royalty will be based on the agreement, and dividend will be based on when you receive the right to receive dividend, you will recognize the revenue from dividend. So dividend can be recognized when the right to receive dividend is established. Okay, so with this AS9 we are through with. So starting with construction contracts, the objective of learning the accounting standard is to learn accounting of construction contracts. Construction contracts means any contract, the contract which is envisaged by the standard is any contract that involves construction of some PPE. The contract is running for more than 1 year. Only such a contract is under discussion under the standard. We are the scope of the standard. We are going to learn accounting of these contracts from the viewpoint of contractor only. Only from the viewpoint of contractor. Contractee accounting will not form part of our discussion at all. Getting into definitions. One word which you should know about is what is contract revenue. What are the components of the contract revenue? Contract revenue means the revenue which you're going to earn from the contract. That's very simple. Now let us read what and all can form part of contract revenue. I have it here. Yes, here. I will first list them down, then we can go through in the initial price agreed upon. Plus, I have initially agreed the price to be 100 lakhs. So initial price agreed upon. Plus, suppose I go in for an escalation in the price. Why will I go for an escalation? At the time I fixed the contract revenue itself, I would have told it in the agreement that if my raw material costs go up or if anything like that happens, I can or I have the room to escalate the price by 10%. Some percentage will be fixed. Suppose I escalate my revenue, the amount that is going to be received, an escalation clause will also form part of the revenue. Next, I have told the person that when you are giving me the land for construction, you demolish the building and then only give it to me. After that only I will start. But the person did not do that. He just gave me a land with an old building also. So I have to do some extra work on that. For any extra work that I do, I will charge money from the person. For that, whatever I am going to ask from the person, that will also form part of revenue. Next, I am making any claims because see, I have the architect ready with me. I have the construction workers also ready with me. I am ready to start the construction from August. However, the land did not come to me. That is, the person did not approach me. He kept on delaying the, what is that? He has to come and he has to give me the permission to start the construction. He delayed the granting me the permission to start the construction, because of which I had to wait 15 days extra, and only then I could begin. This 15 days I have to unnecessarily spend money on my material which is already purchased. Hence, for this I can claim back because of any delay from the contractee's side. I can make any extra claim from the person. Suppose I complete the work even before stipulated date, I may get an incentive from the contract, from the person who's given me the contract. So even that will form part of revenue. Finally, if I make some mistake in doing it, I may have to pay a penalty for it. So penalty will be deducted from the revenue. So contract revenue, what all forms part of contract revenue? 1. Initial price agreed upon, escalation clause, variation in the work, incentive and claim. These two you remember back to back. Incentive and claim, and penalties payable should be deducted. A very nice question on this is study material illustration 2. Ensure that you go through from your end. If you want to, you just mark it or note it down, that you go through illustration 2 to understand contract revenue meaning. Next, when should contract revenue be recognized? Recognition criteria of the contract revenue. First criteria, contract revenue can be measured reliably. You should be able to reliably measure it. Contract cost also you should be able to measure it reliably, and probable FEB inflow. The criteria here is similar to the asset recognition criteria, where you learn probable FEB inflow and cost can be measured reliably. Similar thing here, probable FEB inflow. Here not only cost but also revenue you should be able to measure reliably. There is no question on this recognition criteria for you in the study material. So that criteria is just extra, not required from an examination viewpoint. Crucial thing is on how much of amount to be recognized. Measurement of the revenue to be recognized. I am only taking the provisions of it. Questions will be dealt with in MCQs. Recognition of contract revenue depends on the outcome of the contract. You're going to check, can the outcome be estimated reliably? Can the outcome be estimated reliably? If you get an answer, what you're going to check is, can the outcome be estimated reliably? If you get the answer, yes, you can estimate it reliably, then revenue will be recognized. Revenue is recognized based on percentage of completion method. You're going to do it based on percentage of completion method. If you get the answer, no, you are not able to determine the outcome reliably, then revenue will be recognized only to the extent of cost incurred on that contract. Whatever cost incurred, only to that extent revenue will be recognized. What does that mean is, if outcome cannot be determined reliably, you cannot recognize a profit on the contract. What you can recognize maximum is, suppose you have a cost of 100 lakhs, you will recognize a revenue of 100 lakhs, that profit is zero. You cannot make a profit on this. If the outcome can be measured reliably, you will recognize based on percentage of completion. Only one question in the material is under this model. All the other questions are under this model only, where the outcome can be determined reliably. How or what are the conditions where how will you know whether the outcome can be estimated reliably or not? Questions will tell you. You don't have to break your head to know what are the conditions for this. Standard tells it, but we don't have it in our study material, so I'm not going over the conditions. Can the outcome be estimated reliably? Yes means go for percentage. No means only to the cost is incurred, only to the extent of cost. What does percentage of, how do you calculate percentage of completion? Is actual cost incurred divided by cost till date, or divided by total cost on the contract into 100. Actual cost divided by total cost into 100. Please ensure to go through these questions as study material question 11 and question 9. These two on this model, please ensure to go through. I will see how far you're able to work out in MCQ. If you're not able to work out, I'll come back. I will go through the illustrations. Last provision in AS7. So what are provisions we have covered? From question viewpoint, I'm going to revise. First, what is the meaning of the word revenue? Revenue means initial price agreed upon plus any variations that you're bringing in the work plus any escalation that you raise on the contract. Apart from this, two things now. You're making a claim because some problem with the person who has given the contract, or you completed the contract beforehand, so you're getting an incentive minus penalties. This is the meaning of the word contract revenue. One illustration question, something was there. Please go through that question and see whether you understood it. Next is different apps. Next is we have to learn to recognition, how much to recognize as revenue. For that, we have to decide what is the outcome of the contract, whether it can be estimated reliably. If yes, recognize based on percentage of completion. If no, only to the extent of cost. Okay, percentage of completion is equal to cost incurred till date divided by total cost into 100. You have to find out the percentage year wise and find out how much of revenue to be recognized year wise. Okay, last thing which I'm going to cover is, what if there is an expected loss on the contract? We are going to cover this. No question will tell you directly that we are expecting a loss on the contract. Question will not tell you that. How will you know that there is an expected loss? Is you will check what is the contract revenue decided, 100 lakhs. The cost that has happened and will happen, that is incurred till date and cost to complete the contract, comes to 110 lakhs. You have overrun the cost budget which you had decided upon. In this case, we tell that the contract is going to end in a loss. If there is an expected loss needs to be recognized in the year in which, that is the total loss in the contract should be recognized in the current year itself. You will not wait for the entire contract to be over to recognize the loss. If there is a possibility that there is a loss, you should recognize it in that year itself. For this, I want to take up a question and explain it. Question number 10 we will try. Akar limited question. That alone we will go through. There is a provision which needs to be written for this. For the other one, there was no provision necessary, so it was okay. Please move to question number 10. Let's read the question. Akar Limited signed a contract for 1 crore 50 lakhs. Following particulars are given. Material, labor, hire charges, other contract costs, labor charges are still outstanding. It is estimated that by spending 33,50,000, the contract can be completed. You are required to find out what is the profit or loss to be taken for this contract. First, this question is not only on finding out the profit, but also what are the components of cost. I did not cover it, that's why I wanted to cover it as an illustration question. What and all will form part of cost is material. Okay. Material used, labor charges. 36 lakhs is paid and 2 lakhs is outstanding. Both put together will be the labor charges, higher charges, other contract cost. Totally cost incurred is 1 crore 34 lakhs. Estimated future cost is 3350, which means total cost is 1 crore 67 lakh 50,000. What is the contract revenue fixed? What is the contract revenue fixed? 1 crore 50 lakhs. So this tells you that there is an expected loss. The question does not use that provision. Okay, I will. Yeah, this tells that the expected loss is there. Now, in case of expected loss, how to deal with it, I will come to it. Before that, we will see how much of revenue is to be recognized on this. For revenue recognition, you will have to find out what is the percentage of completion. Why am I finding out revenue to be recognized? What is the question on compute profit? What is profit equal to? Profit is equal to revenue minus cost. Cost is computed here. I need the revenue. So 80% is the percentage of completion. Apply 80% on 1 crore 50 lakhs into 80%. You will get 1 crore 20 lakhs. So 1 crore 20 with minus it from 167. You will get the loss for the current year. Please do it in the calculator. Revenue recognized 1 crore 20 lakhs minus what is the cost incurred till date? Cost incurred till date is 1 crore 34 lakhs. So 14 lakhs is the loss which we are making. Able to follow that? Please don't go with the calculation of material. Please don't only go with the calculation of material. We have a revenue to be recognized. Revenue that can be recognized is 1 crore 20 lakhs. What is the cost till date? 1 crore 34 lakhs. So what is the profit or loss to be recognized? This is the loss. 14 lakhs is the loss on the contract that should be recognized. That's all. Answer would have got over. However, we come to know from the information given in the question that the total contract cost is 1 crore 67 lakh 50,000, whereas the revenue fixed is only 1 crore 50 lakhs. So we are making an there is a loss, total loss on the contract is 70 lakh 50,000. Are you able to follow? Expected loss is 70 lakh 50,000. Sorry, the total loss on the contract is 17 lakh 50,000. Out of 17 lakh 50,000, what is the actual loss which we have already recognized in P&L? 14 lakh. So this extra 3 lakh 50,000, no, it is not loss happened now. It will happen in next year. But conservatism tells if there is a possibility of loss, also provided for in itself. So this 3 lakh 50 also should be provided for. So you will present the answer as total loss on the contract is equal to 750, loss already recognized 14 lakh, loss to be recognized 3 lakh 50,000. Okay, that's all. A7, one more provision I forgot. One more provision is there, which is segmenting the contracts. Combining and segmenting contracts. When can you combine the contract and see? When should you segment the contract and see? That is to be discussed. Now, suppose you are going to construct two buildings. This is a residential complex. One is residential house building, and the other one, a hospital is getting constructed on the same land. So they are searching for a person who can construct this land, construct the buildings and give it to us. This contractor is, let's say, SPR. SPR is taking up this contract of constructing this building for X Limited. when they propose the contract, they tell that for the building and hospital put together, we will charge you 100 lakhs. How much of the revenue is for each building? It's not mentioned in the proposal. The condition by X Limited is whoever does residential building should also do the hospital. We will not give separate contracts to two different people. We want only one single contractor to finish both the buildings. So SPR is negotiating for a price for both the buildings put together, and these two buildings completion date also, the what is that, the breakup of cost, how much is going to be incurred, is not given. We have not calculated building wise, we've calculated as a project as a whole. Suppose you're looking at the whole thing as a project of both the buildings put together, you're going to see it as a one single contract, even though it involves two units of building. Okay, now suppose SPR is going to negotiate for this contract. They can either choose residential building or hospital or both. There's an option. X Limited can award the contract for any one building or both the building. In that case, first of all, they are looking at the buildings separately. We are negotiating the price also. For this, we are giving a separate price. For this, we are giving a separate price. We are negotiating also separately. The cost which we are identifying is also separate. The revenue also we can identify separately. Cost is identified separately. We are negotiating also separately, not as a single package. In that case, we are going to look at the contract as two different contracts, where we are going to split it, segment it, and then see it. Okay, one question we will just see to get familiarized. XY contracts with AB Limited to construct two residential buildings in the same premises. Construction of both the buildings will begin simultaneously. Material and everything will go parallel to provide cost savings to XY. So cost also they don't have separate. They have it only together. Timely completion of the two building and negotiated also a consolidated price. So are we going to segment it or combine it? Combine it. Combine it. Okay. Next one. X company negotiates with some company based on proposals submitted to zonal officers. They are going to get a contract to construct outlets. The entire contract has been given in a single document, but they've fixed the revenue outlet wise. Outlet wise, they fix the revenue in addition to individual completion time. Are you going to read it as one single contract or four separate contract? Answer is four separate contract, because even though it is on single document, revenue can be identified separately, completion time is separate, cost is separate, so it will be treated only as segmented contracts. Okay, with this AS7 we are done with the revision part. So starting with Accounting Standard 16, which deals with borrowing costs. The title of the standard uses the word borrowing cost only. The word accounting or nothing extra is attached to this accounting standard. Now, what is the objective of learning the standard? We will just quickly go over the objectives, the standard quickly. Objective of learning the standard is to decide whether the borrowing cost can be capitalized or not. Second, if it can be capitalized, how much amount can be capitalized on that? Scope. Now, when it comes to costs, there are two sources of funds which we have. One is the own funds and the other is the loan funds. Loan funds cost only the standard is talking about. So borrowing cost means only the interest part, nothing to do with the equity related costs. So this I've just tabulated that if I have to bring down all these sources of funds, only the cost on, in case there's something called preferential capital classified as liability, which you will learn when you come to Ind AS scenario, to that alone AS 16 will apply. Otherwise, all these forms of borrowings which you know, for example, debentures or a bank loan, any kind of borrowing, only this accounting standard will apply, or public deposits also for that matter. Definitions. There are two. Yes.
Ma'am, your video is blurred.
Okay. So resuming back with the discussion, we are going to learn the meaning of two words first. Knowing the meaning of these two words is very important. You will have to be quoting these two words somewhere in your answer if any question on A16 comes. What does borrowing cost mean and what does qualifying asset mean? Borrowing cost, when I tell, it is the cost of borrowing. Else to tell, interest plus other costs. When I tell other costs, this standard gives examples of three costs under others. One, commitment charges. One is interest cost. The other is, even if you are not, is the bank has sanctioned the money for you, but you have not withdrawn the money from the bank. In that case, banker can't charge you interest. They will charge you commitment charges. And ancillary costs, any other extra cost that you can directly attributable to the borrowing for arranging the funds. And third is any discount or premium on debentures. These are the three examples which the standard gives. Now, having understood that these are the examples, I will go over the definition of borrowing cost. Borrowing cost may include the following. First, we will look at a smaller thing, simpler way. First is interest. Second, amortization of ancillary costs. Please note, ancillary costs, discount on all this, the word amortization is attached because the cost is going to be split over the period of the loan or the period of the borrowing. So interest, amortization of ancillary costs incurred for arrangement of borrowings, amortization of discount or premium on the issue of debentures or redemption of debentures, finance charges. Finance charges is relevant only if you get the asset on lease. And fifth is exchange differences. Exchange differences is relevant only on foreign currency borrowings. We will just go over this now. Can we repeat it together? Borrowing cost includes first interest and commitment charges on borrowings. Here I've given bank borrowings. Even if you write borrowings is okay. And one note, one thing you remember, borrowings does not mean only long term. Even short term borrowings is included, which means suppose you're paying, you have taken overdraft to fund a PPE. In that case, even overdraft interest can form part of BC, not necessarily only bigger loans. So interest and commitment charges on bank borrowings. Second, amortization of ancillary costs incurred for arrangement of the borrowings. Amortization of discount or premium on here I have given just a small thing. Discount means discount at the time of issue of debentures and premium at the time of redemption of debentures. Fourth one, finance charges, and fifth one, exchange differences. Exchange differences, when you're writing, please write on foreign currency borrowings. So much is the meaning of the word borrowing cost. Important definition. Next important word, even more important than this borrowing cost meaning, is qualifying asset. There are quite some questions in the study material which talk on for which you'll have to define qualifying asset first. Qualifying asset is an asset that necessarily takes a substantial period of time to get ready for its intended use or sale. Just to help you remember the words clearly, we will go over each word and understand the relevance of that word in that sentence. Qualifying asset is an asset. This definition does not use the word tangible items, or it does not tell asset without a physical substance, which means intangible asset. Here the word asset is used, so it can be both tangible or intangible item. Okay, next, necessarily takes. The word necessarily is important. If you just tell takes, it is not sufficient. I will tell why necessarily in some time. Necessarily takes a substantial period of time. What a substantial period of time? I have to elaborate a little more. To get ready for its intended use or sale. The word use or sale is there, so even inventory can be forming part of a qualifying asset. Not necessary that only PPE is, even inventory falls. But in our study material example or illustration questions, only PPE examples have been given. Inventory also can form part of it. You should just be aware of it. MCQ question, maybe they can test you. So can we repeat qualifying asset? Even if you're sitting at home, whoever are there at home, all Please ensure that you open your mouth and you're reading along with us at sitting at home also. Qualifying asset is an asset that necessarily takes a substantial period of time to get ready for its intended use or sale. It's not like you are by hearting these sentences. You have to learn it and by heart and write it. However, there is a certain amount of technical language which we should be presenting in our exams. If you tell I will write everything in my own words, does not come to the quality of a CA professional exam. Hence, you have to write these words. You can change a little bit here and there, but what you should not change in this is the word asset should be there, necessarily, substantial period of time, intended use or sale. That's all. This is what I expect. Other things, it's your choice. Now, going over this asset, PPE, is it a qualifying asset? Yes. Intangible asset? Yes. Investment property, will it form part of qualifying asset? Yes. If you don't know what is investment property, any land or building only will form part of investment property, but the intention of having the land or building is not to use, not to sell, but to rent it to someone and get some income out of it, or keep it with you and sell it after 5 years for capital appreciation. Even that forms part of qualifying asset. Inventory, yes, I've already told you. What does not form part of qualifying asset is investment asset, financial assets like shares, debentures. You take those kind of assets, it does not form part of qualifying asset. There is a question in study material based on what is a qualifying asset, where they give you an investment. I will also parallelly do that. Just a minute. Study material. Can you all open your study material also? Everybody at home have a hard copy. You have a hard copy, soft copy only. I will also parallelly cover off. I will tell you the reference of the page numbers. Yeah. Illustration 4, page number 5.127. Illustration 4, page number 5.127. Shravani, just one help. If you just, okay. Nothing, it's closed. It's closed. I thought the door was open. Yeah. Illustration 4. Take Limited has borrowed 30 lakhs from SBI during the financial year, and the borrowings are used to invest in shares of Give Limited. You're investing the borrowings in purchasing shares of another company, and that company is implementing a project which is costing 50 lakhs. The project has not been completed. The question here is, directors of Take Limited has borrowed money and they are put in the shares of another company. Can Take Limited capitalize the interest that is being paid on the loan to purchase the shares? That's the question. Now, just to tell you what all provisions, we will just discuss off and then we will see the answer. Here, the question is on qualifying asset, because they're telling you, can we capitalize the interest cost on this? So the borrowings has been used for what? Borrowings has been used for purchase of shares. We have invested money in some other company. That company is implementing a project. But for Take Limited, what is the amount used for shares? Is shares a qualifying asset? No. You will have to, for telling no, how are we going to approach the answer? First part of yesterday I had given you all a question to work out and send me, because I want to know how you present the answers so that I can teach you how to move towards the right presentation. Your answer should be divided into, first, you will be writing provisions. Next, you will be giving analysis. And third, we will be giving the conclusion. When we are writing the provision, it is necessary to start off the provisions as per AS 16. Here, what is the relevant provision? Someone had sent me an answer on depreciation with lot of provisions given. You may not have that much of time to complete the answer. Here, only one thing, qualifying asset needs to be defined. What is qualifying asset? Can we repeat it? Qualifying asset is an asset that necessarily takes a substantial period of time to get ready for its intended use or sale. Now, in analysis, what we should be giving in the given case, the Take Limited has invested in purchase of shares. Shares are ready for its intended use or sale from the date of purchase itself. Hence, it cannot be considered as a qualifying asset. Okay, we will discuss, then we will see how the material also tells. Next, it will tell that conclusion, the interest on the borrowings that have been taken for purchase of shares cannot be capitalized. If you give this one, sufficient. In our here, they are also linking it with AS 13. Okay, I am not talking about 13. Even if you took the shelter of one accounting standard, it is sufficient. I do not think AS 13 relevance if you is very important here. If you skip it, is okay. Now, reading A16, qualifying asset, they've given the definition. Since shares are ready to use, it is not a qualifying asset, therefore, directors cannot capitalize. If you tell it cannot be capitalized, you should also tell what should be done then. You should tell it should be charged off to P&L. Okay, so qualifying asset meaning we have this. Yeah. Now, I'm going to get into substantial period of time. This also we will have some questions in some time. What a substantial period of time mean is at least 12 months time it should take. Lesser than 12 months can be possible provided it is justifiable. In our exam questions, we will take 12 months only as a substantial period of time. This already explained, so I'm skipping it. This I have given you we have already done that illustration for, so I'm skipping. Next, we are getting into what the standard answers, two questions. First question is whether BC should be capitalized or not. What BC can be capitalized? This sentence is the base of the entire standard. This is the crucial sentence throughout the standard. Borrowing cost that is directly attributable to three things. Two, qualifying asset. 1 minute. I will remove this definition out. First, we will try to frame it out step by step. Borrowing cost that is directly attributable, directly related to. Even if you write related to is okay. Directly attributable to qualifying asset. Anything that is related to a qualifying asset can be capitalized. Related to what? Qualifying asset. Let's take an example of PPE. What are the ways in which you can get a PPE is? 1, you acquire the asset. 2, you construct the asset. But for us, qualifying asset is not only PPE, it is also inventory. It is also inventory. So for inventory will go in for production. So now we will define now we will go through that sentence. Borrowing cost that is directly attributable to acquisition, construction or production of a qualifying asset should be capitalized as part of cost of the asset. Can we repeat the sentence? Borrowing cost directly attributable to the acquisition, construction or production of a qualifying asset should be capitalized as part of cost of asset. If you miss out this, it's okay, should be capitalized. But preferable if you write this, it looks more, it looks a better presentation, like what do you say, that proper technical language we are using. Okay. Other borrowing costs should be charged off to P&L, you can write, or should be expensed off, you can write, or should be recognized as expense in the period in which they are incurred. Your choice how you word it. But when you are writing this, you also write this. Better, both should be written. In every standard, you're doing a question on borrowing cost computation part, write this sentence and then begin. Anywhere you write, it will become relevant only. Except if the question is just on deciding qualifying asset, then don't write this sentence. If it involves number calculation, write this sentence for sure. Okay, now this I have just given extra. It is not used in any question in our study material. What is the because I told you that every standard we have objective, scope, definitions, recognition, measurement. Objective, skip it from examination because scope is not, it's not very important for this standard. Definitions, we have learned two definitions: borrowing cost and qualifying asset. Now we are coming to recognition criteria. Any standard on asset related will have the same criteria. Nothing new I'm going to teach you. You know these two criteria, so I'm skipping it. It's probable FEB inflow, cost can be measured reliably. I have written borrowing cost can be measured reliably because it is this standard. Measurement. Now, the entire standard, which main part of the standard for us learning is on measurement criteria only. In measurement criteria, what are we trying to do is computation of interest. Though I told you borrowing cost has multiple elements, can we just repeat what are all the, repeat, we are here in this class to ensure that the studying gets over in the class itself, that you don't have to go back and go over these definitions. At the end of the class, I will give you one question from every standard, which I want you to write and give it to me, so that if there is any modifications to be done, I will tell it to you in the next class. Okay, we are here to improve our presentation. Even if you know the standard, that's not sufficient. You'll have to present it properly. Borrowing cost meaning was interest. Yeah. Next was ancillary cost. Third was discount or premium on redemption or on issue redemption debentures, finance charges and exchange differences. Even though we have understood so many parts of BC, our questions is only on one, and that is interest. So we are only going to learn computation of interest. Even though I tell computation of borrowing cost, we are only going to learn computation of interest. Now, interest is not something new you're learning now. You've already learned interest calculation right from 11th standard onwards. Interest calculation formula is interest is equal to amount into rate into period. To understand what should be the amount, what should be the rate and period, only we are referring back to the standard. So my discussion is going to be on elaborating what is period first. I'm going to check into period first. Then we will come to rate. Then we will come to amount. We'll go in that order. So factors required for computing BC are these three things. When I tell amount, it means loan amount. Here I'm taking borrowing amount, it's loan amount. Period of capitalization. Period means what? When I tell period, period is where we are trying to define what is the start time and what is the end date. There should be a start date and there should be an end date. Start date means we will call it as commencement of capitalization. So if you're doing a question on start date, you will prefer to use the word commencement of capitalization. End date will be called as cessation of capitalization. It should stop on that date. Sometimes, okay, we will finish with commencement, then I'll come to the next thing. Commencement of capitalization. When can you start the capitalization? There are three conditions. I will slowly build on the condition. First thing, you should have taken the loan, which means you should incur the interest cost, only then you can the borrowing cost comes to picture. So the first thing is loan should be taken, which means borrowing cost is getting incurred on the loan. Second, you should have used the loan for the QA. So expenditure on QA should be incurred. So two things. One, you should have taken the loan and you're paying interest. Second, you should have spent the loan on the QA. Third, spending alone is not sufficient is what the standard setter felt. There is a third condition attached here as necessary activities are in progress, which means suppose we have started constructing a bridge. We have started somewhere in May 2024. In June, let's take elections come, and that time the construction is not happening on this bridge. In that case, you cannot capitalize. That is, Three things. You should continuously work on the project. Just by taking a loan and you're just sitting and waiting that yes, I will start. Yes, I have done something. Then I'll take a break and then do after some time. The standard wants you to continuously work on the project and finish it off. So they tell necessary activities should be in progress. Here, if you, three conditions, can we repeat it? I will show the, yeah, can we repeat the conditions? First one, BC is being incurred. Throughout my notes, I have used the abbreviation BC, but it is not an acceptable abbreviation. You will have to write borrowing cost only. If you write interest is being incurred, I wouldn't say it is correct. You are wrong, because interest is not the only BC which the standard setter feels, it is much more. So interest is being incurred, wrong. Borrowing cost is being incurred, expenditure on QA is being incurred, and necessary activities are in progress. All these three should happen. Only then you will start capitalization. Coming to a question to understand this. Arham Limited. This is my answer, but I will show you the answer only if required. Otherwise, we will just discuss and move. Arham Limited purchased a land for constructing a building. Entity took a loan of 50 lakhs from some bank for constructing the same. Construction started only on 30th September. See, they took a loan on 1st April, but they started the construction only on 30th September. So once the loan is taken, BC is being incurred. Expenditure on QA, whether it is incurred, we have to check. Prior to this period, no work took place at the site. Can they capitalize the borrowing cost? Can they capitalize? No, because the necessary activity, that is expenditure on QA not incurred, necessary activities also did not start, so it cannot be capitalized. Next thing, they purchase a land for constructing the building. The loan is borrowed for the purpose of construction. So BC is being incurred, okay? The company started, because the loan is borrowed on 1st April. The construction started only on 30th June. It took 3 months to get approval of the authority. Can approval of authority be considered as necessary activities in progress? Yes. Because without that, the moment you've started, what is that, going for approval, it means you're already working on the building. Whether you physically construct is not what the standard tells us. Even if you're doing designing work or getting approvals, even that will be considered as a necessary activity. So capitalization will begin from 1st April itself. From the date loan is taken, you put it in the land. You invest in the land. So even expenditure on QA incurred. Third, necessary activity is also in progress. Here, next learning which should happen is, I have started the construction, but in between construction is getting suspended, temporarily stopped. In that period of stopping, temporary delay, can I capitalize the borrowing cost? Standard tells no. If the necessary activities are interrupted temporarily, during that period of interruption, capitalization should not happen. I will now show you the provisions for it. A16 snapshot. Suspension. When necessary activities are interrupted. Here there is an exception which you should understand. Suppose the temporary interruption is necessary part of the construction process. Here the classic example which they give you is, say, wine production. Wine is also a qualifying asset because it necessarily takes a substantial period of time to get ready for its intended sale. Okay, I'm going to sell wine. Once I have purchased the grapes, I have made it into grape juice. I started the necessary activities. Once the grape juice is done, I store it in containers and keep it for the next few years. That time, no activity is happening. But even though no activity is happening, that process is necessary for the wine to get ready. So can you tell that the necessary activities has got interrupted? No, it is a necessary part of getting the asset ready for its intended use, so capitalization need not be suspended. There is no question on this in the study material. The question is on this now. So this is important for you to learn the provision. If the delay which is happening is common during the construction period in the geographical region, then capitalization need not be suspended. What do I mean by this? We will go through an example. I've given ninth one already given as an example. We will, yeah. Harsha Limited is constructing a bridge on the river in Maharashtra. River is having high water levels, which is common in that period, and during that time, construction had to be suspended. Can the company capitalize BC during that period of interruption? Yes. Why? Because delay is due to delay is common, or it is due to a reason which is common in that geographical region. Here they give you two examples. One is flood, other can be rain, or the water levels in that river is high. That's all. These are the only three examples they will test you on, and they will not give you a separate question like this. I will show you that how it can be included in a bigger question. I will take up one question next. Heavy rains, again similar example. Now, when should the capitalization stop? What are we discussing? Period of capitalization, commencement, cessation. Commencement, three conditions. BC is being incurred, expenditure on QA is being incurred, necessary activities are in progress. Cessation means the asset is ready to use. That's all. But here little more elaboration has been given by the standard. When I tell asset is ready to be used or to sell, okay, asset is ready for its intended use or sale, that time capitalization should stop. Here the standard setter tells if the asset is substantially complete, also capitalization can stop. The word substantially is crucial, which means it is not necessary that 100% asset is over. Even if minor modifications are pending, small work is pending, still capitalization can stop at that point of time. So even though routine work or minor modifications is pending, asset can be considered as substantially complete. If you are answering a question on cessation, what word is expected from you is capitalization should stop when the necessary activities are substantially completed or substantially over. So what should be there? Necessary activities should be there. Substantial word should be there. Okay, till here done. Period is over with this. There is some extra special cases I would tell. Now we are going to discuss on a special case. Special case here is, suppose a qualifying asset has multiple parts in it. For example, they are telling that you are constructing a building. Building is having multiple floors, and once ground floor is completed, you can start using the ground floor. Thereafter, first floor construction will begin. Then second floor, and then third floor. We are going floor wise, we are going to construct. And the moment one floor is over, you can start using that floor. In such a case, what AS 16 tells is, this portion is completed. It is ready for its intended use. So cessation should happen here. That is, capitalization should stop for that completed part alone. You can continue for the rest of the build. For that completed part, you should stop. So proportionately, you will stop capitalization for that part. Suppose you tell that no, we are constructing a machinery. Machinery also has a lot of parts in it. There are some 5 parts in it, 6 parts. 6 parts in it. Only if all the parts are completed, only then I can start using the machinery. In that scenario, can you stop capitalization in between if one part is over? No. It's very logical, nothing new that we are learning about it. Here, the asset is not ready for its intended use or sale without entire asset getting completed. Let us get familiarized with the provisions here. When qualifying asset is completed in parts. Sorry, when qualifying asset consists of various parts, capitalization should be stopped when any completed part is capable of being used while construction continues on other parts. There is a study material question on this. We will be going over that question in some time. I'll finish off with that otherwise. It will involve other things also. So I will come to it in some time. Cessation, understood. Now I'm going to move to the cessation. I will come to the question part afterwards. Moving to the next thing. 3 factors required for capitalization: amount, period, rate. So when you're reading a question, your mind should start searching for amount of borrowing, rate of interest, and period. This your mind should start searching for. Period, finished. Now we are entering into rate of interest. Of course, rate of interest, what we have learned is when we do interest calculation, the rate of interest will be the rate at which you borrowed the money. Of course, yes, that is only the answer, that whether it is actual borrow, it should be the actual rate of interest. Before I enter into more into discussion of rate of interest, we have to get familiarized with something else. So I am moving away from rate of interest and getting into something called as nature of borrowings. Now, what does nature of borrowing mean is there are 2 types which the standard tells. This is peculiar, this is specific only to AS16. We generally don't use this in the common parlance. Whether you have one loan funding the qualifying asset, if that is the case, that is you have borrowed the money specifically for the acquisition, construction or production of a qualifying asset, then that borrowing will be called as specific borrowing. Suppose the borrowing is there, but you did not borrow specifically for this qualifying asset, but you're using it for the qualifying asset. It will be called as general borrowing. I have tried to break this down into a relationship. You would have learned in school, 1 to 1, 1 to many, many to 1, many to many, that kind of relationship. I have tried to break it down to that relationship to easily understand. This provision not necessary to learn. Suppose one loan for one qualifying asset, it is called specific borrowing. One loan for multiple qualifying asset will also be called as specific borrowing. Please don't think that only this means specific borrowing. Suppose you're borrowing the loan and you're using it for these qualifying asset. The loan was borrowed only for the purpose of qualifying asset, even though they are multiple. So this will also be called as specific borrowing only. Now, what is general borrowing is many to one relationship. There are many loans and you're using it for qualifying asset. You are not specifically deciding that now many loans means, does not mean all the loans total is used for qualifying asset. That is not what I'm trying to say. You have 3 loans there. Some portion from every loan you're using it for qualifying asset. This loan is put to multiple uses. It can be used for working capital purposes also. It is being used at the same time. There is also many to many relationship, but at inter level you don't have it. It will come to you at final level. Surely you will learn it under Ind AS category, but still borrowing cost is the standard which will again repeat for you at final level also. So many to many, I have not shown it here. Now, amount to be capitalized. Here, I understand that I have to give you rate of interest. So I will skip this for now and then come back. We will finish off with rate of interest. There are 2 rate of interest which is possible. One is the actual borrowing rate. 2 is the weighted average borrowing rate. When is weighted average borrowing rate relevant? Is whenever you have multiple borrowings, you need to find out the average borrowing rate of those borrowings. Hence, for this category, specific borrowings, what rate of interest will be applicable? Actual rate of interest. And for general borrowings, what will be applicable? Weighted average borrowing rate. Weighted average borrowing rate can otherwise be called as capitalization rate. This is the common parlance word which we use. What does AS16 use? Capitalization rate. So in exam, preferable to use the word capitalization rate. Anyway, no provision is required on this. You will only be using this on computation part. Measurement is totally, you don't have to remember anything. You only have to understand things. So here I'm not focusing on making you repeat the definition. It's not necessary. Okay, so rate of interest, there are two possibilities. What are the two possibilities? Actual borrowing rate or weighted average borrowing rate. So what are the three things which we need for calculation of interest? Amount, rate, period. Rate of interest we have understood. Now this rate, on what number should you apply is the question. If it is specific borrowing, you will apply it on whatever amount you borrowed. And if it is general borrowing, you cannot apply it on the amount borrowed because that entire amount borrowed has not been used for the qualifying asset. You have used multiple places. So you will apply that rate on the expenditure on QA, which means how much ever you use for the qualifying asset, only on that interest can be capitalized. You can't capitalize interest on a borrowing which you did not use for qualifying asset. Makes sense. That's why for general borrowings, apply rate on expenditure on QA, and for specific borrowing, apply it on the borrowed amount itself. Understood? Now I am going to go over this amount to be capitalized. Amount to be capitalized for specific borrowing will be the actual BC incurred. Don't even go through the other things now. Actual BC incurred. For general borrowings, it will be apply the capitalization rate on the expenditure on QA. Suppose the period for this year, the construction did not begin from the beginning of the year till the end. It started somewhere in the middle of the year. Then you will have to calculate only for the period for which the construction is happened. That's why period is also come into picture. Okay, now we will see a question on this. Yeah, we are going to see this question. Gajendra Limited is constructing a building at Hyderabad. Estimated expenditure is 20 crores. It took a loan for 15 crores at 10% from SBI, specifically for the 20 crore is the expenditure. It took a borrowing only for 15 crores. Rate of interest is 10%, and it is used for construction of the asset. Whenever you read a question, first thing what you should check is it a specific or a general borrowing? Answer is it is a specific borrowing. So apply the rate of interest on the borrowed amount. 15 crore into 10% comes to 1.5. Out of that entire money, some portion was kept in fixed deposit and you earned a small income out of it. Suppose you have earned an income out of it, you can deduct it from this interest cost. Only the net interest should be capitalized. This is not the first place we are coming across like this. Suppose you are doing, we have learned under net selling price. Suppose you have earned money by selling an asset, but you also had to incur some cost of disposal. You netted off. Here also you are incurring some cost on the borrowing, but on the other hand, you are getting some income also. You can net it off and then capitalize. Under AS10 also you learned it. Suppose you have demolished a building. Demolition had some cost, but by selling that whatever salvage, you got some income. So what did you capitalize as part of cost of PP? Netted off and then capitalized. Netting off is part of every accounting standard, nothing new in this. So amount to be capitalized for specific borrowing is actual BC incurred. This you have to learn it. It is necessary for you to write the provision when you are doing a question on this model. Actual BC incurred minus income from temporary investment of the borrowing will give you the BC to be capitalized. Now we will start doing some questions on this specific. Now that's all. Provision wise I'm through with. We will do questions on specific and general borrowing. We are going to do study material question number 9. So if you have a study material at home, whoever have at home, please ensure that you open the study material. Yes, 16 notes. If I sit to work out all the questions, it takes too much of time. That's why I will discuss some and I will work out only a few. We will read the question. Amazing Construction obtains a loan of 32 crores to be utilized as under. They are telling that they have borrowed one loan. If it is one loan only, you will take it as specific borrowing. If it is multiple loan, you will take it as general borrowing. They have used the loan as follows. For construction of a ceiling, 25 crores. Work was held up for a month during the year due to high water levels. Which provision is relevant for this? Suspension of capitalization. So when you read the question, you have to understand what all provisions will fall relevant for this. Next, purchase of equipment and machinery. Third, working capital. You're using the loan for multiple reasons. Working capital, purchase of vehicles, advance for tools, purchase of technical know-how. Total interest is given to you in the question itself. They are not asking you to calculate the interest on this. Even though no rate is also given. So 32 crores is the loan amount, 80 lakhs is the interest. How much of this interest can be capitalized is the question. Show the treatment of interest. Okay, now let us understand what all provisions are relevant here. First thing, this question is asking you on what is the treatment of interest, which means you will have to write BC that are directly attributable to, can we repeat it, directly attributable to the acquisition, construction or production of a qualifying asset should be capitalized as as part of cost of the asset. Other BC should be charged off to P&L in the period in which they are incurred. So that meaning you will have to give first. Next, period of capitalization. Commencement of capitalization, please don't write. The question is not testing you on commencement. They're not asking you when should I start capitalization. Only suspension. Now, how are you going to present the provisions also is, when you're writing the provision, preferable to give a side heading for every provision. You need not write it in capital letters, nothing. Suppose you're writing this, no? You write BC eligible for capitalization. Underline. Write the provision. Next, we will write suspension of capitalization. Capitalization should be suspended when necessary activities are not in progress. However, if the suspension is due to an activity which is common in that geographic region, capitalization need not be suspended. So you'll have to tell about that provision. Next, can you capitalize the borrowing cost of all of these assets? No, because purchasing equipment, working capital, all these are not qualifying assets. So the next provision which you will write is qualifying asset meaning. Qualifying asset is, can we complete the sentence, is an asset that necessarily takes a substantial period of time to get ready for its intended use or sale. That's all. These three provisions you write with side headings. You need not write provisions, underline, then write not necessary. You give side headings and write the provision, after which we will write analysis. If you have time, write analysis, word, underline, then write. Otherwise, just start. In the given case, start off as a new paragraph. In the given case, you can tell the construction was suspended due to high water levels, which is common in that region. Hence, capitalization need not be suspended during that period. So you are answering for this. Okay. Next, you have to find out what is the BC to be capitalized. Of course, these are not qualifying assets, but before we tell that, you present the answer in the form of a table like this. How to decide on the columns in the table? Let me also show you that, because you cannot by heart the columns of the table and go there. What the question gives you information, the question gives you information on particulars, that is whatever is the amount spent on, and amount. You need to decide what is the interest that will be capitalized and what is the interest that will be charged off to P&L. To decide on this, you will have to tell which is a qualifying asset. So the columns will be particulars, amount, qualifying asset, this and this. If you are unable to recall back the columns in the exam, for worst come worst, you will have to write everything one by one below the other. Waste of time. That's why it is better to go for a tabular presentation. But take some time in understanding what and all you're going to present in the table, and then decide on the columns which you're going to give for the table. Okay, now we will finish off this question in this table itself. This is a qualifying asset. This we will write not QA, like that for all the ethics. Because purchasing equipment is ready to use. Working capital cannot be anything to do with qualifying. Vehicle also you can use it immediately. Advance for tool or crane will also be taken that way. Purchase of technical know-how is also ready to use. So everything is not a QA, only one is a QA. Now, how to decide on the BC to be capitalized computation part? Can we do it? Can we all do it in the calculator? Please can you take out a calculator and work out and tell me what is the BC to be capitalized for ceiling? We will have Rita is there, okay. Anybody online can turn on your mic and tell the answer if once you have calculated the BC to be capitalized. Have you completed? BC to be capitalized. Yeah. Did you get 62,50,000? Not got. Okay. If anyone has not got it, anyone who has not got it, I will also explain how to get it there. The total interest on the borrowing. Total interest is 80 lakhs. The loan that we have taken is 32 crores. For the loan amount of 32 crores, interest is 80 lakhs. How much of the loan fund you have utilized for this? 25. So you'll have to do proportional calculation. I think interest I should have written afterwards. That's why 32 crores is 80 lakhs for 32 crore, for 24 crore, 25 crore, how much? If you calculate, you will be able to get 62,50,000. All the other interest, like this similar way, you will calculate the other interest also. All the other interest will be, you will show in the next column as charge off to P&L. Okay, so this model question, there are quite many questions in this study material on this model, and also one minute. Okay, even in the RTP it is there. I will finish off this, then we will come to the RTP. 3 RTP questions we will go through. The September, May and Jan. Last 3 RTP questions also we will be going through. So our coverage in the class is study material plus RTP. Past exam question, if whatever it is also included here, whatever relevant, I will also cover that also. Next, we are moving to this question where QA is completed in parts. I will read the question. You will tell me whether it is a specific borrowing or a general borrowing. Let us read the question and understand. Harish Construction Company is constructing a huge building project consisting of 4 phases. It is expected that the full building will be constructed over several years, but phase 1 and 2 will be started as soon as they are completed. So while 3 and 4 construction can continue, 1 and 2 can be used. So if a QA consists of various parts, can we recollect the provision? If a QA consists of various parts, then cessation, capitalization of BC should stop when the completed part can be used while construction continues on the other parts. This is relevant for this because they are talking about parts here. So when you start reading, your mind should start applying that what provision should be written here. For that, you should be clearly, all the provisions should be arranged in a proper way in your mind. Mind mapping of the provision should be there. Only then you will be able to apply it in a question. If that mind mapping is not clear, then you will not be able to pick the right provision and write it. Okay, now they give you the details of the phases. They are giving you the expenditure on the phases, expenditures phase wise. During the mid of the current year, phase 1 and 2 have become operational. Find out the amount to be capitalized. Loan taken is 200 lakhs. Interest is 15%. Only one loan amount given, so it is a specific borrowing. One borrowing is funding one asset, but that asset consists of various parts. So what provisions should be written here? Let us discuss that first. Then we will go over the suggested answer, which I will show it later. What all provisions are relevant? We will. First thing, BC eligible for capitalization. Any question on BC to be capitalized, the crux of A16 should be repeated. Can we repeat the provision? BC that are directly attributable to the acquisition, construction or production of a qualifying asset should be capitalized as part of cost of the asset. Other BC should be charged off to P&L. This is the first provision. Second, I told you that if it is completed in parts, that capitalization should stop while construction continues on the other parts, because this part can be used when the construction is over. Okay, having written these two provisions sufficient. In the given case, phase 1 and 2 become operational while construction continues on phase 3 and 4. Hence, capitalization for phase 1 and 2 should be stopped during the middle of the current year. Use whatever is language is in the question only and frame out the sentence. Or you can tell what is the accounting year followed. Not given. So middle of the current year, which means 6 months. Middle of the current year you tell. They don't have dates, so you're not writing dates. Okay, we have told about the when should it stop. Next, you'll have to talk about the amount wise. So we will get into the calculation now. For calculation, I have presented the answer here in a table. If you can think through with a table, okay. Otherwise, you go one below the other also. I will do one below the other first. Let us understand that. Then I will show you a better presentation in the form of a table. 1 minute, I'll open the right file. Yeah. We will do phase 1. Interest calculation. Thereafter, you'll understand other phases. Here. How 200 lakhs has been taken. Phase 1, we are going to calculate the interest. 15% is the rate of interest. Check in the question, whenever there is a specific borrowing, is there any income that is earned by temporary investment of the borrowed amount? If that is there, you'll have to deduct that from the total interest. In this question, it is not there. Okay. Now we will apply the 200 lakhs has been borrowed. On this, 15% is the interest. So 200 into 15% comes to 30 lakhs. In the previous question, they did not give you, they did not make you do this calculation. In Amazing Construction, they gave you that 80 lakhs directly. In this, we have calculated that first. After having calculated this interest, next, if there is any temporary income, you will have a loan from, that is not temporary income, income from temporary investment of the borrowed amount. you will deduct it and find out the net interest. That is the step one. If you are doing such a calculation where you're deducting the income from temporary investment, before this you will have to write the provision. BC to be capitalized for specific borrowing is amount to be BC actual BC incurred minus this BC to be capitalized. That provision should be written if you're using it. Otherwise, don't write it. Not necessary. I'm not using it. Okay. Now 30 lakhs is the interest. We will get into phase 1. We are not using the entire 200 lakhs for phase 1 only. We have spent 34 on phase 1. The amount borrowed is 200, whereas total expenditure is 221. Okay, 221. 34 divide now 34 should be expenditure is 34 for phase 1, but total expenditure is 221. For 221 expenditure, interest is 30 lakhs. For this, how much? Able to see what proportion I have done? Expenditure versus interest is the comparison. For 221 expenditure, the interest was 30 lakhs. So for 34 lakhs expenditure, how much is the interest? Can we do it in the calculator? 30 into 24, 34 divided by 221. Are you getting 4.61? Yes. So this is the interest that is related to phase 1. Interest for phase 1 is 4.61. We are not going for tabular presentation. We are going for the usual normal thing. Okay, there. Now from there, for phase 1, what we have understood, can we capitalize the end? Now every phase I'm going to write BC to be capitalized, BC to be capitalized. I will end the answer. Okay, either you can do phase wise or you can give a total in the end. I want to finish off then and there. BC to be capitalized. Can the entire amount be capitalized? Can the entire amount be capitalized? No. Why? Middle of the year, phase 1 got over, right? So till it is complete, only you can capitalize. After it is complete, you will have to charge off to P&L. So you have to present that as 4.61 divided by 2. 2.305 can be capitalized. 2.305 will be charged off to P&L. Bifurcate like this, and how should you present it is, I repeat, I have shown it like this. You will write under first part BC to be capitalized. Next part you will write interest to be charged off to P&L. You will write like this and show it as a presentation. Next, phase 2 also same way you're going to do. 64 divided by 221 into 30. You will get 8.61. From 8.61 you will divide it. BC to be capitalized. Interest to be, now you will not write BC to be charged off to P&L. I wouldn't tell it's right. If it is charged off to P&L, it is not a borrowing cost. Only that can be capitalized is called as borrowing cost. So if you write BC to be capitalized, or you write interest to be capitalized and interest to be charged to P&L. But if you write BC to be charged to P&L, I don't agree with that terminology. Next, phase 3 and 4 also you will calculate the interest. Okay, proportionately. And you will tell the end that from that 7.47 you write arrow mark down BC to be capitalized or interest to be capitalized. There is no bifurcation to be done for 3 and 4. Clear with the answer? This is your presentation expected for this answer. So what have we done? We have shown provisions. Thereafter, in analysis, we have told that this thing will stop, and then we have shown the computation. Finally, end the answer with the conclusion. What conclusion should be written here is, you will have to write as follows. 1. Total BC capitalized equal to, add up phase 1 and 2, add up and write the number. It is necessary that you show like this in the end. Next, interest charged to P&L. Add all the 4 numbers from 1, 2, 3, 4 phases, add it, show it. With this, your answer is complete. If it comes, it will come for 7 marks. 6 to 7 marks can be categorized for this question. Okay, study material questions also, whichever are different only I'm taking up. For example, this is again a study. On this model, there are many questions. Amazing construction company, same model, this question is also. I'm not going over this. So by the end, you would have covered all the study material questions. That's for sure. Whatever are different is covered here. Now I'm coming to general borrowings. We are done with specific borrowings. We did two model questions. One was one loan funding multiple QA. There is one RTP question on this model again. I will show you the RTPs afterwards on this model. Next question, what we did for specific borrowing is one loan funding, one QA only. But this QA has multiple parts. This is the second model. That's all. No other model possible under specific borrowing. Now we move to general borrowings. It's not here. No. Can you check with the PC sir about the AC remote? General borrowings. If the window is this size also, is it visible to you? Online, whoever are there, is this font or the size of my writing visible to you? If I split my screen into three portions, still is it visible, Shalini?
27, 28.
Yes, ma'am.
Okay.
Yes,
Okay, Shalini.
yes, ma'am.
Okay.
28.
Now coming to general borrowings. So general borrowing, we will recollect back what we see to be capitalized. For interest calculation, first I will write amount, rate, period. Our questions in exam does not test you more on period for general borrowings. The focus is only on these two at inter-level. Final level will take you to the next level for general borrowings. Okay, so what you're doing is very, very basic questions where not all provisions are tested. Yeah. What is the amount? What is the rate for this? We'll start with the rate. What rate are you going to use for general borrowings? Weighted average rate. You will have to find out the weighted average rate, which is the capitalization rate. So first, I will teach you how to do capitalization rate. Okay, when we come to questions. On what will you apply the rate? On what will you apply the rate? Expenditure on QA. Not the borrowed amount, but on expenditure on QA. Expenditure on QA into capitalization rate. Period will generally be 12-month period only for us. Just to get familiarized with this, I'm going to take up this question, study material question. Rainbow Limited borrowed 150 crores for construction of a boiler plant at 10%. The plant is expected to be completed in 4 years. Weighted average cost of capital is 13% per annum. This is nothing but capitalization rate. Accountant of Rainbow Limited capitalized 19.5 crores for the accounting period 31st March. Can you find out how did that 19.5 crores come? What rate has been used to arrive at 19.5 crores? Whoever are online, I will appreciate if you send me the, if you keep messaging, use the message thing and send me the answers. I want to know whether you are listening, you are attentive. Whether I see or not immediately, I want you are to message me something if possible. If I ask you to do a computation, please ensure that you send me messages. Okay. Yes. Did you find out what rate has been used? 13% or 11%? 13% has been used. So 150 crore borrowed. They have given you the actual borrowing rate 11% and the capitalization rate 13%, and they are asking you, is the accountant correct in doing it? Little more information is also there. Due to surplus funds, out of that 150 crore, something was earned by temporary investment of the fund. Discuss about the above accounting treatment. Is the accountant correct? No. Which rate should be applied? Actual borrowing rate or weighted average borrowing rate? To decide it, what should you decide on the nature of borrowings? Is this a specific borrowing or a general borrowing? There is one loan, 150 crores. You're using it for construction of boiler plant. When what you're going to search in the question is, are there multiple borrowings or are there multiple assets? See, even if you're going wrong, again I repeat, whoever are online, even if you're wrong, it's totally fine, but I want to see some messages. Okay, so if in this question there is only one loan amount, if there are multiple loan amounts, you will tell it is general borrowing. One loan amount, one asset, it is a specific borrowing. For specific borrowing, what is the rate of interest? Actual rate of interest, actual borrowing rate. You will not tell rate of interest, you will tell borrowing rate, actual borrowing rate. So in this case, the accountant has applied the weighted average borrowing rate, which is not correct. But writing this, answering this question is more on the skill of presentation rather than on computation. What all provisions are we going to write? Are we going to write here BC that are directly attributable to? Are we going to write that provision? Not required. Are you calculating what amount of capitalization should happen? No. What is the question on? What rate should have been used by the accountant? So only go over the provisions that are relevant for the rate choosing. What are the provisions? Now here, how will I write? How will we approach? Nature of borrowings. You can start it like this. If you have a provision as sentence, you write a sentence. As much as possible, try for tabular presentation, chart presentation that makes your answer look better. That's why that snapshot will help you to bring that presentation in your exam. Suddenly in the exam sitting, you're not going to come up with new charts, visualize and then write. That is not going to happen. You should have learned it by way of some present. You should be clear in your mind that if this provision comes, I will write it like this. In your mind, you should be clear with the process, only then it will happen. Here, borrowings, you can write general. We will write specific first and then general. For specific borrowings, use actual borrowing rate. For general borrowings, use weighted average borrowing rate, or you write capitalization rate. But here better to use weighted average because question uses that word. Okay, weighted average borrowing rate. Then this is one provision. What is the next provision which you will write? On which amount? Amount also. What is the other thing which you have to get tested on? 3.5 crores. Income from temp. So you'll have to write, in case of specific borrowing, BC to be capitalized is computed as follows. Actual BC incurred minus income from temporary investment of borrowed funds will give you the BC to be capitalized. Write that and then begin your answer. This much provision written, and of course you will start with as per AS 16, that is understood, because in the exam you are going to have multiple accounting standards.
Can we write boiler as a qualifying asset before all of this?
Not necessary. Yeah. You can write that also.
One line of it is a qualifying
asset. It is a qualifying asset. If you want, you write, but I would not really see it is important because the question is where the accountant is only having a confusion on what is the amount to be capitalized. No, see, he tells accountant has capitalized this for the accounting period. He is not having a doubt whether I should capitalize or not. So I need not decide on whether it is a qualifying asset or not. He is clear with that. Why should I tell something which he already knows? Makes no sense. That's why I'm not talking about it. Yeah.
The 4-mark question is looked because my answer will be.
If you think of a provision in that, the question will involve a lot of things, but this is just told for you to decide that it is a qualifying asset for you. I don't remember the name of a person. Some person has sent me a depreciation answer. She started the answer with what is the meaning of depreciation, and then only she did all the calculation. Provision wise, as much as possible, take bare minimum. If you take too many, it's okay. Examiner will be okay, but you are only going to waste time. You will not have time to complete the paper because somewhere some question is going to get stuck. Let us be how much ever you study and go, somewhere you're going to get stuck. Somewhere you can't move forward. you will waste time, so don't take too many provisions. After having done that, in the given case, you will have to write your answer like this. You will present it and tell this is the amount to be capitalized. Okay, so we are done with this question. Next, I want to take up a question on capitalization rate computation. I want to do, now there was an MTP question. I am working out some other question of similar model now. But before I work out this, I thought let me do a simpler question and then come to a little more complex question. If I do complex directly, it may get difficult for you to understand the concept. Capitalization rate is important if you're doing a question on general borrowings. I think another, 15 minutes, I think general borrowing should be through with. Capitalization rate, we will fix the formula first. I have not shown you the formula in the only way to come to that is to accept from the it's a responding slope is 16 snapshot. Let this be here because I'll also show you the formula once we derive the formula. Capitalization rate is nothing but weighted average borrowing cost, weighted average interest. I have to arrive at this formula. Let us write down what is the formula for interest. If I have to tell you what is the interest in terms of rate of interest, what is the formula? Interest divided by loan amount, I'm writing here borrowings, into 100. This is the interest formula. But in our general borrowing scenario, we will have multiple borrowings. So the denominator I'm going to now modify to multiple borrowings. Total interest on all the borrowings put together will be in the numerator. Division will be borrowings which is there, total borrowings, total interest divided by total borrowings. But what will happen is borrowings may not happen at the beginning of the year. It may also happen during the year. So we will tell that borrowing which is there, we will have to find out the weighted average of the borrowings. Okay, it's see when the borrowings change during the year, you will have to average out the borrowings to find out a single number which represents the total borrowings. Hence, if the borrowings are changing, in that case, you will have to find out the average of those borrowings, weighted average of the borrowings outstanding during the year into 100. Okay, capitalization formula, if you remember it good, otherwise even in the exam, you run the process in your mind about the interest rate and then arrive at the formula. I'll show you the formula. Capitalization rate is borrowing cost. Interest only I've written here. This is the what I've written. Interest on, I have given the word general borrowings because in a question we will also come across specific borrowings some places. And weighted average general borrowings outstanding during the period into 100. Okay, now we will quickly finish up with this question. This is very simple. Total interest, can we just calculate in the calculator? Total interest on these, there are 3 funds, okay? 3 borrowed funds. We'll have to find out the interest on it. 10% into 88, 20 into 12%, 2.4, 50 into 9%, 4.5. I will add up the total 8 plus 2.4 plus 4.5. 14.9 is the total interest. Numerator done. In the denominator comes the total borrowings. Did these borrowings change during the year? Meaning were they outstanding from the beginning to the end, or was there any changes? No changes. So you need not average out. If there are changes, then average out. No changes, so what will be the denominator? 150. So 14.9 divided by 150 percentage, the capitalization rate will be 9.93. Okay, now I'm entering into the next model question for this. or I'll come to this question later after the break. We will, because we're used to this, we will finish off one question in this model. That is a little different. 28th question, it's an illustration 2 question. This question only I'm going to give you for homework. I am showing the question also. I will post it in the group at the end. This question will be on specific and general borrowing, both put together. You will have to calculate what is the BC to be capitalized. X Limited began construction of a new building on 1st January. Just let the answer be there. Wherever required only I will show the answer. Otherwise we will do the computation as much as possible. X Limited began construction. It obtained 1 lakh specific borrowing to finance the construction of the building on 1st January at an interest rate of 10%. So there is a specific borrowing. Specific borrowing is 1 lakh rupees at 10% rate of interest. Then they tell you there are non-specific loans also, and there are 2 loans given. These loans, did they tell you that they borrowed on this date or they have repaid on this date? Nothing like that is there. It is a straight borrowing which was outstanding from the beginning till the end of the year. In this case, let us this is a non-specific borrowing, so which means capitalization rate is necessary. Can we just calculate the capitalization rate? Capitalization rate is nothing but numerator will have the total interest divided by total loan amount. I am writing loan amount, it's actually borrowing, into 100. Can we do it in the calculator? What is the total interest? 5 lakhs into 11% M plus 9 lakhs into 13% M plus MRC 1,72,000 divided by total borrowings. I'm just adding up the borrowings. 14 lakhs into 100. 12.29%. 12.285% approx is what study material takes it. Even if you round it off to nearest multiple is okay. 12.29%. Okay. So now let us come back to the provision. For specific borrowing, what is the BC to be capitalized? Specific borrowing, actual borrowing cost, actual BC incurred. For general borrowing, what should you apply the capitalization rate? On what should you apply the capitalization rate? Expenditure on QA. Okay. Now what is relevant for general borrowing is expenditure on QA also is required. So now next information is given to you. You should know what information is required. It will be easy for you to decode in approaching the question. Expenditures, they are not giving you one expenditure. They are giving you multiple expenditures. They are giving you multiple expenditures happening on different dates. Multiple expenditure happening on different dates. January, April, July, December, and these numbers are given. To apply in that formula, expenditure on QA into capitalization rate, period is nothing but they have started the building on 1st January. Come back. They've started the expenditure on 1st January and they will end it at the end of the year. Okay, they will generally not, they have not, have they given the period? Yeah, they are following Jan to December only because they end with December. Okay, at least the asset gets over by December. So 12-month period only. Now expenditure on QA, one number is required. What is there is multiple numbers. So how will you bring out one number out of multiple numbers? How should you find out one number of multiple numbers? One number representative of the entire array of numbers. There are 3 techniques: mean, median, mode. All accounting standards only use mean technique. Mode and median, no accounting standard uses for finding out one number representative of an array of numbers. Get that very clear. This same technique is used even for AS20 EPS calculation. You have to find out the weighted average of the shares because shares keep changing. What do? You have to find out one number on for the entire year's shares. What will you do? Average out. And averaging also, there are two types: simple average and weighted average. The standard will prefer you to use weighted average only always, wherever you see. Even for the loan amount, we were asked to use weighted average only. But here, anyway, no changes happened, so I used it as simple average. Weighted average only should be used. Now, when I have to approach weighted average I have to find out for expenditure on QA. Weighted average formula is summation XW divided by summation W. So I have to fix XW, XW. Then only I will be able to find out the answer. I'm using statistical thing only. Now only I'm going to link it with accounting. What should be my X means expenditure. This is only my X. What will be the weights? The period will be the weights. Generally, periods only go as weights. Even if you recollect back AS20, shares will be X, weights will be period. If you remember that standard, I want to, bring, now that we know all the standards, I want to bring parallels between all the standards. So expenditure, period, and then you will going to do product. Always remember one thing, that 1 minute. Period, when you are taking, that sum of weights will be 12. If period is months, sum of weights will be 12. Don't add the period and find out the sum of, that is, sum of weights should not be added as such. Period will be taken as 12 months as the sum of weights. Let's start with the filling up of the table now. 2 lakh, or I will just show you how it is filled up. We have understood the concept. I have included month extra just to help us calculate the period. If you want, include. Don't want, okay, you will calculate in your mind and then write it. I have written all the expenditures here. Next, period should be calculated. Period means from the start of the construction date till the end of the accounting year. Jan to December year. So for first thing, it is 12 month. I'm assuming that expenditure happens at the beginning of the month. Until unless question tells, I'll take it at the beginning only. Generally, you're not going to be tested on that also. Beginning date, 12 months, 9, 6, 1. I counted the number of months and I've written. Find the product and then X summation XW divided by summation W. Sum of which should always be 12. That you get it very clear in your mind. Whether it is here or whether it is AS20, where even there period will be in terms of months, and there also you will take only 12. This will be called as average accumulated expenditure. Average accumulated expenditure. Now we are going to come to BC to be capitalized. What all have we done? I will remove this out from the screen. We will arrive at the answer. How much have we spent on the asset? Average accumulated expenditure 622 500. This is the average. This is not entirely funded from general borrowings. It is also funded from specific borrowings. So the portion from specific borrowing we will find out first and then from general borrowing. Portion from specific borrowing is 1 lakh. For specific borrowing, apply the actual rate of interest on the actual borrowed amount to get the actual BC income. There you don't have to apply capitalization rate. You will apply it on the actual borrowed amount itself. 1 lakh into whatever is the rate, I think 10% will be the 10,000. General borrowings, how much has been funded by general borrowings then? Total amount spent is 622 500. Out of that, 1 lakh gone for specific. General will be 522 500. On this, apply 12.29%. You will get the This will give you the BC to be capitalized. Addition of these two. I end up the answer by telling, see, the question tells you calculate. You please read the question very clearly, find out what is required, and then only end the answer. Because sometimes I've seen, when I was running the regular batch, we had tests. There will be some who finish all the answers, but in the conclusion, they don't give me the find what I'm looking out for. I should see in the conclusion. If I don't get it, I will deduct a 1 mark, 1.5 mark for them. That's all. Because the examiner will have an answer key which will have the conclusion only very clearly for him. That is not there. Why will I have to spend time in going through so much which I don't need? I will see with what I need should be there. The best presentation will deserve the highest mark. If you make the examiner search for things, he will give you a mark, but he will reduce it to that extent also. So, and what should be there? So, how will you conclude the answer? If I were to conclude it, how I will be doing it is, what all is required, I will see. Amount of interest to be capitalized. So, I will write conclusion. If you want to write conclusion, always leave some space. Just start writing down. BC to be capitalized. You can tell it is already shown here. I will write it here. 74189. Show the number that this is the total number. Next, pass a journal entry for capitalizing the cost of borrowing in respect of the building. So I am asked now to pass the journal entry also. If you did not read this, you will stop with this and move ahead. You will lose that mark for journal entry then. Journal entry is very simple. It's just building account debit. I'm scribbling here. Please don't mind. I'm telling what I'm scribbling, so you should understand my scribbling here. Building to bank. The amount is the next thing. How much amount? I can add it in the calculate update, but let me show it. Amount spent, that is cost, or I can write cost incurred on the building, is equal to summation of all this. Please don't use average accumulated expenditure here. That averaging out was used only for the purpose of calculating interest, but that does not change the amount spent. So addition of all this, I don't want to spend time. Addition of all this comes to 10,20,000. That is the actual expenditure. Plus the BC to be capitalized. I get 1094189. This number written in the journal. So write the entry, write the calculation below and update it. But in my presentation, I knew that this is required. So I did that and then came back. It's your, you may not be able to think through that much. You write it there. Is this question clearer? During the break will run for at least 45 minutes from my side. So during the break, you can go rest, eat, do everything. Come back, finish off this question, 29th question. I will share this in this file itself. Okay, from that file, you search for 29th question, work out the question. Post break, we are only left with one thing, which is foreign currency borrowing exchange differences. That's all. With this, AS16 will be through with. And one question in between, I told capitalization rate, I skipped some RTP question. So half an hour post break, I'm going to finish up with AS16. And next standard which I'm going to take is AS19. There is also another important standard from a computation viewpoint and provision viewpoint. So I'm taking the next standard, AS19. After 19, if by chance I have, I'm targeting that I should have time after that. So I'm telling you my order, so that if you want to revise and come back also, it is up to you. 19, and after 19, I'm going to finish off with 2. Inventories. Tomorrow's class, we are going to use everything. MCQ is not for today. Let us complete decent number of standards and then we will do MCQ. Once all asset related standards are through with, asset related not exactly from a study mental viewpoint, whichever I feel can be linked along with assets, everything through with, then only it will make sense in going through the MCQ. So tomorrow only MCQ will come. Today will be core only questions from study material, past exam, RTP should be completed. Okay, we are stopping here for a break. I shouldn't have saved it. Okay, all scribbling also will be there in that then. That's all. Okay, I will share this file with you. Please ensure you complete it. And I want to see answers flowing to me during the break time. In the break, whenever I find time, I will also be, I may not reply to you person by person, but I would have seen all the answers before I resume back, because what are the mistakes done I should understand before I move forward. The revision class is not only from my viewpoint where I just keep on telling, you are listening. I have to know how much you've understood. I have to, okay, so I will. So resuming back the discussion on AS16, I want to take up a few RTP question which is of this model and then go to the last part of AS16. Last part of AS16, which is foreign currency borrowings. This is a September 25 RTP question. Is it permissible to capitalize BC incurred on these assets which are necessary for the construction of qualifying asset? Now, the example starts. Before I read through everything, I'll read the last line. Is the some borrowing cost eligible for capitalization? This is on eligibility of capitalization. With that in mind, we will read it. A company is in process of constructing a large manufacturing plant in a backward area. As a part of this project, it has also purchased a residential building which is to be used for housing the workers engaged in the construction of the plant. Purchase cost of the building is met by raising a long-term loan. The purchase cost of this building is met by raising a long-term loan. Company intends to dispose of the building once the construction of the plant is complete. So the loan is taken for the purpose of constructing this building, and this building is being constructed for the purpose of constructing the manufacturing plant, which is a very huge project. If the manufacturing plant meets the definition of QA, would the BC on funds borrowed to purchase the residential building be eligible for capitalization? I will just explain the question a little clearly, more clearly. There is a plant that is getting constructed. For the purpose of constructing the plant, the workers there have to stay in a building. For that, we are going to construct a residential building first. We purchased a residential building. Now, this residential building is funded by taking a loan. This loan money is used to purchase this building, and this building has been purchased for the purpose of constructing the plant. Now the question is, can the borrowing cost on the funds that have been borrowed to purchase the residential building be eligible for capitalization? No. Anybody from online? You can turn on a mic and talk. Any idea? Okay. This is a bit tricky question. Before I answer what is the conclusion, what provisions do you think can get applicable to this? Qualifying asset. Qualifying asset is an asset that necessarily takes a substantial period of time for it to be ready for its intended use or sale. Okay, now let us look at the answer. This is a little tricky question only. I will, instead of me explaining and then reading the answer, we will directly jump to the answer itself. First thing they tell, qualifying asset provision. So whether you know the answer or not, at least start with the provision. Then assets that are ready for the intended sale when acquired are not qualifying asset. They're just telling extra point. Next, in the given case, prima facie it may appear that residential building is ready for use when acquired and thus BC cannot be capitalized. Yes, however, in the present case, this building is being acquired for the construction of the plant. So building is the building cost is directly attributable to construction of the manufacturing plant. Accordingly, companies should capitalize this borrowing cost on funds borrowed for purchase of building, because that building is related to the plant. Okay, this is a very, very different model question. That's why I wanted to cover this in the classroom. Next.
We have to write that prima facie, it will look like that.
If you want, you write prima facie, but otherwise you will have to just do only after prima facie what is written. That alone, if you write, should be sufficient. That is more so to in written in a way to explain to us. May 2025. May 2025 question, AS16. This is a very simple question, just like what we have been doing where one loan, multiple assets. I just wanted to show that this question is been 620 lakhs the loan. This has been used for acquiring some plant and machinery under a scheme. Expenditure of 510 lakhs was incurred on installing this plant and machinery. 54 lakhs was advanced to suppliers. Additional assets will take substantial period of time in its installation. Now, here one loan is going to be funding multiple assets. One is plant and machinery, other is this advance given, and the third is working capital purposes. You'll have to tell what is QA, then interest to be capitalized, interest not to be, that is to be charged to PN. It's a very simple question. I'm not even going with the answer. We are familiar with this question. There's a lot of study material question on this model. Last, this one is a tricky one. Next one, Jan 25 question. Yes. Again, a very different model which you wouldn't have come across in the study material. It is talking on the definition of borrowing cost, that meaning of borrowing cost this question is placed on. Borrowing cost meaning is interest, commitment charges, amortization of ancillary costs, amortization of discount or premium, finance charges and exchange differences. Okay, now with that in mind, we will read the question. How will the interest be capitalized when QA are funded by borrowings in the nature of bonds that are issued at a discount? Here, bonds that are issued at a discount is the fund that is being used for funding for the QA. X Limited issued in year 1 a 3-year bond. Just a minute. I want to have a split window view. So that I also write the information given here. X Limited issued in year 1 a 3-year 10% per annum bond with a face value of 1 lakh at a price of 90,000 to finance a qualifying asset. So they have issued 1 lakh face value bond at 90,000 rupees, which means 10,000 is the discount on issue of this bond. This is going to be used to finance a qualifying asset which is ready for its intended use at the end of year 2, which means it is a qualifying asset. Compute the borrowing cost to be capitalized if the company uses amortization of discount on straight line basis. Here the question is on finding out borrowing cost, which has two components. One is the interest component and the other is the discount on issue of debentures. Both put together will be the BC to be capitalized. The year, now this loan has been borrowed for 3-year term period. Year 1, here I should have written up. Year 1, 2, 3. Interest per annum is 10,000 because 1 lakh is the face value on that 10%. So 10,000 is the interest for this. Discount, can you please calculate what is the discount to be amortized for the first year? 3,333. So for the first year, 13,333, same for all the 3 years. But you will tell BC to be capitalized is only these two. This will not be capitalized. Okay. Now what are the provisions which we should write for this? First is borrowing cost meaning. BC is, you need not write everything. You just write interest and amortization of discount on issue of debentures or premium at the time of redemption of debentures. Write only what is relevant. Next, or I will show you this just an answer. We will keep seeing that also parallelly as we discuss. Yeah. They tell you the meaning of BC, that BC is interest and other costs, amortization. Only what is required is written, not everything. Waste of time. Next, the question is on the core of this. They have also repeated the crux of A16. BC that are directly attributable to. Why? Because they are telling that qualifying asset it is there, that's why. Now, are you going to define qualifying asset? If you, not necessary, because they are clear that it is a qualifying asset. You need not define. But you will have to include one more provision, which is cessation of capitalization. Because year 2, we are stopping the capitalization. We are not moving to capitalize the year 3 interest. Hence, you will have to also tell when should it cease. it should cease when substantially all the necessary activities, or you can tell substantially all the necessary activities are complete. If you write that, sufficient. After having written this, then you will show the workings here like this, and after that you will write for these two. So BC to be capitalized is equal to, add the two numbers, interest charged to P&L, add that, write that 13,333. I have to see that addition done. Okay, that the final answer you should add it and show it.
Third year should be charged to PN.
Third year should be charged to PN. Either you show it, write a number here like this bifurcation, or in the table itself you put a curl bracket and write it this side. Capitalize charge to revenue or charge to PN and you write it. Okay, these are the only two different, very different model questions. So I wanted to cover it before I go into the last part of the standard, which is forex borrowings.
You had asked the Jan 25 in our,
Your test, because it was different model, I had put it in the test.
the other one that's for the first time. The building
Because
for
September 25 only it came, no? This article. Okay, now we are going to enter into, I'll open the snapshot file and then we will resume the discussion for foreign currency borrowings. Of course, foreign currency borrowings, there is another accounting standard which talks to split. Yeah. Of course, there is another accounting standard which talks about foreign currency borrowings, which is AS 11. I will cover AS 11 tomorrow's class, so I'm not bringing anything to do with 11 right now. We are only going to focus on what AS 16 talks about. Yeah. When you have foreign currency borrowings, little bit of 11 knowledge I presume you have, so I am also covering from 11 also a bit. Foreign currency borrowings, there is something called as initial recognition principle and initial measurement and subsequent measurement. Sorry, not recognition, measurement. Initially, when you are taking the borrowings, suppose you have borrowed $1 lakh, you have to convert into rupees and write it. At what rate you will convert is the rate prevailing on the date you borrowed the loan, the actual exchange rate you're going to convert it. Then, when it comes to the year-end balance sheet, subsequent measurement tells you need to check whether that item is a monetary item or a non-monetary item. Monetary items should be restated as on the balance sheet date. Non-monetary item need not be restated. This is what you do even under branch accounts. You restate monetary items. Okay. Now, foreign currency borrowing, a loan, is it a monetary or non-monetary item? Monetary item. So it has to be restated. When you restate a monetary item, say $1 lakh, we had recorded at 42 rupees that time. Now it has become 45 rupees per dollar. In that case, there is an increase in the dollar because of which loan amount is going to increase. Any loan liability increasing is going to result in exchange loss. Only when you have an exchange loss, you will enter into the provision of A60. If you have gained, this standard is not at all relevant for you. Suppose you have an exchange loss on a foreign currency borrowing. Can you capitalize that exchange loss also? That question we will try to answer. On any foreign currency borrowing, there are two costs attached. One is the interest cost, which I'm paying in terms of dollars, and also exchange loss. Exchange loss can be capitalized subject to certain conditions. That condition I'm going to tell. What the standard tells is, you are paying interest on this loan. Interest actually paid on foreign currency borrowings, we will calculate. This we are going to compare it with interest that would have resulted if the money was borrowed in India. You're going to compare it with interest that would have been resulted if the money was borrowed in India, and find out how much of savings have you made in the interest cost. Suppose I have saved 10,000 rupees. That is, I pay 10,000 less compared to what I would have paid if I had borrowed in India. To the extent of this saving, we can capitalize the exchange loss. Else to tell, I will show the provisions now. Loss that can be capitalized will be actual exchange loss or this difference, whichever is lower. Whichever is lower, you can capitalize it. The steps how we will approach is, first we will find out what is the exchange loss on the principal amount. On the principal amount we'll find out. Next we will find out what is the difference in the interest. After that we are going to make that comparison, actual exchange loss versus this, whichever is lower, and then decide on the capitalization. We will directly look at a question for this. I'm not going to make you work out. If you, I think it's pretty simple. So just by reading, you will be able to understand it. Yeah, this question I wanted to solve. One study material question is there. Yes, this question. Study material question. XYZ has taken a loan of USD 10,000 for a specific project at an interest rate of 5% per annum. Exchange rate prevailing was 45 that time, and now it has become 48. So we are going to restate the liability at 48. What is the exchange loss that we are making by restatement? Can you just calculate? What is the exchange loss? 30,000. Okay, so there is an exchange loss equal to 30,000. Next, if okay, what is the interest which we would have paid is 10,000 we borrowed. We have to find the interest that we would have paid in rupee terms, sorry, not in dollar terms. 10,000 we borrowed. At that time, the value was 45 rupees. So 45 into 10,000 into 5%. Sorry. You need to find out the interest in dollars and then convert into rupees. Sorry. You will use the closing exchange rate. So $10,000 into 5% you have in terms of dollars. $500 into 48 rupees is the exchange rate at the end. So that into 48, 24,000. This is the actual interest payment. You will apply it on dollar funds because the person who lent to you will calculate the interest on what dollar amount only he lent, not on the rupee terms which we have. That's why. 24,000. This will be compared with the interest that would have resulted if the money was borrowed in India. For this only, you will have to convert it to rupee terms. $10,000 into 45. This is the amount that would have been borrowed in India. On this, you will apply the percentage, which is in India, if you borrow 11% in the local currency. So 450,000 into 11% comes to 49,500. So the savings in interest cost is 25,500. Whichever is lower, so how much will you capitalize? 25,500 will be capitalized. The balance will be charged off to P&L. So 25,500 will be capitalized. The balance will be charged off to P&L. Okay, this is, I think, manageable. So foreign exchange differences we are done with. Okay, this question also, capitalization rate, I told I will do it later. I want to finish up. It's a little difficult question. It's not there in the material, not come in RTP, but I want to cover it because if it comes, you will not be able to manage it by yourself, even after knowing all the provisions. I'm not going to work out, I'm just going to show the answer, okay? Let's read the question. An entity constructs an office building which continues to 31st December. Directly attributable expenditure at the beginning of the month are 2 lakhs in September and 4 lakhs in each of the 3 months of October to December. The question is not on entire thing, it's only on capitalization rate calculation. So this is not relevant for us. Average annual expenditure, we are not going to find out that. Next paragraph only is relevant for us. Company has not taken any specific borrowing for constructing this asset, but has incurred finance costs on a general borrowing during the construction period. During the year, company entity had issued 9% debentures with a face value of 30 lakhs, and it had an overdraft of 4 lakhs which increased to 8 lakhs in December. Interest paid on overdraft was 12% till 1st October, and then the rate also increased to 15%. How will we calculate the capitalization rate? Okay, that is only the question. We will first understand the approach, then I will take you through the answer. To calculate weighted average borrowing, the capitalization rate is equal to total borrowing cost on the general borrowings divided by weighted average borrowings outstanding during the period. This is only the formula. Total interest cost we have to find out. It is not as simple as applying 9% on 30 lakhs will give you the interest for debentures. But for overdraft, can I apply 12% directly on 4 lakhs and finish it off? Not possible. It is undergoing changes. So I will prepare it in a tabular presentation. How we are going to approach it is, we need to calculate interest. Interest is equal to amount into rate into period. First, we will have one particulars column. We will have one particulars column where we will write the source of funds, debentures, overdraft. Next column we will also have a date, okay, because date is relevant for period. Date, particulars, thereafter amount, rate, period, and then next column interest. With this approach we will start. Debentures. Debentures is 30 lakhs. 9% is the rate. 12 months is the period outstanding. So no problem. It is simple. 2,70,000. For overdraft only I will discuss. What is the amount which we start the overdraft with? 4 lakhs we start with. And that time what was the rate? The rate is 12%. Okay. Period we will have to fix because we have to see when the next change happens. From this we start from the starting date, 1st January. Okay. Next, there is a change. Now the change happens one in December. The change happens where the amount increases, and the other change happens in rate on 1st October. What is the year followed by the entity?
Continues to 31st December.
Jan to December only. Okay, Jan to December only. They don't give anything else. So 4 lakh 12%. What is the next date of reset happens? The change happens. What is the earliest date of reset? 1st October. 1st October the change is from 4 lakh. The amount is the same, 4 lakh only. But the interest changes to 15%. On 1st December, in December 21, I'll take it as 1st December. The amount changes to 8 lakhs. Rate continues to be the same. Calculation wise, I'll just show it here. So 448. Period wise, on October change happens. So 9 months is the first thing period. Thereafter 2 months, 1 month. After this, you will be able to manage with the interest calculation. Okay. Next, we will have to find out the weighted average general borrowings also. For weighted average borrowings, again, we will just discuss and then we will see the answer. Weighted average borrowings, to find out that XW and XW. What is X? Amount of borrowing. W will be the period and the third is the product. For amount of borrowing, we will start with this debentures 30 lakhs, period outstanding is 12 months. For overdraft, the starting amount is 4 lakhs. Next, there is a reset happening. Reset happens on 1st October in regard to rate of interest. But rate of interest is not relevant for me in this calculation. The next date of reset is 1st December. 1st December, it changes to 8 lakhs. That is relevant for me. So what is the period for 4 lakhs? 11 months, and for this 1 month. That's with this you will be able to complete of the weighted average borrowings also. Sum of product divided by sum of weight. Sum of weight I've already told it's only 12 for any weighted average calculation when you take months as the weight. Okay, so with this our A16 part we are through with.
When you made us do these sums back in, you gave us this one homework question which is 31. I missed one word at the beginning, which said expenditure given on cumulative basis.
Okay.
I made a very huge mistake and then the entire answer was wrong. So I thought I should point it out. When expenditure is given on cumulative basis. This is one thing I keep revising every time I come back to this.
Okay. I think I could have selected this question also for early for discussion. Anyway, I will not extra select the question because already we are done with
this. Maybe tell people to revise.
I will give this maybe revision. So you'll have to find out cumulative basis 5 lakhs. So you'll have to find out the difference and then write the expenditure. Okay.
I still have it as the wrong answer here because when I saw it.
Next, we are moving to AS19. Accounting Standard 19 deals with leases. In this standard, knowing provisions is also equally important as much as computation is, because both computation and provisions form part of any answer. To start off with objective, the objective of the standard is to learn accounting treatment of leases both in the books of lessor and in the books of lessee. So in both the person's books, we are going to discuss the accounting. Scope. This standard is not applicable to the following: any lease agreement which deals with natural resources or intangible assets or land. These three it is not applicable. No question on this model has been on scope has been asked either in book back or past exam question 2. What all we are going to cover is we are going to learn how to classify leases. Classification of lease. Thereafter, we will learn accounting of finance lease and accounting of operating lease in the books of both lessor and lessee. And finally, discussion will be on sale and lease back transaction. This is the coverage of the standard. Let us begin by looking at the meaning of the word lease. Lease meaning is not an important word from an examination viewpoint though. Lease is an agreement which gives the right to use an asset for a single payment or for an agreed period of time. For an agreed this much if you know sufficient, if you read is sufficient. It is giving the right to use an asset for an agreed period of time. For the purpose of accounting of leases, the standard feels that you will have to check what are the terms of the lease. What it means by terms of the lease is it checks for risks and rewards incidental to ownership of the asset. Incidental to ownership. You need to check the risks and rewards incidental to the ownership. If these risks and rewards incidental to ownership are with the lessee or is it with the lessor, we need to check. Which means the standard is telling, even though it is a lease agreement, you go and see the substance of the transaction. Maybe this appears as a lease, but actually the owner of the asset is not the lessor, but the lessee only. There can be a possibility that title is not transferred to the lessee, but the risks and rewards are already transferred to the lessee. In that scenario, that lease is in the form of risks and rewards incidental to ownership are not with the lessor but with the lessee. That will be classified as a finance lease. And if it continues to be the lessor, it is only a rental agreement, not in the form of any financing arrangement. That kind of lease will be called as operating lease. Finance lease word is because this is actually a loan given against an asset, only outside form of it looks like a lease. Okay, telling this much was not sufficient is what the standard setter felt. Hence, the standard gives you something called as indicators of finance lease. Indicators of finance lease. There is something called as deterministic conditions and probabilistic condition. Deterministic condition alone, if you know, sufficient. Deterministic conditions, there are totally 5 conditions which have been given. Knowing this is very, very important from an exam viewpoint, because if you're asked a question on classification of lease, you will have to list down these 5 conditions. I will just show you those conditions now. A lease can be classified as a finance lease if it satisfies even one condition satisfied is sufficient, not all required. First condition, lease should transfer the ownership of the asset to the lessee at the end of the lease term, which means the lease itself is such that ownership will get transferred to the lessee once the lease term is over. It is not, the asset is not going to come back to the lessor. That's the first indication. Second, even though the asset is not automatically transferred, the lessee has an option to decide to purchase the asset at the end of the lease term, and that purchase price is way lesser than the fair value of the asset at the time of exercising the option. Third condition, the lease term covers a major part of the asset's economic life. Even if the title is not transferred, the lease term itself covers a major part. The question that is testing on this provision, there is a question on in the material. Next, leased asset is of a specialized nature which only the lessee can use the asset without making major modifications. And last one, at the inception of lease, present value of all MLP is substantially equal to the fair value of the asset as on the date of inception of lease. These are the 5 conditions, but knowing condition 3 and 5 only is important, I would say. No, the 1, 2, 4 are not being tested so far in any question. So only 3 and 5 we will repeat. Third condition says, I will also have it on screen. If you don't know, you can even see it and repeat it. Lease term covers a major part of the asset's economic life. I have told it in my own words. I have not exactly repeated, but I have ensured that the word lease term is there. Major part should be there. Economic life should be there. Then if you want, you change any other word is okay. Instead of telling economic life of the asset, I told asset's economic life. That and all changes you can do in your own language. But if you tell instead of life, I will write useful life, or I'll just write life, that is not the change you can bring about. The word economic life I have to see, major part I should see. You cannot tell substantial here, that will go wrong. I want to see the word major part only, and I have to see the word least. These 3 words have to be there. Next, present value of MLP is substantially equal to the fair value of the asset as at inception of the lease. So fair value will always be attached with the date. This fair value is on the inception of lease. Now what does inception of lease mean? Inception of lease means the date of lease agreement. Or here again the standard tells that even if I have not legally signed the agreement, but if I have orally agreed to the principal terms of the lease, even then committing to the principal provision of the lease will also be considered as the date of inception of lease. No question on inception of lease is there in the material though. I've just explained the word inception of lease. Okay, so we will see some question on this. Is 19.
We're not up to this page.
So she has scribbled all over on the page. Okay, we are seeing the conditions. I want to take out a question. It is not. I have ticked off the question. If I move the question, it is easier for me to move to that question. Yeah, question number 11. Lessee has the option to purchase the asset at lower than fair value at the end of lease term. Finance lease or operating lease? This is a study material question only. Lessee can purchase the asset at the end of the lease at a price lower than fair value. It is a finance lease. Economic life is 7 years, lease term is 6 years. So lease term is covering a major part of assets. Economic life, finance lease. Economic life is 6 years, lease term is only 2 years. So this is not a finance lease, which means it will fall under operating lease. Present value of MLP is equal to fair value of the asset.
That was a finance lease.
Oh, I did not read fully. But asset is of a special nature and has been procured only for the use of the lessee. I did not read. Yeah, if it is a specialized nature, even if this is not satisfied, specialized nature, so it is going to be a finance lease. And last one, PV of MLP is equal to fair value, so it is a finance lease. Okay, so the conditions we are through with. Now we will enter into accounting of leases. Now, accounting of leases when it comes to, we are going to learn accounting in the books of lessee and also in the books of lessor. Finance lease accounting we are going to discuss. First, we will start with lessee books. In the books of lessee, asset, the asset that has been taken on lease will be capitalized only in the books of lessee and not in the books of lessor, because risks and rewards incidental to ownership have been transferred to the lessee even though title has not been transferred. So it will be recorded only in the books of lessee. Journal entry for this will be asset account debit on inception of the lease. This is the journal entry which is passed. Asset account debit to liability account. We will take the lesser name. Lesser. What will be the amount here is we will capitalize the asset at fair value of the asset at inception of lease or PV of MLP, whichever is lower. You cannot overstate assets. That's why whichever is lower. Conservatism does not allow you to overstate any asset. That's why whichever lower. This is the provision. Fair value of the leased asset or PV of MLP, whichever is lower, is used for capitalization. We will take up a question on this calculation. Question number 18. 18. Yeah. Esquire Limited, this is also a study material question. Esquire Limited has taken machinery on lease from SK Limited. The information is as under. Lease term is 4 years. Fair value at inception of lease is 20 lakhs. Lease rent 6,25,000 per annum at the end of the year. I want to. Next, GRV is 1,25,000. Expected residual value 3,75,000. Implicit interest rate 15%. I have to talk about GRV and expected residual value. I will be doing it in some time. So I will just explain of what does MLP mean here. not moving. Okay, I will remove this out. I told you that should be capitalized at fair value of the asset or PV of MLP, whichever is lower. Fair value of the asset is directly given to us as 20 lakhs. Now MLP meaning is MLP is equal to lease rentals. See, minimum lease payment is nothing but the payment which the lessee is going to make during the lease term and at the end of the lease term. During the lease term, what does the lessee pay? Lease rentals. At the end of the lease term, he will have to pay something called as guaranteed residual value. So at the end, both put together will be the MLP. This MLP, we'll have to bring it down to present value terms because these cash flows will arise at different timelines. So to bring down the cash flows to present value terms, we are given the discount rate to be 15%. So we will have to calculate PV of MLP as year 1, 2, 3, 4 cash flows, or we can write MLP over here. First year it's going to be 6,25,000. Second year 6,25,000. Third year also same. For the fourth year it will be 625 plus 125. Only GRV, that expected residual value, I'll talk about it later. So we will have to add 6,25,000 plus 1,25,000 added, and that will be the last year cash flow. This should be discounted at PVF at 15%, and what you get will be the present value total. If you find out the present value of that, this is the one S Square Limited. I will just illustration 1. Yes, 6,25,000. We have found out the present value to be 18,55,851. This or fair value, whichever is lower, so the asset should be capitalized at 18,55,851. Asset account debit to lesser account, Machinery to SK Limited, 18,55,850. Okay, this is first model question where you have to find out the initial measurement, that is initially the asset is capitalized at what value in the books. They can ask you like this, or they can ask you initially what is the liability recognized in the books. Whether they ask you asset or liability, computation is the same, because asset account debit, what amount you write, the same you will write as liability account also. So that's why they can ask you in either of the ways. Next comes as during the lease term, how do you do the accounting? Once the lease is entered, we have seen the accounting. Next, during the lease term, we are going to make lease rentals payment. These lease rentals that are paid is a total of principal portion and the interest portion. So you may have a question where you have to bifurcate the lease payment installment into principal portion and interest portion. That bifurcation is the next model question. So what are the three models which you can think of? Is one is indicators of finance lease. They'll ask you to classify the lease. Second, they may ask you to value the asset or liability, initial measurement. And the third is split the lease rentals into principal and interest portion. So for this question, if you have to split it, I will just show you how the split up happens. Table heading alone, we will decide how to approach with the table. It's a tabular presentation. Year 1, 2, 1 minute. Year 1, 2, 3, 4. 4 years. Thereafter, we have the installment amount. The installment amount is called nothing but MLP. This MLP should be broken down into interest portion and principal portion. And finally, we will have principal due or principal outstanding. First year, year 0, we start the loan. Year 0, we have taken a loan of the borrowing What is the value at which we recognize the liability in our books? 18,55,850. That is the loan amount which we start off with. 18,55,850. This is the loan amount. For the first year, what is the MLP? What is the first year repayment which we make is 6,25,000. Let us calculate interest now. Interest is 15%. That 15% you will apply on the loan amount outstanding, 18,55,850 into 15%. You get 27,8378. So find out the principal portion minus 6,25,000. You get 346622. This is the principal repayment which happens. So what is the net principal outstanding after the repayment? 18,55,850 minus 346622. 1509228. Like this, you will have to calculate year after year. Only point to be noted is for the last installment, it will be a total of 6,25,000 plus the GRV also should be added, and interest will be found as a balancing figure so that the loan amount becomes zero. This alone is the point to be noted. One question we had, the residual value pending in the end. Both are okay.
If given in the question, you assume that to be residual.
Yeah. But both are okay. At what value you stop? We will just read these two questions. 14th and 15th, we will just read it and answer it. Lessee books accounting, that's all. Now I have to move to lessor books. Before I move to lessor books, I want to finish up two extra questions. This is a combination of classification of lease plus what you learned right now, the MLP present value, both combination it is. Many limited leases out a machinery to Krishna on the following terms. Cost of the asset 20 lakhs, lease period 5 years, lease rental 596,650, life of asset is 5 years. IRR is 15%. PV of MLP is almost equal to 20 lakhs. We need to decide on whether it is a finance lease or it is an operating lease. What are the conditions for finance lease? First condition, lease itself is transferring the asset to the lessee at the end of the lease term, or lessee has the option to purchase the asset. Third is lease term covers a major part of asset's economic life. Fourth is specialized nature. Fifth is PV of MLP substantially equal to fair value. Please read this question and understand which are the provisions applicable. Only that we will write. We are not going to write all the provisions. Can you please go through? Is this a finance lease or an operating lease? This one. Many limited. Many limited. This one. Is this a finance lease or an operating lease? We have to discuss. I will just show the answer now. Lease period is equal to the economic life of the asset. First thing. Second, PV of MLP is almost equal to fair value of the asset. 3. Lessee has taken the insurance coverage, which means substantial risks and rewards are with the lessee, and so this lease will be classified only as a finance lease. Next one. This is also an RTP question which appeared recently. Recent RTP also I saw the same question. 24 again in 25 also it came, okay, similar to this. Suraj Limited wishes to obtain a machine of 30 lakhs by way of lease. Effective life is 14 years, but the company requires only for 5 years. It enters into an agreement for lease rental of 3 lakhs per annum payable in arrears. Interest rate is 15%. Chief accountant does not know how to classify this lease, whether it's a finance lease or an operating lease. First thing, the lease term is 5 years, but economic life is 14 years. Does not cover a major part of asset's economic life. It does not cover the major part. Next, 3 lakhs per annum like this you pay for 5 years. Even if you add comes to 15 lakhs, don't consider present value. Even without present value, does not even cover. At least 80 to 90% you should cover. That is very substantial. It is not substantially covering. That's why these two provisions written. And finally, we tell you also have to now this question I chose just to tell you the presentation of the answer. How you should present it is, a lease can be classified as finance lease if any one of the conditions also satisfied. Don't write all the 5. Relevant is only these 2. Write there. Next, you will tell in the given case, you'll have to write down with the number calculation. Fair value is so much, PV of MLP is so much. Find out the percentage and then tell it does not substantially cover. Thereafter, you'll have to tell lease term is so much, economic life 14 years does not cover a major part. Therefore, lease is an operating lease. And if it is an operating lease, the lease rentals cannot, that is, it should be moved to P&L as rental charges. You'll have to recognize it as an expense. You will not be bifurcating it as principal and interest portion. No? That is not allowed for operating lease. So this presentation of answer has to come. Okay, finance lease in the books of lessee I am through with. With this, we are through with lessee books. Now I am going to move to lessor books. Under lessor books, again, you need to be familiar with few more terminologies. So I will introduce the terminologies and then we will do some question. We are going to do this question after discussion. Now, in the books of lessor, we have given this asset on lease to the lessee. Say we are having a car. This car has been given on lease to the lessee under a finance lease. Title is with the lessor, but risks and rewards incidental to ownership of the car have been transferred to lessee. So who can capitalize the asset in their books? Lessee only will capitalize. Lessor cannot show car as an asset. The journal entry which lessor will pass when this car is given on lease is debtor account. I will write debtor, but it's actually lease receivable account, or we will write lessee account debit. Instead of debtor, I'll write lessee account. Lessee account debit, because I have the right to receive money because of this car getting transferred to him. 2. Either asset account or sales account, whatever be the thing. This lease receivable, at what value should you show it? That will be a question that can come in the exam. I repeat, this lease receivable should be measured at what amount is the question. This lease receivable is shown at the net investment in lease. Lease receivable is shown at the net investment in lease. To understand net investment in lease, we have to understand few more terminologies. Okay. Okay, I'm unable to reach that. Yeah. It should be recognize this as an asset at net investment in lease. Now, what does net investment in lease mean? There are 3 ways in which you can define net investment in lease. First way, net investment is equal to fair value of the asset. This is the first easiest way. As on that date, what is a fair value? That is called as net investment in lease. Other ways, net investment is equal to present value of gross investment in lease. This only you will use in a question, present value of gross investment in lease. Now, what does gross investment in lease mean? We have to find out that. You have to understand that. Gross investment in lease means all the cash flows that come to the lessor during the lease term and at the end of the lease term. All the cash flows that arise from the lease during and at the end of the lease term. During the lease term, what do we get? Lease rentals. At the end of the lease term, what we get is residual value. Now, residual value, the standard talks about 2 terminologies. One is the guaranteed residual value. other is the unguaranteed residual value. What does that mean? I will tell you. This car, if I've given it on lease to X, when he returns back the car to me after 5 years of usage, I will value the asset, value the car. The car value should come at least to 30,000 rupees. This is the value of the car at the end of the useful life. For this 30,000, X is giving a guarantee on this that after 5 years of usage, this car will be worth 30,000. If by chance you value and you find that the car is not in a good condition, that's why the value estimated, if it comes to 25,000 rupees only, the balance 5,000, I guarantee that I'll give it to you in cash at least. Either the asset should be in such good condition that it should be 30,000, or if it is lesser than 30, the guarantee given is up to 30,000, I will guarantee it. Which means if the asset is 25,000 worth, extra 5,000 the lessee has to pay. For this is called as the guaranteed portion. The residual value of the car could be 50,000 after the entire usage. Out of this, how much is the lessee guaranteed for? 30,000. The balance residual value will be called as unguaranteed residual value. If you understand the term, okay. Otherwise, I want you to remember is GRV is relevant in the books of lessee. UGRV is relevant in the books of lessor, because lessee has only given a guarantee to the extent that alone he will take it in his books. Whereas lessor is going to get residual value, whether guaranteed or not, he will get the entire residual value. So for him, what is relevant is UGRV. What is gross investment in lease? Lease rentals plus GRV plus UGRV. We will not tell, we can also tell lease rental plus residual value, but we will not define it like that. Because residual value has two components. We can also tell plus residual value, but we will learn it as gross investment in lease is equal to lease rent plus GRV plus UGRV. The difference between gross investment and net investment in lease is called as interest, but we will call this as unearned finance income. That's all. 3 terms you should be familiar with. We will move to the next question once we revise on these 3 terms. First term is net investment in lease. Net investment in lease is equal to the fair value of the asset or PV of gross investment in lease. What is gross investment in lease? Lease rentals plus GRV plus UGR. Unearned finance income, what is it? Gross investment in lease minus net investment in lease. Question B and P availed, that question we are doing. That is also a study material question. It is question number 13. Ahead. I thought if I have the answer shown, it becomes quicker. I have to operate in these mistake. Prakash Limited. BNP Limited. Okay. We are going to solve this question. BNP availed a lease from N&L Limited. Conditions of the lease term are as under. Lease period is 3 years. Lease period is 3 years for equipment costing 10 lakhs and has an expected life of 5 years. Market value is 10 lakhs. What is the cost of the asset? 10 lakhs. Market value also 10 lakhs. Useful life is 5 years. Lease period is 3 years. Property reverts back to the lessor on termination of the lease. UGRV is given as 1 lakh at the end of 3rd year. 3 equal annual payments are made at the end of each year. Consider IRR to be 10%. You have to calculate 2 things. 1, whether this lease is a finance lease, we have to answer. 2, we have to also calculate the unearned finance income. Monica, tell me which provisions of indicators, there are 5 indicators, no? Which provisions we are going to use for this question? out of those 5 indicators. The question number is 21. Which are the indicators out of the 5? Not able to recollect. Yes, ma'am. Lease term covers a major part of asset's economic life. Second, fair value is given, which means you're going to use the 5th condition. PV of MLP is substantially equal to the fair value of the asset at inception of the lease. So these 2 conditions we are going to use for answering whether the lease is a finance lease. How we are going to present the answer. Lease can be classified as a finance lease if it satisfies any one of the following conditions. Lease term covers a major part, you will tell, and also that PV of MLP is substantially equal to fair value of the asset at inception of lease. Now, lease term is equal to 3 years, whereas economic life is 5 years. Does it cover major part of asset's economic life? Means 60%. Even this you can consider as major part. Anything more than 50 also can be considered. Next condition. PV of MLP substantially equal to fair value. Fair value is given to us as 10 lakhs. But do we have MLP information? MLP requires what? Lease rentals plus GRV. GRV, is it there in the question? Not there. They tell UGRV is 10 lakhs, sorry, 1 lakh, but they tell nothing about GRV. PV of MLP needs to be found out now, which is equal to lease rentals plus GRV, present value of that. We will now start doing the question. We have to find out PV of MLP. For this, we are going to start with the formula approach where we will write down, first I will write down what is gross investment in lease. Gross investment in lease is equal to MLP plus GRV plus UGRV. Net investment in lease is equal to present value of MLP plus present value of GRV. Nothing but what is net investment in lease? Present value of gross investment in lease. So present value of all of these 3 factors I have to bring down to present value plus present value of UGRV. Finding out present value of all these 3, summation of it gives us net investment in lease. PV of MLP, do we know? We don't know. We will call that as X, or I will call it as PV of MLP itself. GRV, we will assume it to be 0 in the absence of any information. Plus present value of UGRV. What is UGRV given? 1 lakh. You will have to bring down to the present value. So 1 lakh into PV. PVF for 3 years, 10% is 0.7513. The present value interest factor. 0.7513 into 1 lakh comes to 75130. Net investment in lease is nothing but fair value of the asset, which is 10 lakhs. So can you find out PV of MLP as a missing figure here? Yes. PV of MLP will be 924,870. Once we get this, I will go with the solution. I will just show you after this first step needs to. PV of MLP is this. Oh, one more thing also I have to explain. Okay. We have present value of MLP. What we need is MLP. What we also will find out what is MLP. If I gave you MLP, how will you find out present value of all MLP? You will do MLP into present value annuity factor. If you do, you will get the PV of MLP is equal to MLP into PVAF. What I have to find out here is MLP. So MLP will be equal to how much? PV of MLP divided by PVAF. 924,870 divided by 2.4868. That is only the PV of PVAF. So 924 divided by 2.4868 comes to 371,912. Till here you're with me. Now we are done with the computation part. We just have to answer. Classification of lease. First parameter, lease term 3 years, covers a major part of asset's economic life 5 years. I have also given the numbers along with the sentence. PV of MLP is so much. It substantially covers the fair value. Writing that alone is not sufficient. You will have to find out the percentage and express it as a percentage. Therefore, lease is a finance lease. Next, unearned finance income is asked. What is unearned finance income? Gross investment in lease minus net investment in lease gives us unearned finance income. So let us first show what is gross investment in lease. What is gross investment in lease meaning? All the cash flows that are earned during the lease term and at the end of the lease term, not the discounted not at discounted terms, just the cash flows. So gross investment in lease is nothing but MLP plus GRV plus UGRV. Able to follow that it is summation of all the three cash flows. MLP is 1 year MLP is 371,912 into what is the lease term? 3 years. So MLP will be 1115736. GRV 0, UGRV 1 lakh given to us in the question. Thereafter, net investment in lease. Net investment in lease is nothing but fair value of the asset at inception. That even that we can take it as. So 10 lakhs. We'll have to do this. This into 3. UGRV 1 lakh comes to 12 lakh 50. This should be deducted from net investment. You will have the unearned finance income. This question is also of similar model only. It is a study material illustration 2 question. Same model question. Generally, they club like this, whether it constitutes finance lease and unearned finance income. This model question only is mostly asked for lessor accounting. For lessee accounting, they will ask you to find out the present value, the value at which the asset will be recognized in the books, which is nothing but PV of MLP, or fair value of the asset, whichever is lower. Okay, now we're moving to operating lease accounting. Operating lease accounting, I do not see any question coming as a 4 mark, 7 mark question. I don't see a question coming from here. Operating lease, if it comes, it will come only in MCQ mode. They've already asked one time. In MCQ mode, they're asked operating lease. So I will just cover the provision for. Here it is, operating lease. Operating lease is a lease where the risks and rewards incidental to ownership of the asset is not being transferred to the lessee, it is with the lessor only. So who is going to record the asset in their books? Lessor will record it as an asset in the books. Lessor will charge depreciation on the asset. Lessor will get every month or every year some amount from the lessee as lease rentals. what will happen to the books of the lessee? Can lessee recognize this as an asset in the books? No. Every year, whenever they make payment of the lease rentals, they will take it as rental expenses or rental charges in their books. That's all. In this context, we will do 2 questions, after which we are done with operating lease part. Suppose outputs from a machine taken on 3-year operating lease is estimated to be 10,000 units in year 1, 20,000 units in year 2, and 50,000 units in year 3. The annual lease rentals agreed is 25,000, 45,000, and 50,000. Show the accounting in the books of lessee. Lessee books, we are doing the accounting. In lessee books, the journal entry will be rent account debit to bank account or cash account. Rent will be attached with lease rent because it is a lease agreement. That's fine. Lease rent to bank. Now, what will be the amount to be written? That needs to be understood. The base of the calculation which I'm going to take now is matching concept. For the first year, second year, and third year, they tell you that output from the machine is 10,000 units for the first year, 20,000 for the second year, and 50,000 for the third year. The rent that they have paid is 25,000, 45,000, and 50,000. If rent has been paid 25,000 in the first year, you will recognize in the P&L account 25,000 actually. Yes. However, the standard tells that you will have to match. There can be a possibility that in the year of more output, you may pay lesser rent compared to lesser, when it is lesser output, you may end up paying more rent. So you will have to bring the rent in the P&L in proportion to the output that was manufactured during that year. How to find out the proportionate rent is rent expense to be recognized. How we are going to find out that is add up the total output from the asset, which comes to 80,000. Total rent 25, 30, 70, 80, 90, 100, 120,000. For 80,000 of output, rent is 1,20,000 totally. So, for 10,000 output, what will be the rent? 15,000. So, in the first year, only 15,000 of rent expense will be recognized. The balance difference is 10,000. What is the journal entry which we pass for this is, if I tell rent to be recognized is only 15,000, we will write rent account debit 15,000 only. We are not going to write 25,000. What will be taken to P&L is only 15,000. 2. Bank account. How much have we paid rent? 25,000. The difference of 10,000 will be taken to an account called lease equalization account. Okay, this is about accounting in the books of lessee. In the books of lessor also we will finish up one question. Suppose outputs from a machine of economic life of 6 years are estimated as 10,000, 20, 30, 40, 20 and 5,000 respectively. Machine was given on a 3-year operating lease. Question is clearly telling it's an operating lease. Equal annual lease rentals to yield 20% profit margin on cost of 5 lakh rupees. This question came as an MCQ question somewhere in the exam. I remember seeing that this question has come as an MCQ question. You are asked to find out what is the total lease rent and annual lease rent. Go through the question for a minute and then we will start discussing. lease rent should yield 20% margin on the cost. So total lease rental should come to 55 lakhs plus 20 percentage, 6 lakh rupees is the total lease rental. I will just show you the calculation. What is the total output from the machine? Total output which the machine can manufacture. Can you please add up 10,000 plus 20,000 plus 30,000 plus 40,000. See, year 1 10,000, year 2 20, year 3 30, year 4 40, year 5 20 and 5,000. If you add up all of this, it comes to 1,25,000. 1,25,000. Hence, are you giving the asset on lease for the entire 6 years? No. What is the period for which we have given the asset on lease? Only for 3 years. For 3 years, what is the output that is that can be manufactured from the asset? 10,000 plus 20,000 plus 30,000. 6 lakhs can be recovered from an output of 1,25,000 totally. But we are giving the lease only for 60,000 units. So what is the proportionate lease rent for the lease term? We'll have to find out. That comes to 2,88,000. This is the total lease rent for all the 3 years. The equal annual lease rental. So 288,000 divided by 3, 96,000 will be per annum lease rental. After which, the same way you will have to compare it with the to be recognized versus paid and then find out the difference. Okay, 5 minutes break and then we will join back. The final discussion is on sale and leaseback. In this, we have sold an asset and again taken the asset back on lease. Sale of asset is the first transaction and we are again taking the asset back on lease. It is the second transaction. Sale of asset will result in profit or loss. This lease that you're going to take back the asset on lease, for this lease, X will have to pay lease rentals. We are going to look at this transaction entirely from the viewpoint of lessee and not from the viewpoint of lessor. Because once he sells it, he is going to take the asset on lease. Y becomes the lessor and X will become the lessee for that. The question which we will try to answer in this discussion is how to recognize the profit or loss on sale of the asset. Should I recognize the profit immediately now or should I amortize it, defer it and amortize it over the lease term? Immediate recognition or defer and amortize? This question we are going to answer under sale and leaseback. We are not learning entire accounting of the transactions. We are only looking at a very, very limited purview where profit/loss on sale of the asset can be recognized immediately or it should be deferred and amortized. what AS 19 tells is there are two contracts here. One is the sale agreement and the other is the lease agreement. What we need to check is there any nexus or a connection between these two agreements? Which means now if we are making a loss on sale, is it compensated, or by making a loss right now on selling, we may be paying lesser lease rentals on the lease agreement. That's why he decided to purchase it. That is what to say. I will give an example, it will be better. 1 lakh is the book value of the asset. We have sold this asset at, let's take 90,000 rupees. So by this, we are making a loss of 10,000. I could have sold this asset at 1 lakh, but I have sold it only at a very low price. Let's take 80,000 and I made a loss of 20,000. On one side, I have got lesser amount by selling the asset. On the other side, there is also a lease agreement. In the lease agreement, this person to whom I sold is going to fix the lease rentals. Please note, the Y is going to fix the lease rentals which I have to pay because I am entering into the next agreement. What Y does is, he will fix lower lease rentals now. Why lower lease rentals? That time he gave me lesser money. So he is now reducing the lease rentals for me. Anyway, if you understand the logic, okay. Otherwise, in the exam, what you're going to check is there a nexus between both the agreements? Is there a connection between me fixing the selling price and Y fixing the lease rentals? If you feel that there is a connection, then you cannot recognize the profit immediately. You will have to defer and amortize. So if nexus is there, you will defer and amortize. If you tell that there is no connection between both the agreements, then recognize the profit immediately. Losses can never be deferred. Losses has to be recognized immediately. There is no option for a loss. Only confusion can come on the profit situation. Now, to decide whether there is a nexus or no nexus, we will be given information on 3 parameters. 1, they will tell you what is the selling price of the asset. Then they will tell you what is the fair value and also the book value of the asset. Selling price versus fair value, we will make a comparison first. If selling price is equal to fair value, any other person also I could have sold it at 100 rupees, and to this person also I sold it at 100 rupees. Do you think there's any nexus? No nexus. So if selling price is equal to fair value, no nexus, which means profit is going to be recognized immediately. If selling price is lesser than the fair value, I could have sold this asset to anybody else at 100 rupees, but to this person I sold it at 80 rupees, which means the standard tells that there is a possibility of nexus coming here. And if nexus comes, what is the accounting treatment? Defer and amortize. If loss is not compensated by future lease payments, defer and amortize. I will go with the provisions. Yeah, if loss is compensated, defer and amortize. However, if okay, that provisions I will show you. Okay? First, we will see about nexus and no nexus. Here there is a nexus, so it should be defer and amortize. If selling price is more than the fair value itself, fair value means any other buyer will be able to purchase the asset only at 100 rupees, but I was able to sell the asset at 120 rupees. In that case, standard tells that up to fair value, recognize immediately. Above fair value, defer and amortize. Now I'll show you the provisions. We will see it in a question, okay? Up to fair value deferred amortize, above fair value, sorry, up to fair value recognize immediately. We will see it in a question. I think that will be working out better and easier, faster also. A Limited sold machinery, book value 40 lakhs for 50 lakhs, and the same machinery was leased back. Book value and fair for 50 lakhs. So selling price is given to us, and thereafter they give us different situations. We will just solve it ourselves and then go with the table presentation. I'm just removing it off from the screen. Once we get comfortable with the concept, then we will see how to present it in a table. Fair value. 1 minute. I will start with selling price. Selling price, fair value, book value, and then we will write the situation. Suppose selling price is 50 lakhs, fair value is 50 lakhs, book value is 40 lakhs. We need two things. We are going to do two things here, okay? One, we will find out whether there is an excess. Two, we will find out whether there is a profit or a loss. First situation, selling price is equal to fair value. Is there an excess? No excess. What is the profit or loss in this transaction? You make a profit or a loss. Book value is 40. We were able to sell the asset at 50. So we make a profit of 10. Profit is 10. How is profit calculated? Comparing selling price with the book value. 50 is the selling price, 40 is the book value, 10 only is the profit. This profit, what is the accounting treatment? Recognize immediately or defer and amortize? Recognize immediately, because there is no nexus between the two variables. Next situation. Fair value is 60 lakhs, selling price is 50 lakhs, book value is 40. In this case, selling price is lesser than the fair value. So there could be an excess. Could be an excess. Now, computing profit or loss. How do we find out the profit or loss? Selling price is 50, whereas book value is 40. We make a profit of 10. For this 10, we will tell if there is an excess where selling price is lower than the fair value and still you made a profit, then it can recognize immediately. In this situation, only if you make a loss, you should check for compensations, whether it gets compensated. You have been able to sell it at lesser than fair value, but still, according to you, you made a profit. You are not in a loss situation. So this will be recognized immediately. Next one. 40 is the fair value. Selling price is 50 and book value is 40. Fair value is 50, selling price 40. Sell. Selling price 40. This is 45 and book value is 40. Here, selling price versus fair value, if you compare, selling price is lesser than the fair value. If selling price is lesser than fair value, to any other person I could have sold it at 45, but I sold it at 38 only. And according to me, what was the value in the books? 40. But I sold it way below the value in my books also. And hence I make a loss of 2 here. I make a loss of 2. This loss can be recognized immediately if the loss is not compensated by future lease payment. But If it is compensated by future lease payment, then it will be deferred and amortized. I think in the classroom we had taken that it is not it is compensated. We've written both. You should write both. That's what I wanted to correct. If you have not in the classroom, if I've given only one, it is not enough. You'll have to write both. If now I repeat the situation again, these two I compare again. Okay. These two situations we will again go over them. In the first case, selling price is 50, fair value 60. Sale price is lesser than fair value, which means to any other person I could have sold at 60, but here I made a sale at 50. But according to me, what was the value of the asset? 40 only. Only 40 was the value according to my books. Still, I was able to sell it at 50. So standard tells that if you are still able to make a profit in this situation, then recognize it immediately. No problem. Because according you thought 40, still you got 50. So you are not underselling your asset. If you are underselling your asset only, we will have a problem and we will tell defer and amortize. Here, if my expectation was only 40, but still I got 50. So you are not underselling your asset, recognize it immediately. But in this case, our expectation was to get 40, but I got only 38, where I am underselling my asset. I could have got, I was expecting to sell it at 40, but I got 38. If you have agreed to undersell your asset, then only amortization will come. Defer and amortize. Here also, when you tell, you'll have to give a condition that if loss is not compensated, recognize immediately. If loss is compensated, defer and amortize. You'll have to tell both the things, points. Next thing. Next situation. 46 lakhs is the fair value. I will write it. I think that's better. 46 lakhs is the fair value. D, A, B, C. I should be doing D here now. Yeah. So 40 lakhs is the fair value. Selling price is 50. Book value is 40. Now in this case, selling price versus fair value. Let us compare. Selling price is more than the fair value. Are you underselling your asset? No, right? A fair value itself is 40. Still, I'm able to get price more than the fair value, 50. Okay, I'm not underselling the asset. This is a case of profit or a loss. Profit is 10. If you have sold the asset more than the fair value, up to fair value, recognize immediately. Above fair value, defer and amortize. Any other sane buyer would not have given anything more than 40 rupees. But if this person was ready to give you 50, then we have a problem. We will defer and amortize. Only that portion which he gave extra than the fair value, we will defer and amortize. Up to fair value immediately. Next one. 46 lakhs is the fair value. Selling price is 50. Book value is 40. Here selling price is more than fair value. What is the book value? 40. 40 compared with the selling price, we make a profit of 10. Yes. Profit is equal to 10. In this case also, up to the fair value. What is up to fair value? 6 rupees is up to fair value. So 6 rupees we will recognize immediately, and balance 4 rupees we will defer and amortize. Last situation. Fair value is 35 lakhs. Selling price is 39 and book value is 40. Here, book value itself is more than the fair value. Yeah, sorry, more than fair value. Yes. Yeah. Book value is more than the fair value, which means you have overstated your asset. 35 is the fair value, 40 is the book value. You have overstated your asset. If you've overstated, you will have to bring down the value of asset up to fair value first. So first thing is bring down the value of asset up to fair value by writing the loss immediately. With this, the revised book value will become from 39, the book value is now going to become 35. Now you find out whether you make a profit or a loss. We make a profit of 5. Again, no, selling price is 40.
No, book value is 40. Selling price is 35.
Why?
Okay, time.
Okay. I will better do it in this itself. Because the order in which I'm writing here is different. Okay.
So 40 becomes
Book
35.
value is 40. Fair, I better write in this.
35.
Fair value 35. So, if book value is more than the fair value itself, then bring down the value of asset to its fair value. So, bring down by 5 rupees. We have reinstated the book value. Revised book value now is 35. Now compared with the selling proceeds. Selling proceeds is 39. We make a profit of 4. Up to fair value, recognize immediately. Beyond fair value, defer and amortize. For the profit, that is the provision. Up to fair value is 0 because book value is equal to fair value. Above fair value, 4 rupees, which will be defer and amortize. Clear with this? I will make you try this question as for you to try at home, whether you're able to follow the concept. Done. So with this AS19 part, we are done with the provisions part. I will go with the RTP question.
There was some sale and lease back the finances.
So that's why I want to finish up with RTP. 3 RTP questions and then we will come. September, no, I will not start with September 24. Or okay, we are doing sale and lease backs. Sale and lease back, surely you should go through in that towards the end, towards the exam time. It's necessary that you go through because chances are that you may miss out or get confused between the provisions. Okay. Let's read this 19th question. On 1st April, Mansi Limited sold a plant for 850 to 800. The carrying amount of the plant on that date was 1,80,000. Mansi sold a plant for 8,52,000. Carrying amount is 1,80,000. Selling price is equal to 852,800. Book value of the asset is equal to 1,80,000. Economic life of the asset is estimated as 8 years. Minimum lease rentals payable by the lessee has fixed at 1,60,000 payable annually beginning from 31st March. So they are also telling you about MLP is fixed at 1,60,000 economic life is 8 years. They are giving you the discount rate. Calculate the net effect in the statement of P&L in the books of Mansi Limited. I will try to open. I want to have both the solution and the question the same. If you have question and this simultaneously, it is
You can
easy.
take a screenshot of
Hmm?
take a screenshot of
It is now okay. Nineteen. 6. And here also I will have the answer because this is a very different model compared to what we have seen. Yeah. Mansi has sold the plant. So this is the selling price. And this is the book value. Net effect in the statement of P&L is being asked. On reading the question, first we should try to understand what is this transaction about. We have sold the plant and the sale was a part of a package where the asset is leased back to Mansi for 8 years term. There is a sale and also lease back. The lease back is happening for 8 years term and the economic life is also 8 years. So the lease back is resulting in a finance lease and not an operating lease. In our study material questions only on operating lease is there. This is resulting in a finance lease. If it is a finance lease, we have to discuss on something else. But before we move into that, have we made a profit or a loss on this transaction? What is the selling price? 8,52,000. $852,800 is the selling price. Carrying amount on that date was 1,80,000. 672,800 is the profit. This profit which we are making, how are we to deal with it is the question. If it is a finance lease, let me elaborate what happens in a finance lease. Mansi is having this asset. Mansi is selling this asset to Akash. When the asset is sold, who is going to have the risks and rewards of the asset now? Akash will have. So risks and rewards have been transferred to Akash. Then Akash is entering into a lease agreement and giving the asset back on lease to Mansi. That lease is resulting in a finance lease. So now, who is having the risks and rewards? Mansi. Because it is a finance lease. In finance lease, risks and rewards are with the lessee, not with the lessor. So Mansi is going to have it. So in effect, did Mansi Limited transfer any risk and reward by this transaction? Not at all. It's only a contract when the asset is also with Mansi only, risks and rewards are also with Mansi only. So do you see actually a sale transaction happening in substance? No. There is no transfer of risks and rewards. Hence, here, whatever is the profit should not be recognized immediately. It will only be deferred and amortized. There's no other option for finance lease. For operating only, you have to check. For here, it is always deferred and amortized. We will read the suggested answer here. Net effect of profit or loss should be judged whether the lease is a operating or a finance lease. Lease term is for 8 years. Lease term is for 8 years and economic life is also 8 years. So this is the first condition where lease term covers a major part of asset's economic life. We have to check whether it's a finance lease. So you have to first answer that criteria. Second criteria which we can check is PV of MLP is substantially equal to fair value of the asset. PV of MLP. MLP here is 1,60,000 into present value factor 10%, 8 years. So if you do 1 divided by 1.1 equal to M plus, like this. If you do for 8 years, you should be getting 5.335 as the factor. That if you multiply with 1,60,000, you will have 853,600. What is the fair value of the asset at the inception of the lease? 852,800. That's only the price at which you sold. So it is substantially covering the fair value, hence the lease is a finance lease. First, you will have to talk about this. Now that this lease has resulted in a finance lease, next we will have to talk about the sale and leaseback. If sale and leaseback transaction results in a finance lease, profit of 672,800 cannot be recognized immediately. It should be deferred and amortized over the lease term in proportion to the depreciation of the leased asset. You will have to defer and amortize it. Because in your books, what is related to asset in our books is the depreciation. So in lessee's books, it is going to be amortized in the ratio of depreciation. And then you'll have to do the number calculation. You'll have to find out what for depreciation, debit comes as 106. This 850 divided by 8, you will get some number 84,100. The net debit for this is 22,500 per annum. This is a very different model question, must revise after the class also. You please go through this. Next, we will go with May 25 RTP. It's a very simple question. Sun Limited, the same thing which we had done under Suraj Limited has come as Sun Limited here. Instead of Suraj, they put Sun. 30 lakhs is the cost. 14 is the useful economic life, 3 years is the lease term. So we are the lease term does not cover a major part of assets economic life. 3 lakh is the lease rentals. If you bring it down to the present value term, it will be way lesser than the, that is, it does not substantially cover the fair value also. So this will be classified only as an operating lease. Jan 25 RTP question. You'll have to find out the unearned finance income. Unearned finance income, for that what you need is gross investment in lease minus net investment in lease. Jan 25. We will just quickly just see off the calculation. See how they have written is unknown finance income is gross investment minus net. What is gross investment meaning? the cash flows that arise during the lease term and also at the end of the lease term in the books of lessor. So during the lease term, what cash flows arise? Lease rentals. Plus at the end of the lease term, what does arise? What arises is GRV plus UGRV. That is the gross investment in lease. Net investment in lease, you will tell, is the present value of all of this. So gross investment we will calculate first. Okay, I'll remove the answer. Can you just calculate in your calculator gross investment in lease? 4 lakhs per annum, 5 years we are going to pay. So 4 into 5 plus GRV, which is 0.8. Expected is given, so 0.7 is the UGRV portion. 21.5 is the gross investment in lease. 21.5. Next, we will have to find out the net investment in lease. What is net investment in lease? Present value of lease rentals, GRV and UGRV. You have to bring it down to the present value terms. How to find a present value? We will write the cash flows. We will write all the cash flows. First year 4 lakhs, next year 4 lakhs, third year also 4 lakhs, 4 lakhs, fifth year 4 lakhs, and then GRV plus UGRV, I'll write it as a together number. This we have to discount it to present value terms. Discount values are also given to you. Use that, bring down to the present value. 14, this one. Thereafter, this minus this will.
You've been given fair value. You can't take that as net investment. You have to find PV of them, like all of those, and then because technically, if you say net investment is against fair value, it doesn't make sense. The answer is negative. There's no income if you do 21 minutes.
But see, generally, if they give you fair value and they are asking you, meaning directly, if they give you net investment in these, and there is no other way you can find out net investment in these, only then you will take the fair value to be net investment. If you have some other information through which you can find out net investment, you will try doing this formula, present value of all this. If you can't work it out that way, then you are going to assume net investment to be fair value. That is only an assumption you make. Okay, so with this AS 19 we are through with. PS2 deals with valuation of inventories. This standard has the word valuation. The focus on this standard is not more on recognition principles. It is only on valuation principles, which means measurement principles only will be under discussion in this standard. We will start with understanding the scope, objective, and then we will enter into definitions. Objective of the standard is to prescribe the accounting treatment of inventories. Scope. This standard does not cover the following inventories. Inventory of construction contracts, because it is covered by AS7. Service providers also to some extent is covered by AS7, AS9, so it is excluded from this accounting standard. There was some MCQ question asked where shares, debentures held as stock in trade, is that covered by AS2? Answer is no. AS2 specifically tells if you're holding any financial assets as stock in trade like shares, debentures, it is not going to be covered by AS2. Whether it will be covered by AS13, answer is 13 also excludes that from its coverage. But by industry standard, we will value shares or debentures held as stock in trade at lower of cost and market price. Whichever lower, we value this. But that is as per the industry standards. Accounting standards don't tell that. So, because there's a separate standard on financial instruments which comes in the Ind AS literature, that's why both these standards are excluding shares or debentures that are held as stock in trade. Producers' inventories of livestock. Suppose you are having any plant or animal, that is tree or animal. In that case, those inventories will not be covered under AS2, because in Ind AS there is a separate standard for agriculture. That's why they have excluded it from AS2 coverage. But point to be noted here is what inventories is excluded is really producer, the one who the farmer's inventory only is excluded. Suppose I am buying some that is any agricultural produce for the purpose of selling, that will be covered by AS2. Only producer's inventory is excluded from the standard. This is about the coverage. What I want you to remember is only two things. One, shares, debentures held as stock in trade not covered. Two, producers' inventories of livestock, agricultural produce not covered. Any other person's inventories of agricultural produce will be covered by AS2. Definition. The only definition which we will learn in this standard is the word inventories. Not very important though. It is in application of this question, there's only one study material question which applies it, otherwise not really asked in the exam. Inventories are assets. The word assets is used, it does not tell whether it is tangible or intangible. So even intangible items can be forming part of inventory. Inventories are assets which are held for sale in the ordinary course of business, or used in the production process, or it will be consumed in the production process. Either using or consuming in the production process, that will form part of inventory. There is one study material question. We will go through with that, question number 9. It's 2. Question number 9, let's read. Alpha Limited sells flavored milk to customers. Some of the customers consume the milk in the shop. While leaving the shop, the customers leave the empty bottles and the company takes possession of these empty bottles. The company has laid down a detailed procedure for accounting these empty bottles, which are sold by the company by calling tenders. We have to decide whether inventory of the empty bottles is an asset to the company. First, whether it is an asset, and if you tell it is an asset, is it an inventory that is covered by AS2? These are the two questions. So first, to decide whether it is an asset, you will have to define what an asset means. An asset is, can we complete the sentence? Asset is a resource controlled by the entity from which FEB is expected to flow to the entity. Asset recognition criteria is, it is probable that FEB will flow to the entity and cost can be measured reliably. In this case, is there any probability that FEB will flow to the entity? Empty bottles, will it fetch anything to that entity? Yes, because it will be able to sell the bottles. It is given somewhere. It will be
sold by the company.
Yeah, they will be able to sell the bottles. Hence, FEB will flow to the entity, and company is able to sell the bottles by calling tender. So it can be considered that FEB is probable and empty bottles can be recognized as an asset. That's the first thing. Second, you have to answer whether this is going to be treated as an inventory or scrap. Scrap means we give it very, very insignificant importance. For inventory, we will give it little more importance. From the question, what we understand is company has laid down a detailed internal record procedure for tracking these empty bottles, which means we are giving it importance. Hence, it cannot be treated as scrap. It will be treated only as inventory. With materiality is the base for deciding whether it is scrap or inventory. Since it is material, it will be considered as part of AS2. Next provision. There is no other recognition criteria. Principal, that is probable FEB inflow, cost can be measured reliably. Same recognition criteria, we are entering into measurement of inventory. This standard is pretty simpler because you know the measurement principles from school level itself. Only additions, up to 3 additions, additional points we will see. Otherwise, this is very easy. Inventory is going to be valued at lower of cost and NRV. What does cost mean? What does NRV mean? That we will understand. Cost. The word cost, under PPE also we define the word cost. Under PP, what is the meaning of cost? Purchase price plus directly attributable cost plus present value of decommissioning and restoration cost. Here, the third part is not relevant for inventory. So what does cost mean here? Cost is purchase price plus directly attributable expenses will be forming part of cost of inventory. So cost is cost of purchase plus directly attributable cost. Apart from that, there is an extra cost which will come as cost of conversion, because you're going to buy that item, do some modification, production, then sell it. So cost will be cost of purchase plus cost of conversion plus other cost, which means other directly attributable cost to bring the inventory to the location and condition. This breakup I have just shown here. Purchase price minus all this is just extra, plus any non-refundable duties and taxes, plus directly attributable expenses. Directly attributable examples given by the standard is freight, insurance, brokerage to purchase the asset. What is forming part of cost is not so important, whereas what is important is what does not form part of cost. Overheads, general administration overheads, abnormal losses, will not storage cost. I've given, but I don't know where I've written it here. Yeah, here. Exclusion from the cost. What all will not form part of cost is 1. Losses will never form part of cost. Whether it is operating loss or abnormal loss, it will not form part of cost. Storage cost also will not form part unless that storage is necessary part of production. General admin overheads and selling overheads. These are all will not form part of cost of asset.
Secondary packing cost.
Packing cost also, if the packing cost is incurred to bring that item to saleable condition, then packing cost can form part of cost. Suppose that packing is only extra, that's not really necessary to bring it to the saleable condition, then that is called a secondary packing. It will not form part of cost of the asset. That's about the word cost. Now we will enter into, after cost of purchase, we are entering into cost of conversion now. Cost of conversion. Now, suppose an entity decides to manufacture products and sell it, they have 3 costs: material, labor, and overheads. These are the 3 production costs. Material is captured under cost of purchase, and cost of conversion is labor and overheads. For cost of conversion, labor, how do you take labor cost into valuing inventory, into arriving at cost of inventory is actual whatever paid will be considered as the labor cost. For overheads, there is something called as absorption of overheads, where you have to find out what is the overhead per unit. To find out overhead per unit, what you will do is total overheads divided by the capacity of utilization, we call it capacity. This capacity, you should always, you should generally take actual capacity, in the sense, overheads, there are 2 types of overheads. One is the variable overhead and the other is the fixed overhead. Variable overhead will be absorbed based on actual capacity. fixed overhead will also be absorbed based on actual capacity only. However, there's an exception here. Based on actual capacity only. However, suppose actual capacity is equal to normal capacity. Have you been efficient or inefficient here? Efficient only. Suppose actual capacity is way lesser than normal capacity. We have been inefficient in manufacturing the items. I could have manufactured 10,000 units, but I manufactured only 8,000 units. In case of inefficiency, the denominator now will not be actual capacity, it will become normal capacity. This we can coin it as fixed overheads can be absorbed based on actual capacity or normal capacity, whichever is higher. That's only fixed overheads absorption. We will look at a question. It's a study material question. Example 2 from the study material. Page number 5.7. ABC Limited has a plant with a capacity to produce 1 lakh units of product and expected fixed overheads is 18 lakhs. Fixed overheads is okay. Now we are going to see about 3 capacities. Actual is 1 lakh, actual 90,000 and third is actual is 1,20,000. Again, I want to bring back the provisions to your mind. Fixed overheads should be absorbed based only on the actual capacity. Only if you think that you are inefficient, then you will go for normal capacity utilization. So let's start with the first thing. What is the fixed overhead? 18 lakhs. Have you been efficient or not? What is the normal capacity? 1 lakh. How much have we produced? 1 lakh. We will continue with actual capacity in the denominator. So 18 lakh divided by 1 lakh per unit, the overhead is 18 rupees. This is better to say. 18 rupees per unit. So totally overhead absorbed is 18 lakh, incurred is 18 lakh. There's no under absorption. Next. Anyway, this is just extra calculation which I did. Otherwise, if you stop with 18 per unit is enough. Next. Suppose you have been able to manufacture only 90,000 units. Your capacity was to manufacture 1 lakh. What will be the denominator? 90,000. Normal capacity 1 lakh. 1 lakh. So 18 lakhs divided by, you have been able to manufacture less, that is the inefficiency. So you see, what will happen if you take 90,000, I will tell you. 18 lakh divided by 90,000, what is the overhead per unit? 20. Suppose you do 18 lakh divided by 1 lakh, overhead per unit is 18. By you being slower in manufacturing, your cost cannot increase. It is a loss. 2 rupees is not a cost but a loss. So if you absorb based on the actual capacity, you are taking loss as part of cost. That's why you're not allowed to do that. If you're inefficient, go by normal capacity. It's your choice where how you want to remember this or this, whichever higher you want to remember, or you want to remember it as inefficiency means normal capacity. That is your choice. Third way, actual is 120, whereas your capacity is only 1 lakh. You will continue with actual itself. That is, the denominator will be 18 lakh divided by 1,20,000. 15 rupees per unit is the overhead per unit. That was just a conceptual question. We will take up this question also. Illustration 4 also we will quickly revise on. 5.14. illustration 4. Material cost 200, direct labor 40, direct variable overhead 20. Fixed production charges on normal working capacity is 2 lakh kgs. Normal capacity is 2 lakh, fixed overheads is 20 lakhs. 4,000 kgs of finished goods are in stock at the year end. We have to value closing stock of 4,000 kgs. That is what we are required to do. We are required to value the inventory per kg of finished goods. We are having 3 costs here: material, labor, variable overheads. Material cost 200 plus 40 plus 20 plus you have to add fixed overheads here. Fixed overheads is given to you as a total 20 lakhs. Your normal capacity is 2 lakhs. How much did you manufacture? Not given. Actual capacity is not given. So you take normal itself in the denominator. There's no other choice. You will take normal 2 lakhs and arrive at fixed overheads is 10. Add 10 and you will have the total cost. Total cost into 4,000 will give you the value of inventory. NRV is not given. If NRV is given, you will compare both and then decide on the value of inventory. Next, we are going to enter into special situations. I'm going to talk about what about losses. Then we will talk about joint products, byproducts, and finally we will come to NRV discussion. Losses and inventory valuation. What if there is a loss? Normal loss is considered as part of cost. You don't have much questioning on normal loss part. What they will ask you is value the abnormal loss in a question. Abnormal loss, if it is there, it should be excluded from the cost of the inventory. Provisions writing is not that important for AS2. The question is more on numerical computation only. That's why I'm not stressing more on the provisions part. This abnormal loss should be excluded from the cost of the inventory. Whenever there is an abnormal loss, you will find out what is the revised cost per unit. Revised cost per unit is equal to total cost divided by good units that are left after normal loss. This formula you have to remember. We will go over a question for this. Illustration 3 we will see. Just a minute, I will download the correct file. It's not the right file. From the study material, let us do question number 6. Study material. Is AS2. Question number 6. Capital Cables has a normal wastage of 4% in the production process. Capital Cables has a normal wastage of 4% in the production process. Company used 12,000 metric tons of raw material costing 150 per ton. At the end of the year, 630 of it was as wastage in the stock. The accountant wants to know how this wastage is to be treated in the books explain the context of AS2. Company used 12,000 metric tons of raw material. 4% is normal waste, and at the end of the year 630 was of wastage was in stock. To find out 4%, now 630 is the wastage, apply 4% on 12,000, comes to 480 only. Normal loss as per what the company expects is only 480. Hence, the balance 630 minus 480 will be abnormal loss, which is 150 metric tons is abnormal loss. What we are asked to do is find out what is the treatment of normal loss and abnormal loss, and also find out the amount of abnormal loss. You'll have to tell first that normal loss can be forming part of the cost of inventory because it is an expected loss, whereas abnormal loss should be excluded from the cost of inventory. They should be charged off to P&L in the period in which they are incurred. Next, whenever there is an abnormal loss, you will have to find out, whenever there is a normal loss, you'll have to find out what is the revised cost per unit. What you're going to do is total cost is 12,000 into 150 comes to 18 lakhs, divided by, you're going to spread the cost over the good units that are left after normal loss. Good units left after normal loss is 12,000 minus 480, you will get 11,520. So 18 lakh divided by 11,520, 156.25 is the revised cost per unit. This revised cost per unit you will use to find out the value of abnormal loss, which is this into abnormal loss number of units is 150. So this into 150 will give you the value of the abnormal loss, which is 23,437.5. This cannot be shown, cannot be included in the cost of inventory. It should be charged to P&L. So for abnormal loss, this is the only type of question possible. Now we are going to do joint product byproduct valuation. Joint products. Suppose a manufacturing process is resulting in two products, product 1 and product 2, and both are having significant market value. We will call them as joint product. Whereas one product is having significant market value and the other one is having a very, very small realizable value, we will call this as byproduct. Then this will become the main product. So joint products and byproducts, if you have this common processing cost, how will you allocate is the question which we will try to answer. If you have already done cost accounting paper entirely, this is not something new. You already learned cost accounting also. If you are doing allocation of cost for joint products, what we will do is we will take out the common cost that is incurred to manufacture these products. Common cost means cost till the split off point. This is called as split off point. After this, the products will be processed separately. So we will find out the total common costs up to the split off point. That common cost has to be bifurcated between product number 1 and product number 2. On what basis we bifurcate is, our basis will be what is the net realizable value for these products. On that basis we are going to bifurcate. But only one place or one point which you can go wrong is When I tell NRV of these products, you will not take NRV per unit, but you will take the total NRV for the purpose of bifurcation of the cost. Total NRV of both the products should be taken. We will just go over an example question. Or I'll finish a byproduct also, then we can do one question with everything. I repeat, if it is joint product, the total common costs are going to be split based on the total NRV of the products. If it is byproduct, byproduct means one product is significant, which we call as main product, and the other one is byproduct. Total joint cost we will find out. What I need is, what is the cost of main product I need? For that, what we will do is total joint cost minus the NRV of byproduct. If you remove, we will be left with cost of main product. We don't spend time in bifurcation of cost between main and byproduct. Byproduct is a very, very nominal value which you're going to realize. So you will just deduct the NRV of the byproduct from it and arrive at the cost of the main product. We will take up recent RTP question for this. Want to have the solution also parallelly running, so that once we are reading the question, we can also see how it is solved instead of working it out in the classroom.
This in the
Okay, so we will read the question now. Raw material is 700, that is closing stock of raw material 700, cost price per unit 35, replacement cost 20, finished product is given to you. This is the closing stock of all this. Raw material is given to you, finished product is given to you. Next, fixed overheads was 95,000, which includes go down rent of 15,000. Go down is used for storing finished products. Storage cost is here. Besides two main products, 1,000 units of a byproduct also emerged in the production process, which was sold at 12 rupees per unit after incurring an expense of 2,500. 4,800 was realized from scale of scrap. The average market price is 160 per unit for FP1 and 100 per unit for FP2. Calculate the value of closing stock as per AS2. Just go over the question for a minute and then we will start discussing. Okay, shall we discuss now? We are asked what is the value of closing stock of zinc limited. This is a comprehensive question, involves most of the provisions which we have seen so far. Closing stock of zinc limited is having two components in it. One is raw material and the other is finished goods. First, we will value with the finished goods. In finished goods also, they have FP1, FP2. There are two products. Production is 3000 and this one. Closing stock is so much is given to us. First, before we start with main product, we are also given an information that there is another byproduct which comes out of this process. So one production process is resulting in three items, FP1, FP2 and B1. To identify the cost of FA, now I need individual cost of FP1, individual cost of FP2 and B1. How do we approach it is, first we will take up total cost. From this I will deduct NRV of byproduct. What I will get is cost of the main product put together, cost of the main products. Now this main product cost, we will have to split it product wise based on the NRV. I'm at an NRV, it will be total NRV, we are going to split it based on. Till then we will move with the question. Then we will see what is the next step to be done. So first is we have to deduct the NRV of the byproduct. What is the total cost? We'll calculate that. Total cost is material consumed is 3,20,000. That is the material cost. Thereafter, labor cost is 1,60,000 and direct expenses is 78,000. Fixed overheads, 95,000 is the fixed overhead. Storage costs do not form part of cost. That too is finished products, which means the production is already over. So deduct the 15,000. What you have will be 80,000 as the fixed overheads. Total this 6,38,000. Step 1, I am trying to find out what is the total cost. Total cost. From this, if I remove BY value, I will be left with cost of the main products. What should I remove for the byproduct is the NRV of the byproduct. NRV of the byproduct is calculated as follows. Question tells that the byproduct can be sold at 12 rupees per unit. Yeah. Byproduct is sold at 12 rupees per unit. So how much is the number of units of byproduct?
1,000.
1,000. It's given there, it's 1,000 units of byproduct. 1,000 into 12. 12,000. But you have to incur 2,500 to be able to sell it. So minus 2,500. 9,500 is the NRV of the byproduct. So 6,38,000 minus 95,000, sorry, 9,500. 6,38,000 minus 9,500. 628,500. This 628,500. Apart from this, there was also sale of scrap. Actually, this should have been deducted even before we enter into this calculation. We should have deducted 6,38,000 minus 4,800. We should have deducted that time because that will not form part of cost. It's net cost only which we should take. So you will have to So while calculating cost itself, 6,38,000 minus 4,800, the total cost which we should write will be 638,000 minus 4,800, 633,200. From this, we will deduct the sale value of scrap, which is 14,000, which is 9,500, 623,700. Able to follow this? We have to take all the cost elements. All the cost elements here mean material, labor and expenses, fixed overheads, and deduct any scrap value which you got. So cost of the main products both put together is 6,23,700. Now we have to allocate that cost between the products. 623,700 should be allocated between the main products on the basis of NRV. I should be scrolling here. How much of FP1 has been we have been able to sell is 2,000. See, we have produced this much. I will do the calculation and show it here. 623,700 is the joint cost allocated. This is the joint cost. This should be allocated based on the NRV of the products FP1 and FP2. NRV is NRV per unit is NRV details the price at which we were able to $3,000 and $1,600 are the output manufactured. What is the sale price per unit? Means 160 is for F1 and F2 is 100. So total sales value from the output that you manufacture is 4,80,000 and 1,60,000. Based on this, we will have to allocate 623,700. 623,700 allocated based on the NRV. So 4,80,000 plus 1,60,000 comes to 640. 623,700 divided by 6,40,000 into per unit is 160. Can we just do the calculation together for this? Total cost is of the main product is 623,700. We have to allocate it allocated based on the NRV. How many units have been sold is not given to us in the question, whereas what is given is how many units produced. For us, production only is relevant because we are trying to allocate the cost of production. So whatever units produced, that you will value it at NRV and find out what is the NRV of those products. NRV of FP1 and FP2, let us find out. How we do it is 160 is NRV per unit and 100 is the NRV per unit. This into products manufactured is 3000 here, and for here it is 1600. If we calculate it, it comes to 4,80,000 for FP1 and 1,60,000 for FP2. This 623,700 should be divided between FP1 and FP2 based on the NRV. So total NRV 480 plus 160 comes to 6,40,000. So 623,700 NRV is 6,40,000 means for 4,80,000 NRV, how much is the cost? 623,700 into 480 divided by 6,40,000. You will get 467,775. Same way we will do for FP2 also. 623,700 is the cost for an NRV of 6,40,000. So how much is it for 623,700? Comes to, wrong in the typing. Comes to 155,925. This is the split up of total joint cost has now been bifurcated between these two. This is the cost of production. We need cost of production per unit. How many units of FP1 was manufactured? FP1 3,000 units were manufactured and FP2 1,600 units were manufactured. So 467,775 divided by 3,000 will give you 155,925. This is the cost per unit. And other one 155,925 divided by 1,600 will give you 97.45. This is the cost per unit. Why am I doing all of this? I have to value inventory. For inventory, I need cost and NRV, whichever is lower. What we have found out so far is cost of FP1, FP2. We have found out the cost. Cost is 155.925 and 97.45. NRV is 160 and 100. Now we have to decide on the inventory value. Cost or NRV, whichever is lower. For the first one, we valued at 155.925. For the other one, we valued at whichever is lower, 97.4. This is the per unit. You will multiply this into number of units lying in the closing stock, which is 500 and 300. So if you do 155.925 into 500 M plus, next 97.45 into 300 M plus.
They rounded it up.
Okay, they have rounded up. They are shown separately. FP1, FP2. We added together. Okay, so this question is for sure to try. This involves most of the concepts. Now we'll move to NRV. NRV is very simple. Net realizable value is selling price minus cost to sell minus cost to complete will give us the NRV. We will see NRV meaning for raw material, WIP and finished goods separately. For raw material, we will see it last. For finished goods, we will start. Finished goods NRV is whatever selling price minus cost that you incur to sell the product should be deducted. Whereas for WIP, it is selling price minus cost to sell should be deducted and also cost to complete should be deducted. Because it is not yet over, you will have to deduct the cost to complete and you will find the NRV. Once you find the NRV, you will compare that with the cost and then decide at what value should you show. For raw material, you are not having the raw material with the intention to sell it. So raw material will be valued only at cost, not at net realizable value. However, if the finished goods in which you are incorporating this raw material, that finished goods has fallen down in value, then raw material will be valued not at cost but at replacement cost. Based on this, we will try one question where raw material is going to be valued at raw material valuation. What you should check is if FG is sold at cost or below cost, then if FG is sold at cost or above cost, which means are you going to make a loss on finished goods? No, you will continue to value RM at cost. Suppose you think you will make a loss on sale of the finished goods, then value that at replacement cost. The raw material should not be valued at cost but at replacement cost. Okay, we will take up this 26th question now. Calculate the value of raw material and closing stock based on the following information. Closing balance of raw material is given to you. This is the send back credit, freight inward, unloading charges and replacement cost. Finished goods. Closing balance is 1200 units and this is the information of the costing. Total cost for production is 220 plus 60 plus 40. 320 is the, I'm just showing the calculation. 220, 60, 40 plus fixed overhead should be done. 2 lakhs and normal capacity 20,000. 2 lakhs divided by 20,000, 10. If you add, it will come to 220 plus 60 plus 40 plus 10. 330 is the total cost of that inventory. For finished goods, you will compare this with the NRV. What is the NRV first case? 400. Has the value fallen down? No, we expect to sell it at profit only. So the inventory will be valued at cost or NRV, whichever is lower. So inventory will be valued at 330 rupees only. In this scenario, raw material will be valued at cost, and the cost of raw material is total cost of raw material.
We've taken material consumption.
Raw material cost is 220 per unit. So we will value the raw material at 220 only. If the NRV is 300, the finished goods will be valued at 300 rupees per unit, and in that scenario, raw material will not be valued at cost but at replacement cost, which is 150. You will have to find, you'll have to do rate into the quantity and get the total amount. Okay, so with this, our AS2 discussion is through. What all we have covered, if I have to go with for a snapshot presentation, 5 minutes we will just AS2, we covered scope. It is not applicable to WIP of construction contracts, WIP of service providers, any shares or debentures held as stock in trade, and fourth one is producer's inventory of livestock. Inventory meaning, inventory are assets that are held for held for sale in the ordinary course of business to be used in the production process or to be consumed in the production process. After which we enter into measurement criteria. Measurement criteria is where we will measure inventory at cost. Cost includes 3 parts: cost of purchase, cost of conversion, and directly attributable cost. Cost of purchase means material cost. Cost of conversion means labor and overheads cost. Here what we learned was overhead absorption or allocation. Fixed overheads can be divided to variable overhead will go as per actual capacity and fixed overhead will go as per actual capacity or normal capacity, whichever is higher. Next, what we had seen was losses. Losses are of 2 types, normal loss and abnormal loss. Normal loss can be considered as part of cost, whereas abnormal loss cannot be added to the cost. It should be debited to P&L. Whenever there is a normal loss, you will have to find out what is the revised cost per unit. Revised cost per unit will be calculated as total cost divided by good units that are left after normal loss. This cost per unit will be multiplied into the abnormal loss in terms of units to get the value of abnormal loss. This is the first thing. Next situation we came across was joint products and byproducts. If it is byproduct, I'll start with byproduct. Total common cost, total joint costs we will take. From this we will deduct for the byproduct. What is applicable is the NRV of the byproduct should be deducted, and what we get will be called as the cost of the main product. Cost of the main product. This cost of main product has to be divided between, say there are 2 main products, product number 1 and product number 2. There are 2 main products. You have the common costs. You will have to divide it based on the NRV. Please remember never to take NRV per unit for this division. What we did was NRV per unit into units that were produced. Produced only is relevant because this cost that you're bifurcating is the production cost. So you're going to base it on more the production, more the cost, lower the production, lower the cost. That's why we take production produced units. We get the total NRV. On this basis, we will split the common cost. This was about joint product by product. After this, we enter into NRV discussion. NRV for finished goods, it is selling price minus cost to sell. For WIP, it is selling price minus cost to sell minus cost to complete. And for raw material, we don't need, no need to find NRV for raw material. Raw material valuation will be based on the FG valuation. If finished goods are valued at cost, then raw material, no problem, we will value it at cost. But if you have to write down the value of finished goods, which means cost versus NRV, NRV is lower. In that case, we are given to understand that the market value of the product is falling. Hence, raw material will not be valued at cost, but at replacement cost. That's all. This is only the coverage of AS2. Okay, we will stop here. So we are beginning with the MCQ questions on accounting standards which have been discussed so far. Primarily, I will be selecting questions with asset-based accounting standards, or AS7, AS9, AS12 also. I will select questions. I will see how much you're able to answer and thereafter decide whether I have to cover any of these accounting standards again. That is revision, whether I have to do it with you. Vikram Limited, Mr. Vikram took a loan. Vikram took a loan of 6 lakhs, carrying interest at 10% per annum on 1st August to purchase raw material. He purchased 4,000 units of raw material at 125 per unit. So totally 4,000 units of raw material have been purchased. Labor charges and variable overheads incurred are 1 lakh to produce 1,000 units of finished goods. 1,000 units of finished goods are produced with raw material. For every unit of finished goods, 2 units of raw material are required. So out of 4,000 raw material which we have purchased units, 2,000 units will be required for finished goods manufacturing. NRV of the finished good is 300 rupees per unit. All the finished goods produced are lying in stock as on 31st March. So finished goods closing stock of finished goods will have 1,000 units lying in the stock. Whatever have been produced is there in the stock. There is no opening stock of material or finished goods. Next, Vikram is using 1,500 units of raw material for constructing an asset which is a qualifying asset. So they are now entering into AS16 here, because qualifying asset what comes? What is a qualifying asset? It is an asset that necessarily takes a substantial period of time for it to be ready for its intended use or sale. Labor and other overhead charges incurred for constructing the asset are 90,000 rupees. Vikram also paid 15,000 to install the asset at factory premises. So this is all the asset cost. Raw material is 1,500 units. Apart from that, there is labor charges and there is installation cost. Vikram used balance of loan proceeds 1 lakh to invest in equity shares of P Limited. What is the total amount of loan taken? 6 lakhs. How much of it is used is not given. How much of it is used for these assets is not given. They tell you that 1 lakh is used for investment in equity shares. Is equity shares a qualifying asset? No. Shares is ready for its intended use or sale from the date of purchase. It is not a qualifying asset. So interest on 1 lakh cannot be capitalized. He purchased 9,000 shares for 1 lakh rupees. So 90,000 is the face value of the shares purchased. He spent 1 lakh on purchasing the shares. P Limited declared and paid dividend at 20% on 30th March. Based on the above information, we need to answer the following questions. I didn't know the answer. Just a minute. I saved another file. Okay. This is also not the right copy. Just a minute. There is one file where without answers. I shared one file with answers first, even before the classes started. September. So much time I spent in working on a file without answers.
Ma'am,
Yes.
the file on the group is correct. Only that the third question.
So let us resume back the discussion. What we are asked is, tell us what is the value of closing stock of raw material and finished goods as on 31st March. Can you parallelly start working out this question? You have to find out what is the closing stock of material and finished goods. Please do it and then please do it in your book and then you can check it from the screen. Even I am parallelly working it out with you. How much of units is lying in the closing stock? 500 units. How 500? 4,000. With this question I don't know how many are able to follow or not follow, whoever are there online. Oh, I have exited from the meeting. In this question, how much of the raw material is then closing stock means 4,000 purchased. Out of 4,000, 2,000 has been used for production. 1,500 has been used for construction of asset. So 500 units are left with the closing stock. Raw material is valued at the cost at which the raw material was purchased. Do you compare cost versus NRV for raw material? You don't. For raw material valuation, it is based on the FG valuation. If FG is valued at cost, raw material is also valued at cost. But if you write down the FG, that is cost is 100, but NRV is only 90, in which case FG will be valued at what value? 90. So if FG gets valued lower, then RM will be valued at replacement cost. This is only the provision. Let us see in this question what is applicable. We will have to now shift to finding out what is the value of the finished goods. Can you please find out the value of finished goods quickly? Finished goods to manufacture, what all we spend? One is the raw material cost, 2,000 into 125 rupees per unit. Can we do it in the calculator? 2,000 into 125, M plus. Next, labor charges. 1 lakh is the labor charges, M plus. That's it. 3,50,000 is the total cost. What is the cost per unit? 3,50,000 we have incurred to produce 10,000 units of the finished goods. 10,000 or 1,000? 3,50,000. The question tells 1,000 units of finished goods have been manufactured. So this divided by 1,000 comes to how much? 350 per unit. What is the NRV of the finished goods? NRV is 300. So 300 or 350, whichever is lower, you are going to value the finished goods at what value? 300. Okay, so 300 into how many units of finished goods are lying? The entire units produced are lying in the closing stock. So 300 into 1,000 comes to 3 lakh rupees. Comes to 3 lakh rupees. Now, raw finished goods 3 lakh. Raw material, what is the value at which raw material is going to be valued? Raw material 125 rupees is the purchase price. Whereas replacement cost, is it given? Please check for replacement cost in the question. Where is replacement cost given? 100 rupees. It is given here 100. So 500 into 100 comes to 50,000. Finished goods 3 lakh, 50,000 is the raw material. Go and check which option has that. Option number D. Finished goods is 3 lakh, RM is 50,000. Anybody who is unable to understand, please raise hand. In that case, I will explain. Otherwise, I'll presume that everybody has understood and move forward. There are 6 of you all on the call. I presume that you'll all follow. Next one. Cost of self-constructed asset as per AS 10. Can we find out the cost of self-constructed assets? Self-constructed, what all have we spent? One is raw material. Can we do it in the calculator? 150 units of raw, no, 1500 units of raw material. What is per unit cost of raw material? 125. 1500 to 125 you will get one number, M plus. Next, we spend money on labor and overhead charges, 90,000, M plus. 15,000 to install the asset, M plus. What is the total cost of thing? 2 lakh. So much, what did you get so far? 2,92,500 you've got, but that is not the answer. Which other cost should you add here? Any
Cost to be capitalized.
Yes, borrowing cost also should be added, because we have borrowed a loan and this asset which you are constructing is a qualifying asset. We'll have to find out what is the interest attributable to this. How are we going to find out the borrowing cost? For that, how much have we spent on this asset? What is the total money borrowed? 6 lakhs. Out of that, 1 lakh is for investing in shares. So out of 6 lakh, 1 lakh goes off for non-qualifying asset which cannot be capitalized. There is balance 5 lakh. Have you used the entire 5 lakhs for the purpose of this qualifying asset? No. No, because 6 lakh is used to purchase raw material only. They have not told 6 lakh is applied for the purpose of qualifying asset. 6 lakh is used to purchase raw material. So, what portion of raw material cost is included in the asset cost is 187,500 only. So, 187,500, on that only you can apply the rate of interest. If you remember, if it is not a specific loan, here this loan is used for multiple purposes. So how much of a loan was used for this, only on that percent interest can be calculated. So 1,87,500 into 10% into 8 by 12. By 8 by 12, we have started this entire construction. But dates are there. I will go with the dates. 1st August you took the loan. 1st August, and we are ending the year on 31st March. So August, September, October, November, December, Jan, Feb, March, 8 months. So 187,500 to 10% to 8 by 12 comes to 12,500. Total answer comes to 305,000. Tricky question where you may forget to do borrowing cost, and even if you do borrowing cost, the higher chances that you can apply on the wrong number. Okay, so if you go wrong with this answer, you will also go wrong with this answer, because here they are asking you how much of interest can be capitalized. How much of interest will be capitalized? 12,500. So whichever option has 12,500 is relevant for us. So we are left with only 2 options by elimination process. Amount of interest to be charged to P&L. How much of interest are we going to charge? What is the total interest we are going to pay? 6 lakhs we have borrowed. On that 10% into 8 divided by 12, we are going to pay an interest of 40,000 rupees. Out of 40,000, how much can be capitalized? 12,500. So the balance interest will be charged to P&L. 27,500 will be charged to P&L. I hope this question has been clear. Last subdivision in this. What is the carrying amount of investment as per AS 13 and suggest the treatment of dividend received from P Limited? Can you please read the options? Anyone turn on your mic and answer. What is the cost of this investment? Is it a current investment or a long-term investment? Is it given in the question? Not given. But have you purchased the shares with the intention of selling the shares? Not really. So you will take it as a long-term investment. Long-term investment, how do you value long-term investment? At cost. What is the cost to you for this investment? 90,000. Did you follow 90,000? Sorry. 1 lakh is the cost of investment. Yes, we have purchased the investment for 1 lakh. 1 lakh is the cost. 9,000 shares purchased for 1 lakh rupees. So that is the cost. We are getting a dividend now. 20% is the dividend on the face value of capital. So 90,000 into 20% comes to 18,000. But this dividend pertains to the year in which you did not hold the investments. It is pre-acquisition dividend. So 1 lakh minus 18,000, 82,000 is going to be the cost at which you are going to carry the investment in the books. So the answer is carrying amount of the investment is 82,000 and dividend is to be deducted from the cost of the investment. Because dividend pertains to the period before we enter into the company. So it is pre-acquisition dividend. Pre-acquisition dividend is deducted from the cost of investment. Okay, let's move to the next question. Eighth question we are going to solve now. P Limited has 60% voting rights in Q Limited. Q Limited has 20. Okay, we will represent the relationship now. P Limited has 60% in Q Limited. Q Limited has 20% in R Limited. Also, P Limited directly enjoys voting rights of 14% in R Limited. R Limited is a listed company and regularly supplies goods to P Limited. So there is a related party transaction. There is a transaction happening between P and R, supply of goods. While preparing financial statements of P Limited, which entities would you disclose as related parties with reference to AS18? You are doing financial statements of P Limited. So for P Limited, who and all are the related parties is under discussion. For P, is Q related? Yes, it is a subsidiary relationship. So it is related. Next, for Q, is R related? Sorry. For P, is R related? Yes. As what relationship?
14 plus.
Yeah, 14 plus 20, 34%. It's an associate. So who and all are related means Q Limited and R Limited. Subdivision C is the answer for that. Q as subsidiary, R as associate. Let's move to the next question, 9. This question is on operating lease, where we have to find out what is the lease rental. Machinery is given on 3-year lease for equal annual lease rentals to yield 20% profit margin on the cost of machinery, which is 3 lakhs. So cost of the machinery is 3 lakhs plus 20% margin on this comes to 3,60,000 rupees. Economic life of the machine is 5 years. The total life. Estimated output from machinery in 5 years is as follows. See, 3,60,000 is the total. That is cost plus profit is equal to 3,60,000. This asset, total useful life is 5 years. How many units can you manufacture over 5 years time? Can you please add up the number of units? 50 plus 1 lakh plus 65,000 plus 85,000. Total number of units is 3 lakhs that can be manufactured in 5 years time. The lease term is only 3 years. So in 3 years, how many units can be manufactured? 1,50,000. This asset cost plus profit, we can recover the entire 3,60,000 over 5 years. That is, by producing 3 lakh only, the entire cost can be recovered. So for 1,50,000, what will be the proportionate cost? 360 divided by 150 into 3 lakh. Sorry, 360 into 150 divided by 3 lakh. 1,80,000 you get? Yes, 1,80,000. This is 3-year rent. You are asked what is the annual rent. So annual rent will be 1,80,000 divided by 3, which will be 60,000. When I did leases, this kind of question comes in MCQ. I had told it that time. There are 2-3 places where such a question comes. In operating lease, you'll have to find out what is the annual lease rental. Okay, next question which we are going to move to is, I am doing only whatever standards I have covered. Suppose you finish off those standards, please come back and finish off all the, if you do these MCQs, it cover plus this plus study material book back MCQs you do should be sufficient. I forgot to include study material book back question MCQ here. Anyway, you have the material, you go through that. This has all the past exam question papers MCQ plus RTP plus all the 8 MTP questions. Everything is included here. So please make sure you solve all these questions as and when you complete those chapters. Let's move to question number 2 now. Scenario 1. We are going to use AS12 also. Let's see whether you're able to follow the AS12 application part. On 1st April 2019, LAC Limited received a government grant of 15 lakhs for acquisition of machinery costing 50 lakhs. The grant was credited to the cost of the machine. So this grant, there are 3 types of grant, okay? I will teach of it. Maybe some may not know. 3 types of grant. One is grant in the nature of promoter's contribution, for which we follow capital approach. Next, grant that is related to revenue. And third type of grant is grant for some fixed asset. Suppose you are receiving grant in the nature of promoter's contribution. Journal entry for that will be bank account debit to capital reserve. You will not take it to P&L. You will take it to balance sheet as reserve, capital reserve. Suppose the grant is related to revenue, where government is giving you money for your day-to-day expenses, for paying salaries to employees, for meeting your electricity bills, for day-to-day expenses. If the grant is coming, the related cost for the grant is there in P&L, because you have to pay salary, only then you will get the grant. Or you have to pay electricity bill, only then you will get the grant. So there is a related cost. So grant will be recognized in the P&L in proportion to the salary cost or in proportion to the electricity cost. So this grant related to revenue will be taken to P&L account. Third type of grant, where you receive grant for the acquisition of a fixed asset. What will you do is, there are 2 options available here. One, you have purchased a plant and machinery for 10 lakh rupees and the government tells that I will meet 2 lakh rupees, 3 lakh rupees cost of your asset. This grant which you are receiving for 3 lakh rupees, we can net it off against the cost and show only the net cost to us is 7 lakhs. This is method 1. Or another method is, in the balance sheet, we keep plant and machinery at 10 lakh rupees only, and we keep the grant separately under an account called deferred GG, government grant account. And as and how we are transferring depreciation to P&L account, in the same proportion, we will transfer this also to P&L account. Okay, now in this question, which type of grant is it? Is it a grant in the nature of capital contribution or revenue grant or fixed asset grant? Means this is for the acquisition of a machinery. And which method is the entity following? Grant was credited to the cost of machine, which means they have adjusted it against the cost. Method 1 is being followed. Life of the machine is expected to be 10 years. Residual value at the end of 10 years is 5 lakhs. Company charges depreciation on straight line basis. Due to non-fulfillment of certain conditions, company had to refund the entire grant. Now, refund of the grant when it happens. When we receive the grant, what would have been the journal entry we passed? Bank account debit to fixed asset account, because it has been adjusted with the cost. So when you refund, what entry we are going to pass? Fixed asset account debit to bank account. We're just going to reverse the entry. Black Limited received certain indications of impairment of the machine and the recoverable amount was estimated to be 28 lakhs. Please note, the refund has happened on 1st April 21. This indication of impairment comes only on 31st March 23. So you're moving from multiple years. You start with 2019, then come to 21, then come to 23, and next there is something on 24 also. The company exchanged the machine by paying cash of 2 lakhs and new machine valued at 18 lakhs. Based on the information given in the above scenario, answer the following questions. Please ensure you answer the questions. I will just come back. What will be the carrying amount of the machine after depreciation for the year? That is 31st March 21. What will be the carrying amount they are asking you? You need to be charging depreciation on 15 lakh, 50 lakh minus 15 lakh, whatever you get, no, on that you should be charging depreciation. $50 lakhs minus 15 lakhs. 35 lakhs on that for 2020 ending, 21 ending. 2 years depreciation should be charged using straight line method. So 35 lakhs minus residual value of 5 lakhs divided by 10 years. Per year 3 lakhs. So 3 you will have to deduct from 35 minus 6, 29 lakhs. So D subdivision is your answer for that. Next, what will be the amount of depreciation to be charged on the machine for the year ended 31st March 22 after you have refunded the grant? So when you refund the grant, the book value of the asset is 29 lakhs plus you have to refund the entire amount of 15 lakhs. So plus 15 lakhs comes to 44 lakhs. That is the revised cost. Now on the revised cost, you will have to find out what is the depreciation. 44 lakhs minus residual value of 5 lakhs divided by how many years are left means 20, 21, 2 years over. We are in 22 ending. So divided by 8. 2 years over, 8 years pending. 487,500 you will get. I hope everybody is able to understand. If I'm just talking, I'm not working out in the note. Is that okay with everybody? Okay, in the absence of more response, I presume it's okay with everybody. So 487,500. What will be the impact of test on impairment on P&L account means? You should find out what is the carrying amount of the asset as on the date of impairment loss testing. So the revised cost was 29 plus 5 lakhs, 34 lakhs. And this date is 1st April 21. So 31st March 22, we would deduct depreciation of 487,500. Then 31st March 23, we would deduct 487,500. And that date only they are having this doubt of impairment. So 34 minus 487,500 minus 487,500 comes to 24,25,000. But the recoverable amount, right on this.
Ma'am, it should be 44 lakh.
Here 44, no?
Yes, ma'am.
Okay. 44 lakhs minus 487,500 minus 487,500. 34,25,000 should be the number. 34,25,000. This should be compared with the recoverable amount of 28 lakhs. So it will come to 6,25,000 is the impairment loss to be charged to P&L. Carrying amount is exceeding the recoverable amount, so impairment loss needs to be charged in the books. Last one, what will be the profit or loss on exchange? Now the revised book value after impairment loss charging is, revised carrying amount is 28 lakhs. You have exchanged the machine by paying a cash of 2 lakhs and new machine valued at 18 lakhs. We will calculate the profit, 28 lakhs
Ma'am, you have to start depreciation for a year.
Okay. This is only on 1st April 2024. So minus depreciation for 1 year, 28 lakhs is the minus residual value of 5 lakhs divided by,
Ma'am, no, there is no residual value. The revised amount will be done.
yeah, we have
Revised.
done with recoverable amount. We have stopped using the cost. We have gone for recoverable amount, fair value. Okay. So because for fair value, we can't use the residual value. 28 lakhs. I think I shouldn't have taken a break after reading the question. I forgot the question during the break time, whatever I read. 28 lakhs. Useful life remaining is
4 years.
4 years. 28 lakhs divided by 4. So 7 lakhs is the depreciation per annum. 28 lakhs minus 7 lakhs, 21 lakhs is the revised, is the carrying amount. Carrying amount is 21 lakhs. I have given cash of 2 lakhs. And we have got a new machine valued at 18 lakhs. So now we have to find out whether we make a profit or a loss. 21 lakhs plus 2 lakhs. Totally asset which went out from my side was 23 lakhs. Whereas what I got is only 18 lakhs. So there is a loss of 5 lakhs on this exchange. Finally, we get a loss of 5 lakhs on this exchange. Okay, we are moving to the next question. Anyway, if we will see a similar model question like this comes, I will, from now onwards, I'll work out a little more in detail. I'll not just do it in the calculator. I think maybe some find it difficult to follow. I will work out the question fully here. AB contractors. We are moving to question number 9. AB contractors fixed price contract of 350 lakhs. Contract price is 350 lakhs. Information related to contract is as given under. Material, labor, unused material is there. Future cost to be incurred to complete the contract. Payment received as part of payment of contract is 150. Machine was used for 4 years for the contract. Original cost of the machine is 210 lakhs. Expected life of machine is 20 years. What will be the profit or loss of the contract? Now, to find the profit or loss, you'll have to compare the contract revenue with the contract cost. Contract revenue with the contract cost. Let us now calculate the contract cost here. Cost will be 125 is the material purchase, but out of that 22 was not used. So remove off 22 from that. 125 minus 22, if we remove, we get 103 as the material cost. Thereafter, labor will be 95 and depreciation on the machinery. Depreciation would be 210 is the original cost. Expected life is 20 years. For the contract, it is going to be used only for 4 years. $210 divided by 20 into 4. 42. Let's try if this works out. 240. Cost to complete is 115. Total cost will be 355. Now percentage of completion we have to find out. To know how much of revenue can be recognized now. 240 divided by 355 into 100. 60 percentage. 60 percentage. Anybody who's getting loss of 5 lakhs? We'll come back to this question. I'm unable to get anybody who's got 5 lakhs as the loss. I will work it out in some time and then tell you. If I'm unable to get it now, I will share it in the group that this is the answer. Give me some time to think through and answer that question. Move to the next question. ACE Limited borrowed 25 lakhs from ABN Bank during the financial year 23-24. ACE Limited used these funds to invest in equity shares of K Limited. K Limited is implementing a project, so with these future prospects, ACE Limited invested 25 lakhs in K Limited. The final question, what is it? Market value of these investments. Identify the correct statement as per AS 16. Okay, we have to apply AS 16 here. So 25 lakhs has been borrowed from ABN and they have invested in shares of K. K is now implementing a project. That project is not complete. The directors of ACE Limited capitalized the interest on loan amounting to 2 lakhs and thus added it to the cost of investment. Market value of these investment is 24 lakhs. Identify the correct statement considering the above facts. Interest paid on acquisition charge, hence directors of ACE Limited correctly added the amount of interest to the cost of investment. You cannot add this cost, this to the cost of investment because shares is not a qualifying asset. So borrowing cost cannot be added. Since project is a qualifying asset, directors of ACE Limited correctly added. They cannot. This is also a wrong statement. ACE Limited invested in shares, which is not a qualifying asset. Therefore, directors are wrong to add the cost. This is only the correct. They should charge it off to P&L. Okay, now let's move to the next question. AS7, again another question comes. Okay, we'll work out this question. We'll see if we can do this one. Gray Limited is engaged in the business of constructing towers since 15 years. Alpha Limited gave a contract to Gray Limited for construction of two towers. Contract price for 2 towers is agreed at 160 crores. Each tower has a contract price of 8 crores. At the time of contract, Gray Limited has estimated the contract cost will be 141 crores. It is assumed that construction will be completed in 3 years. So far what they told is 160 crore is the price contract agreed, with the contract price agreed, and 141 crores is the total contract cost. At the end of year 1, Grey Limited has revised the construction cost to 150 crores. At the beginning of year 2, customer has requested for a variation in the contract. Customer now wants construction of 3 towers instead of 2 towers. The term of the contract will not change. Construction of all the towers will be completed simultaneously. As a result of this variation, contract price will increase by 80 crores and contract cost also will increase by 75 crores. Grey Limited has decided to measure the stage of completion on the basis of proportion of contract cost incurred to the total estimated contract cost. Contract cost incurred at the end of each year is, they give you the contract cost year wise. For the first year, it is 35.25 is the contract cost. And for the second year, 148.5 including unused material. So remove the unused material cost. If you've not used it, it cannot form part of cost. Comes to 146.25. Total year 3 total revised contract cost. Okay, whatever is the total contract cost is the year 3 cost. What is the stage of completion on the basis of proportion of contract cost incurred to the total contract cost at the end of year 1 and year 2? Only first and second year is asked. To find out the percentage, what do we need? Contract cost and total cost. Total cost for the first year. Estimated at the end of year 1. They have revised the construction cost to 150 crores. 150 I will write. Let us check 35.5 cost incurred divided by total cost. 23.5. Okay. So we are having 2 options only with 23.5. Now we have to decide whether it is 66 or 65%. Next, year 2. How much will be the cost here? At the beginning of year 2, customer requested a variation. So they are asking now to construct 3 towers instead of 2 towers. And so because of that, contract cost also will increase by 75 crores. So already what has been revised is 150 plus 75 we have to incur extra. So 225 will be the contract cost. Let's check. 146.5 is the cost incurred till date will be 146.25 plus 35.25. You'll have to add both because cost incurred till date. Is it till date or not? I think it is not cumulative basis. Let's check without cumulative basis. Yeah, without cumulative basis. This year cost only is there. This 146 already includes 35, so don't add it. If it, see, there are 2 ways in which they can give you. One, they could give you cost incurred in year 2 alone, or they can give you total cost incurred up to year 2. This 146.25 is total cost incurred up to year 2. So 146.25 divided by total contract cost 225 comes to 65%. So B is the correct answer. Okay, let's move to the next subdivision. What is the amount of profit to be recognized at the end of year 1? It's very simple. We already know the percentage of completion, 23.5%. What is the revenue for year 1? At the end of year 1, what is the revenue? Has there been any revision in the revenue? No, I don't think, because they are only telling cost has been revised to 150 crore. They don't tell revenue has been revised. So 160 crore itself will take it as revenue. 160 into 23.5% comes to 37.6 is the revenue for that year. Cost for the year is 35.25. So profit is 2.35. Yes, there is an option. 37.6, but with cost comparison, cost is 35.25. So the profit which you get is 2.35. Next one. What is the amount of contract revenue recognized in each year of the contract? You already have the percentages calculated with you. 30, the percentages we have calculated as first year percentage is 23.5. Second year is 65 percentage. Now let us find out the contract revenue to be recognized. This percentage should be applied on the total contract revenue. For the first year, the contract revenue. Contract revenue for the first year is 160 crores. No change happens. For the second year, they go for a revision. So it will increase by 80. So 160 plus 80, if I do, it comes to 240. Let's check whether if we apply this percentage, we're getting in option. 160 into 23.5 percentage. 37.6. Okay, there are two options with 37.6. So if I finish off for year 2, it's sufficient. I need not do for year 3. 240 into 65 percentage. 56 minus the revenue already recognized. Okay, option C comes the answer. How means first year the revenue to be recognized is 160 into 23.5 percentage, which is 37.6. This is the revenue to be recognized for year 1. Coming to year 2, 240 into 65 percentage comes to 156. 156 is on total revenue up to year 2 is 156. I should find out what is the revenue for year 2 only. For year 2 only will be 156 minus 37.6, which comes to 118.4, which means C option is the answer for this. Okay, any doubts on the calculation, please let me know, otherwise I'm moving to the next question. Of course, I'm going it at a little pace, because if I go too slow, I think, we will not be able to complete more number of questions. That's fine. Any doubts, anything which you want me to explain again? Okay, moving to the next question. AS7, only question from a computation viewpoint will be asked. No question on provisions. They ask until unless it is a segmenting and combining question. AS10, we'll read the question. X Limited has entered into a binding contract with Beta to buy a custom-made machine for 2 lakhs. It's a question from study material. We have similar question like this. During the year, X Limited has changed its method because there's a change in the market trend. Before the delivery, X Limited had already changed its production and method of production. New method will require some other machine. So company has decided to scrap the machine after its delivery. Expected scrap is 25,000. So what is the correct accounting treatment? We've done a similar question like this when we did AS10. 2 lakhs is the cost which we have to pay to the supplier who is giving us the machine. 25,000 we can get by selling the machine. So 1,75,000 net is the cost. However, it does not give us any benefit, so the entire amount needs to be charged off to P&L. So option D will be the answer for this. P&L should be debited with 1,75,000. Okay, till now, can I see show of hands of how many people have understood? Shalini, you raised hand, Shalini. I did not see it. Please tell. Yes, Shalini. Okay. Tangam. Okay, Tangam, no response. Okay. If I go way too slow, no, I'm afraid that we may not do questions. So if you think that that's why I just want to know whether the pace is okay. I'm moving to question number question on AS26. ABC Limited is in the business of creating content for various OTT platforms. The company has developed a technical know-how by incurring an expenditure of 25 lakhs. Company started using the asset from 1st April 19. Cost incurred is 25 lakhs. management of the company is of the view that asset has infinite lifetime. This also we have done a similar question when we discussed AS26. Infinite lifetime and therefore has not amortized the asset till date. It is wrong. You should amortize it. Rebuttable presumption that useful life of an intangible asset should not exceed 10 years. So based on 10 years, let us amortize this. It comes to 2.5 lakhs is the depreciation for 1 year. We are going to find out the depreciation for the year ended 31st March. I think we have already covered this question. Yeah, I remember. Okay, we've already done this question. I forgot. Anyway, I've read it, so I'll complete it off. 2.5 lakhs is per year depreciation. How many years over means 20, 21, 22, 23, 24. 5 years are over. So into 5, if you do 12.5 is the total amortization. C subdivision is the answer. 12.5 out of which 2.5 is current year and balance will be charged to PN. Okay, we will do question number, this next question. HIL Limited. We are going to solve. This,
Ma'am?
yes.
In that one question that we left off, AB contractor, I got the total cost of the entire contract as 355 and total revenue is 350, so 5 lakhs loss.
350 revenue. 355 even I got. I will move back. 355 I got that time.
If you do 125 material plus 95 labor minus 22 unused labor.
Yeah, total cost comes to 355.
Yeah. That minus the entire revenue, that's how they take it. I think this is that expected.
I did. Okay. I think they have taken the total profit of the contract.
I also kept doing percentage because this whole time when you were doing other question, this is on the back of my head. This can't be.
I thought that the entire contract not executed because they are telling that estimated future cost to complete the contract is 115 lakhs.
No. The whole contract last line says profit or loss on the contract. So I think they mean the entire contract.
Entire contract. Generally, in such a question, they tell profit or loss only up to the day, up to the percentage they have completed only. They generally can recognize the profit or loss. But okay, fine. I think that's because I forgot to check with this point, Shravani. I got it by it's 5. The contract cost on this, I should have checked for expected loss. This question is actually on expected loss on the contract. Total contract cost is 355, whereas the contract revenue is only 350. So there is already a loss on the contract, expected loss on the contract, which will be 5 lakhs.
This has to be recognized.
That's why percentage of completion is not necessary because it is an expected loss. The question is not on that. That's why they have not attempted to go for percentage of completion. Straight away there is a loss of 5 lakhs based on the contract cost and contract revenue itself. It is a loss-making contract. That's why they are making they have to recognize a loss of 5 lakhs upfront even before the contract is over. Okay. I hope you have followed it. This question is on expected loss on the contract. Total cost on the contract comes to 355, whereas the revenue which we have fixed is only 350. So at that time itself, we know that the total loss that you're going to make on the contract is 5 lakhs. Even if you do by the method which I tried, I think even then you could have got it. I did not check if that expected loss was in your mind. Even with percentage of completion, you can find out. I'll just tell you how. 240 divided by 350 into 100. I tried doing percentage of completion method. I'll try with this. I'll show you. Divided by 350 percentage comes to 60. I'll take it as 69 percentage. Okay. 69 percentage. So for 69 percentage, 350 into 69 percentage, 241.5, whereas the cost that has been incurred so far is 240. So what happens if you proceed with this is you get a profit. You get a profit because revenue is so much, cost incurred is only 240, you get a profit. However, on the contract as a total when you compare, 355 is the cost, 350 only is the revenue. You are making a loss of 5. So you are not allowed to recognize the profit now, because you know that the total contract is going to result in a loss only. You cannot recognize a profit now. You will have to provide for the possible loss in the contract. Hence, 5 lakh loss is the answer. Profit cannot be recognized in the contract. Okay, we are moving back to the HIL question. HIL is based on 9, 13, 11, 24 and 19. Okay, 24 only we are not aware of. We'll see how we can do it. Health India Limited question. Incorporated under the Companies Act is engaged in the production and distribution of medicines. It has manufacturing plants at Baddi and Bhopal. It also imports machines from Pharma Inc., New York. On 1st Jan, HIL sold 2 lakh strips of medicine to D Limited for 50 lakhs on 60 days of credit. Cost per strip of this medicine was 20 rupees. That is, total cost comes to 40 lakhs. So revenue is 50 lakhs, cost is 40 lakhs. D Limited paid 20% of the amount due on 5th January. In March, D Limited is having significant cash flow issues and is trying to raise funds through bank loan to run its operations. However, it is unable to do so and not able to release payment to HIL on the due date. Subsequent to this, it has gone under liquidation on 15th March. At the time when medicine was sold by HIL to D, there was no reason for HIL to believe that it will not be able to collect the proceeds from D Limited. So at the time of initial recognition, there was no doubt whether there is any uncertainty in ultimate collection. No doubt is there. Only later they think that the amount will not be received now. HIL made it. Now this till here it's about sale. Now they move into something else. HIL has made an investment of 200 lakhs in the equity shares of Rose Limited, of which 50% is made in the long-term category and rest as temporary investment, that is current investment. So out of 200 lakhs, 100 is in the long-term category, 100 is in the short-term. We have a similar question like this in study material for AS13. Realizable value of all such investments becomes 50 lakhs as Rose Limited lost a copyright. From the given market condition, it is apparent that reduction in value of investment is not temporary in nature. All the investments put together, the fair value is only 50 lakhs now. HIL imported machine from pharma. So this is about investment. Now they're going to something else. HIL imported medicine from pharma for a sum of $2.5 lakh on 1st January. HIL released full payment only on 17th April. So if you apply AS11 provision, the transaction, foreign currency transaction, should be recognized using the rate prevailing on the date of the transaction. That is the initial measurement. Next, when there is a balance sheet date coming, we'll have to remeasure the amount. And finally, there is a settlement happening only on 17th April. Exchange rates were as follows, and they give you the exchange rate on 1st January, that is only the transaction date. Then 31st March, this is the date of the balance sheet which comes in between. And this is the settlement date, 79. 76 is not at all relevant for us. HIL is working on a strategic plan to close the production unit of Bhopal. Now they're talking about AS24 here. HIL is going to close the production unit of Bhopal due to a change in technology. The board of directors approved the closure of Bhopal plant on 1st March. The company did a formal announcement regarding closure on 10th March. The company entered into a binding sale agreement on 21st April. Reporting date is 31st March. You are asked to answer the following questions. How the recognition of revenue from sales will be done by HIL under AS9? See, 50 lakhs we have is the sale amount. 20% he paid up. So out of 50 lakhs minus 20%, 40 lakhs is still due from him. Okay, with that in mind, we'll search for the option. Revenue recognized for 50 lakhs. Subsequently, unrealized amount 50 lakhs will be debited to bad debts. We have not, subsequent unrealized amount is not 50. Unrealized amount is only 40 lakhs. Initially, we will recognize 50 lakhs and then subsequently, the unrealized amount of 40 will be taken to bad debts account. It's a very simple question. This question is on initial initial recognition and subsequently what you do with it. Okay, moving to A's 13 question. How will you recognize the reduction in the value of investments in the financial statement for the year ended 31st March? Just go through the options silently and then I'll just tell the answer. I'll give you time to think through. Cost is 100. The fair value is 25. Because 50 is the total cost, the fair value of the investment. So category wise, if I split, it will come to 25, 25. One is long-term investment and the other is current investment. Please see which option matches the answer. For long-term investment, will you reduce the value or you will continue to show it at 100 only? No, you will reduce because the fall in the value of investment is not temporary in nature. It is a permanent fall in the value of investment. Okay. So any permanent diminution value of investment should be given effect in the books. Reduction of 75 lakhs in the carrying amount of current investment will be charged to P&L. Reduction of 75 lakhs in the current value of long-term investment will also be charged to P&L. Both the investments have to be brought down to 25. To bring it down to 25, you will do 100 is the cost, 25 you have to have in the books, so 75 will be taken as loss. Whether it is current investment or long-term investment, for both, you will have to charge it off to P&L. Why this answer is, this is out of picture. This is also out of picture because they tell no impact on long-term investment is wrong. Why this answer is wrong is 75 lakhs will be reduced in current investment charged to P&L. For this, they tell it will be charged to capital reserve. That's not possible. That's why option D only is the correct answer. Sorry, option C only is the correct answer. Next subdivision. Next question. Ascertain the loss or gain due to change in foreign exchange rates to be recognized in the financial statement for the year ended 31st March 24. See, there are 3 dates in this. One, the date you enter the transaction. Second, the balance sheet date. And third is the settlement date. They are asking you what is the foreign exchange difference treatment as on 31st March, means subsequent remeasurement alone, you will check it. So if you go through the question, $2.5 lakh. When you recognize dollar rate was 81, now it has become 80. So there is a fall in the value of the dollar. We have to make the payment. So for us, it is decrease in the value of liability. 250 lakhs, 2,50,000, 2,50,000 into 1 rupee. So it is a gain for us. 2.5 lakhs is a gain to be credited to P&L account. I hope you're able to follow, because $2.5 lakh, when we recognized, it was, the currency rate was 81 and now it has fallen down to 80. So there is a fall in the value of liability by 1 rupee per dollar. So there's a gain of 2,50,000 rupees. What would be the date of initial disclosure event to be considered for Bhopal plant? I will show the question, the dates, and then we will discuss. 1st March, board approved the plan. Company made a formal announcement on 10th March. Binding agreement 21st April. The day you formally announce it is the date of that is the discontinued operation. The initial disclosure event will be 10th March, the date of formal announcement made. For AS24, you will not get any complicated question. Maximum, they'll ask you only an initial disclosure event. That's all. AS24 is a very simple standard for us in our syllabus. Though the standard is complex, we don't have all the adjustments. Next question. AS19. X Limited sold plant and machinery having book value of 60 lakhs. Y Limited, a book value of 60 lakhs for 75 lakhs. Selling price is equal to 75 lakhs. Fair value is also 75 lakhs. Okay, they're going to come back to sale and lease back, I think it is. The same plant was leased back to Y Limited, back to X Limited by Y. Lease back is in the nature of operating lease. If it is in the nature of operating lease, we have to check whether there's a nexus between the sale agreement and the lease agreement. And how do we check the nexus? Is selling price is compared with the fair value. Here selling price is equal to fair value, so there is no nexus. Profit on this transaction, profit or loss, will be recognized immediately. So what is the profit made on the transaction? 75 minus 60, 15 lakh is the profit made. That 15 lakh should be recognized immediately. Option B should be the answer for that. It's a very simple sale and leaseback question. Okay. Next, we are coming to a proper AS12 question. Entirely it's only on AS12. So with this, I will know how we will understand how much we know AS12. Surat Limited has received a grant of 40 crores for purchase of a qualified machine costing 90 crores. The residual value is 2 crores and expected useful life of the machine is 20 years. So grant 40 crores, machine cost is 90 crores, residual value of the machine is 2 crores, life of the machine is 20 years. Answer the following questions. Assuming depreciation is straight line method. What is the nature of grant being received by Surat Limited? Is it a non-monetary GG, grant related to specific fixed assets, grant related to revenue, or promoter's contribution? First thing, in your syllabus, you do not primarily have non-monetary government grant. You do not have that kind of grant under discussion. So this option is invalid for us. Next 3 options. This is only for purchase of fixed assets. So second option only is the right option for us. It's a very simple one because you're purchasing fixed assets. Even by reading that, you will be able to answer the question. Surat Limited has a policy to recognize the grant as deduction from the cost of the asset. Okay, so this is an easier method. They go for method 1. They do not go for deferred GG method. So from the total cost is 90. From that they deduct 40. 50 will be the cost. Okay, what will be the amount of depreciation to be charged every year? So we will calculate the depreciation using residual value and life. 50 minus 2 divided by 20. 2.4. Yes, there is an option 2.4. But, there is an option 2.4. Done. Next one. Surat Limited has a policy to recognize the grant as deferred income. So they're going for method 2 now. Under method 2, what they do is in the balance sheet, PPE will appear at cost, which is 40 crores, no, 90 crores. And the grant will come as deferred GG account. What will be the amount of grant to be recognized as other income in the statement of P&L? Now, how much of deferred grant will you push to P&L every year? That's the question. It will be pushed in the same order in which PPE cost is being pushed into P&L. How over what period are we depreciating the fixed asset? Over 20 years time. So just try 40 divided by 20. 2 is their option? Yes. So 2 crore is being pushed every year. It will be moved to P&L in the same ratio in which depreciation is being charged on the asset. So if the PP is depreciated over 20 years, deferred GG will also be depreciated or amortized over 20 years time. That's why 20 division, you get the answer. Next one. If Surat Limited has the policy to recognize the grant as deferred income, what will be the amount of depreciation to be charged as expense in this statement of P&L? So now they're asking how much of depreciation will be charged on this. So 90 crores we have capitalized minus residual value of 2 crores divided by 20 years. 4.4. 4.4. Yes. 4.4 is there. Okay, this is a very simple question on AS12. No complication at all. And I told you there are 3 types of grant. One is grant in the nature of promoter's contribution, revenue grant, and grant for fixed assets. Questions on grant of fixed assets only are mostly asked. So please be very familiar with receipt of grant and refund of grant for fixed assets. That is the most frequently asked question on AS12 if grant is to be asked. We'll move to AS5 question. We will see if we are able to knock off this question also. AS5 talks about extraordinary items, exceptional items, prior period items, changes in accounting policy, and changes in accounting estimates. We will see on what is this question about. Closing inventory amounts to 10,40,000 on the basis of FIFO method. Company decides to change from FIFO to weighted average method of valuing inventory. On the basis of weighted average method, closing inventory amounts to 8,80,000. Realizable value is 12 lakhs. What will be the value of inventory in the books and what disclosure should be given in the financial statement? I'll give you a minute to go through all the options. First thing, when you start reading the option, at what value are we going to show the inventory? 880 or 12 lakhs? Cost or NRV, whichever is lower, which means 880. So these 2 options get eliminated. Don't even read those options. 8,80,000 are 2 options. Now you'll have to decide on which is better, 1 or 2, 1 or 4. Is it enough to show fact that the valuation method has changed, or you should also give what is the impact of the change in the method of valuation? Answer is 4 is the answer for that. AS 1, 4, 5 are very, very simple standards. I have not covered it as such in the classroom. Mostly 1, 4, 5 come, it will only be coming in the MCQs rather than it's a full-fledged question. AS 13. Cost of current investment acquired was 1,000, but the fair value was 800. Current investment is valued at cost or fair value, whichever is lower. Have that in mind. The investment was recorded at 800. Okay, so they've already done that. Now the fair value has gone up to 1,200. I saw 2-3 questions of the same model figuring in the entire, MCQs. This question is pretty important for you to understand. At what value should it be recorded and how much gain be credited to P&L? The cost that you have paid to acquire is 1,000. But because fair value was lower, you brought down the value, carrying amount of the investment was brought down to 800. Now the fair value has gone above the cost itself. In such a case, at what value should the investment be shown in the books? Can we show the current investment at 1200 is the question. Answer is no. You cannot show the asset at a value more than the price that you had paid to purchase the asset. Hence, current investment will be recorded at 1000 and gain of 200 will be credited to P&L. You can maximum bring it only up to the cost. So you will pass an entry as investment will be debited with 200 to P&L 200. With this entry, second option will be the right option. We are moving ahead to the next question. First question here is the same as what we discussed, so I skip it. This is the inventory valuation question. The third question here, it's a very simple one. Byproducts, they are measured at what value? Most of the byproducts are immaterial, so we measure it at net realizable value. Okay, this question is on AS 28. Surya Limited has two fixed assets. FA1 is being carried in the balance sheet for 600 lakhs and FA2 is being carried at 300 lakhs. Value in use for FA1 is 500 and net selling price is 550. So recoverable amount is, if you use you get 500, if you sell you get 550, you will choose to sell only. So whichever is higher, recoverable amount will be 550. Company did upward revaluation last year for 20 lakhs for FA1. As on 31st March, the value in use for FA2 is 350 lakhs and net selling price is 320 lakhs. So recoverable amount here is going to be 350 lakhs, higher of the two. How much is the total impairment loss for the current year for FA1? Please go over and try calculating. What is the carrying amount of FA1 in our books? 600. What is the recoverable amount of it? 550. So what will be the impairment loss? 50. 600 minus 550. 50 lakhs is the impairment loss. Okay, next one. How much of impairment loss will be charged for the current year for FA1 now? Should be FA2.
Ma'am, it is FA1 only. We just did the calculation also for FA1.
Yeah.
550 and 600.
Yes, this is over. Next one.
Yes, so out of the 50 impairment loss.
How much of, okay. How much of impairment loss will be charged to P&L for the current year? Okay. Impairment loss is 50. Out of this, there is a revaluation done. So there is a reval reserve for 20. So charge to be P&L will be only after setting off against the reval reserve. So 30 only will be charged to P&L. Next we'll go to FA2. What is the total impairment loss for FA2? FA2 recoverable amount is 350, whereas carrying amount is 300. So impairment loss is nil. There's nil. It's nil. What will be the carrying amount for FA1? FA1, the carrying amount is 600 minus 50 impairment loss. 550 is the carrying amount. You see, most of the questions, very other standards, like 29, 15, all this, not much asked in the MCQs. What is asked in the MCQs is only whatever we covered, plus I should have been able to cover 145 and 29. 29 also, please make sure you read, because there are 2-3 questions on 29 also. 17, I think only one question I've seen, not much asked in MCQs. 15 also not much asked. 24, only initial disclosure event if you know sufficient. 25, not much asked in MCQ. Debit or credit balance of FCMITD account will be shown where? First of all, this FCMITD account will be shown under reserves and surplus. So this is only the answer. Reserves and surplus as a separate line. Okay, so we're moving to the next question on AS9. And I hope the speed is okay. At least at this speed, your mind has to work in the exam. Otherwise, you will find it very difficult to complete the paper and come out. Suman Limited is in the business of manufacturing electronic equipments and selling these at its various outlets. It provides installation charges for the equipment sold and also provides free warranty on all the sold products. Beach resorts are leading resorts in the city. It purchased 5 ACs from Suman for its resort. Suman Limited sold 5 ACs to Beach Resort for 45,000 each, which includes 1,000 rupees of installation fees on each AC. Company also offers 1-year warranty for any repair that can happen. The company also offered 500 rupees per AC as trade discount. Revenue does not include trade discount. We have just seen it, okay, that provision wise. Beach Resort placed an order on 15th March and they made the payment on 20th March. ACs were delivered on 27th March and installation was completed on 5th April. You are asked to find out how much revenue should be recognized by the company as on 31st March 24. Before you read it, also see there is a revenue to be recognized for 24-25. Even next year, some portion of revenue is going to be recognized. So accordingly, calculate. 45,000 we'll do per AC and then multiply into number of ACs. Okay, 45,000 minus the trade discount of 500. Remove it off. 44,500. 1,000 rupees is installation, and because you did not complete the installation now, you cannot recognize the portion of revenue for installation. So minus 1,000, 43,500. This into 5 ACs, you have the option 217,500. Tick. Next one, how much revenue should be recognized in the financial year 24-25? It will be 5,000 because 5 ACs, 1,000 rupees per AC installation fee, 5,000. What will be the accounting treatment for trade discount? Trade discount should be deducted in determining the revenue. Option 2. Again, I don't think this is a difficult one. It's a very simple question. Is the company required to do any accounting for the warranty that is provided by it? This is not as per AS9. This is as per AS29. 9 should be linked with 29 because suppose you have to, there is an obligation for us to do some warranty. See, we have given a warranty of 1 year. So tomorrow, if that person, Beach Resorts, comes back to us telling that there is some problem with this AC, we will have to make the repair, and I can't charge anything from Beach Resorts that time. Hence, there is a possible there is an obligation on me. It's not possible, it's a present obligation, but I do not know how much amount I will have to shell out for that repair. Hence, please read, we will read the options. No accounting treatment required is wrong. You have to do some accounting treatment for it. As there is a present obligation to provide warranty to the customers, company should estimate the amount that it has to incur and create a provision as per AS29. This is the answer. They are not asking us the amount of provision, they are only asking us the theoretical question on provisions. Accounting for claims will be done on cash basis is wrong. Because you have given a warranty, you cannot wait till it happens on cash basis. You will have to do a provisioning right away. Not creating a provision is wrong. AS2. Inventories include materials awaiting in production process. What For inventory, yeah, what should include in the inventories from the following? Which will form part of cost of inventory? That's the question. Please read the options. Secondary packing required for transporting and forwarding the material. Secondary packing never forms part of cost. Spare parts, servicing equipment and standby equipment. This will go under AS10. It will not form part of inventory cost. Primary packing, which is essential to bring an item of inventory to its saleable condition. Very much yes. Anything directly attributable to bring the inventory to the current location and condition should be included as part of cost of inventory. Publicity material. Again, this question is there in MTP, no, RTP it has come. It is also there in your study material book back question, RTS limited. A very long case it is there, plus there are some 3 questions. Just that you need to have patience in reading this question. It's not a difficult one. I don't remember, even I'm reading for the first time with you. I just prepared the material, that's all. RTS Limited is engaged in the business of manufacturing equipment and components. Company has a contract with the Indian Railways for a brake component, which is structured such that the company's obligation is to deliver the component to the railway's stock yard. Yeah, this is a bit tricky question. I remember now. I think this is a bit tricky question. You should know. We will go back and read the question below. No? As per AS9, would your answer be different? Okay. You have to decide on when to recognize revenue. I think it's vaguely on that. Let me continue reading. The company's obligation is to deliver the component to the railway stockyard while the delivery terms are X works, and company is responsible for engaging a transporter for delivery. Railway sent an order for a defined quantity. Company manufactures that quantity and informs the railways that the items are ready and you can carry out inspection. After the inform, railway representative will come to the company's factory and they will inspect everything and they will put a mark as inspected, they'll put a mark on all the components. Once they have inspected and that mark is put, then with the hologram for delivery identification by the customer. The goods once inspected are marked with a hologram sticker to earmark for delivery identification by the customer when they are delivered to the customer's location. So this mark is fixed because customers should know that these are the ones which they inspected. So for them, they fix this hologram. Company raises an invoice once it dispatches the goods. Management is under discussion with the auditors in respect of accounting as regards its accounting with respect to subsequent events. They have been checking as to which one of the following events after the reporting period provides evidence of conditions that existed at the time of at the balance sheet date. Nationalization or privatization by government, out of court settlement of a legal claim, rights issue of equity shares, strike by workforce, announcing a plan to discontinue an operation. Company has received a grant of 8 crores from government for setting up a factory in the backward area. Okay, out of all this, whatever we followed, okay, now we are moving to the next part of the question where it talks about grant. Grant for setting up a factory means this is a grant in the nature of promoter's contribution. So you will go for capital approach, it will be credited to capital reserve. Okay, that's a provision. Now we will see what is given in the question. Out of this grant, 2 crore was distributed as dividend. There are illustration questions on this where they receive a capital grant but they distribute dividend out of it. It is wrong, not allowed. Company also received land free of cost from the state government, but it did not record in the books. Even if you receive free of cost, it is not okay to show 0. You will have to fix some nominal amount as the cost of the land. So you will have to show the land at some nominal value. Next, RTS Limited has a subsidiary which is evaluating its production process wherein normal waste. Now they come into inventory, normal and abnormal losses. So far this was on AS9. Then they came to AS12. Now they are coming to AS2. wherein normal loss is 5%. Let us calculate 5,000 input units on that. 5% is normal loss, which means 250 is normal, but the actual loss came to 300, which means 50 units is abnormal loss. Whenever there is normal loss, you'll have to find out what is the revised cost per unit. How to find revised cost per unit? 5,000 units of material into cost per unit 1,000, total cost divided by good units left after normal loss, which is 4750, because 250 should be deducted. Normal loss is 250. We get revised cost per unit is 1052.63. This is only the revised cost per unit. Okay, we will start reading. Please read the first question by yourself. Thereafter, I will conclude. When should they recognize revenue as per AS 9?
On completion of inspection, ma'am.
On completion of inspection. Good, Shalini. You will not wait for dispatch of components, because once they have inspected, they have to take the goods. The goods have been identified, they have been set aside for the buyer. So after that, delivery is just a physical delivery, but risks and rewards. Now that he is inspected, his hologram is also stuck. After the hologram is stuck, we will not be able to sell that item to anybody else. Hence, for us, risks and rewards have been transferred to the buyer once the inspection itself is over. Assessment would not change even in case the inspection is normally known to lead to no quality reductions. This is only the answer. Next question we move to. In respect of A Limited, what would be the value of inventory to be recorded in the books of accounts? Asking us the value of inventory. Notice line inventory is 5,000 units, entire quantity of base fossil stock. Okay, so 5,000 units we purchased. Out of that, normal loss is 250. Balance good units is 4750. I think the entire 4750 should be valued. 052. 60. Mm. 4750. Abnormal loss portion you have to remove, because they're asking only value of inventory. Remove 50. So the balance lying in closing stock will be 5,000 minus 250 normal loss. Out of 4750, 50 is abnormal loss. 4,500 only will be forming part of inventory. This into 1052.63. 4947,368. I get 361, but 368 is there. So I tick off that answer. I hope it's clear. 5,000 is the units purchased. 250 is normal loss. 50 abnormal loss. What will be valued as inventory is only after the abnormal loss. That is, you will remove the abnormal loss. Please guide regarding the grants. Please read the options. Distribution is incorrect. In the second case, land should be recorded at nominal value. Okay, Gyan Limited borrowed 10 crore for construction of a plant at a rate of 10% per annum. Construction was being carried on, and out of the borrowings, 4 crore was temporarily placed in a fixed deposit at 6% per annum. Interest earned is 24 lakhs. At a year in, how much of cost can be capitalized? This is a specific borrowing question. 1 crore, so 100 lakhs. 24 lakhs interest earned, so 76 lakhs can be capitalized. Okay, so we've completed past exam question and RTP. We are already 1 o'clock. It will come too much if I go ahead. You try MTP questions at your end. This is only for you to practice. There are 8 MTP questions, so totally 8 papers, 15 questions per, so totally 8 into 15. 120 questions are still there in this material. Ensure you can't do it all in a go, all in a single day. Every day, if you break up one paper also, in 1 week, you'll be able to complete all the 8 MTP MCQs.